Ms. Patterson. Don't mind standing in the aisle. Sorry. The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, all members shall have 5 legislative days within which to submit additional material to the chair for inclusion in the record. Like last month, the committee will finish its work today. However, unlike last month, we will roll votes and take all of them at once after we finish considering the last bill on the agenda. The committee will recess for floor votes when they occur, and as we get close, I'll provide an update as we get it. A quorum being present, we'll now proceed to today's business, and I'll now recognize myself for the purposes of an opening statement. This markup is a continuation of the committee's important work over the last several months. This includes efforts to address recent bank failures, capital formation, and the FHFA's politicization of our housing finance system. As we know, this committee can walk and chew gum at the same time, which I'm grateful for because after the last 8 days, chewing gum is about as much physical activity as I've had. Since the onset of the recent turmoil in our banking system, the committee has received reports from state regulators in New York and California, as well as the Federal Reserve and the FDIC. As part of our comprehensive examination into recent bank failures, regulators testified before this committee on their reports and provided any any additional information they might have gleaned since their respective reports were released. We also heard from former executives of the failed banks and experts in the banking industry. Our work to understand the events that transpired in March and April continues in full force and will continue. Throughout our examination into recent bank failures, one thing has become abundantly clear. Both the days before and after these failures have highlighted flaws in the bank regulators' authorities and duties. There's also a woeful lack of transparency and accountability with respect to federal regulators' decision-making. That's not about this administration alone. It is about the Article 1 versus Article 2 debate we often have in our constitutional republic. The bill introduced by Mr. Barr, which we are considering today, would address the opacity and lack of accountability that has been readily apparent. Our compilation of 5 bills, H.R. 3556, would place Congress on an equal footing with the administration, respecting it as a co-equal branch of government. The bills would ensure that Congress is informed as decisions are made and not provided with self-serving information after the fact. H.R. 3556 is a strong first step to ensure the banking regulators are acting within the authorities provided by Congress. This is about oversight. It's about accountability. We'll also finish up our work from last month to enhance capital formation opportunities by considering 4 additional bills. These bills contain common sense policies that will encourage everyday investors and small entrepreneurs to access our capital markets. H.R. 1553 will expand angel investing, providing greater access to capital for entrepreneurs and small businesses. H.R. 3063 brings much-needed parity for the retirement plans of employees of nonprofit charities and public education institutions, giving them access to the same low-cost investments available to employees of for-profit companies and other employees. We'll also consider H.R. 2627, introduced by Subcommittee Chair Wagner. This bill removes an SEC staff-level position that places an arbitrary limit on the amount of assets a closed-end fund may invest in private funds. Raising this threshold will open up additional opportunities for everyday investors saving for their retirement, to buy a house, or just to build a better life. Finally, we'll consider H.R. 3564, the Middle Class Borrowing Protection Act. In January of this year, FHFA announced a set of mandates and changes to the GSE's LLPA, loan level price adjustment pricing structure, impacting the vast majority of single-family purchases and rate-term refinance loans sold by the GSEs. The committee heard testimony last week that the that these new grids are flawed, and there remain much confusion over the process that the agency used to price credit risk. What we do know is that these changes penalize borrowers who have worked to pay their bills and establish good credit. This bill brings fairness and accountability back to the process. Furthermore, as I said, this committee can do many things at once. We've got very talented members. We've got very talented subcommittee chairs and ranking members. We've got a very, very talented roster at the top all the way to the bottom of this committee. And I think it's the intention of this chair and the ranking member to ensure that this committee does its work. And so we intend to follow through on that. And even if we have disagreements, we can air them well and keep our debates within the policy objectives that we're debating here in this room. And from time to time, we sometimes get off course from that, but I think for us to have mutual respect ensures that we can actually focus on policy and still move the people's business. With that, yield back, and I'll now recognize the former chair, the current ranking member of the committee, Mrs. Waters of California, for 5 minutes.
Thank you, Chairman McHenry, and good morning, all. In about a week, the United States could default on its debt for the first time. Let's be very clear, this is solely because the Republicans have manufactured a crisis and are using the debt limit to extort radical, harmful concessions that will hurt families everywhere. As we get closer to the default date, their demands are even getting more extreme, and the threat of a default is becoming even more likely. As a result, our financial markets are responding negatively, with investors demanding a higher premium of 1.4% for Treasury bills that mature in June to take on the potential risk of not being paid on time. If the government defaults and that kind of premium is backed or baked into the price of buying Treasury securities, some experts estimate that could increase the government's borrowing costs by more than $4 trillion. And that doesn't even take into account the sweeping consequences of a debt default for consumers, workers, small businesses, and the broader economy. The bills that committee Republicans are marking up today are harmful to consumers, home buyers, investors, and retirees, and they are strongly opposed by advocates, pension funds, and state regulators. Not to mention, they're all huge giveaways to Wall Street. For example, the Middle Class Borrower Protection Act would do the opposite of what the bill title suggests and increase fees on middle-class home buyers. H.R. 3063 would put the retirement funds of teachers, healthcare workers, and other public interest professionals at risk. And in case my colleagues on the other side of the aisle forgot, the United States recently experienced the largest bank run in its history and the second, third, and fourth largest bank failures. Thankfully, our nation's regulators and the Biden administration acted quickly and transparently to stop contagion. Regulators also provided the committee and the public with detailed, in-depth reports that included confidential supervisory information laying out the causes of these failures, including a GAO report, a request from Chair McHenry and I. As a result, we know a lot about the causes of the crisis and how to reform the system. However, instead of addressing the root causes, Republicans are pushing for deregulation and seeking to make it harder for regulators to respond to situations like this in the future by requiring more paperwork and other burdensome requirements. Committee Democrats are not blind to the causes of the failures and are prepared to offer solutions to hold bank executives accountable for their mismanagement, reverse Trump-era deregulation, and enhance supervision of the large banks to better protect our banking system. Let me just say that Mr. McHenry is correct about our attempts to work together. As a matter of fact, we agreed that there were 3 important issues that we were going to work hard together on. and I believe that was digital privacy and capital formation. Those are important issues. And so what we're dealing with today basically is capital formation. And I think we want to do it in a way that would protect consumers. At the same time, find ways by which to provide capital for our small businesses and others who, do good work for the public if they have the opportunity to do so. So I think it's important for us to work on these issues. I think it's important for us to respect each other as we deal with the complications of how to manage and whether or not we're giving, equal opportunity to just get an opportunity to get the work done. I think we can do that. Sometimes we have to talk about it a little bit more, but I'm certainly willing to work with him because it's easier when you can work together than when you have to be at each other's throats all the time. With that, let's get down with our business for today, and you'll see that we don't agree on the issues, but that does not mean that we can't agree on process. Thank you very much. I yield back.
Well, I thank the ranking member, and I appreciate the kind words, and I agree. Now, pursuant to notice, I call up H.R. 3556, the Increasing Financial Regulatory Accountability and Transparency Act. The clerk will report the bill, which was distributed in advance.
H.R. 3556, a bill to amend the federal financial laws to increase financial regulatory accountability and transparency, and for other purposes.
Without objection, the bill is considered as read and open to amendment at any point. The gentleman from Kentucky, Mr. Barr, the sponsor of the legislation, has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report.
Amendment in the nature of a substitute to H.R. 3556.
Without objection, the amendment is in the nature of a substitute. The amendment in the nature of a substitute will be considered as first-degree amendment, considering an objection. First-degree amendment for purposes of the amendment in the nature of a substitute will be considered a first-degree amendment for the purposes of amendment. And now we'll recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman, and I will briefly summarize the key elements of my bill, H.R. 3556, the Increasing Financial Regulatory Accountability and Transparency Act. I will begin with some key facts. We recently witnessed a bank run and failure of Silicon Valley Bank, described to us repeatedly as an idiosyncratic bank with poor management. Supervision failures, especially regarding a lack of sufficient focus on interest rate risk, contributed to the failure. Over the course of a weekend, Treasury, the Fed, the FDIC, and other federal and state regulators let a bank run turn into a systemic event. Emergency systemic tools were used by regulators, resulting in a substantial loss to the Deposit Insurance Fund, and the banking system has been fragile ever since. The chairman, ranking member, and many members of this committee stood behind use of those tools at the time in the interest of restoring calm in the markets. In contrast, while the president did address the public to help restore calm, he also irresponsibly threw politics into the mix, falsely accusing his predecessor of rolling back regulations, even though what he spoke of had nothing to do with the bank runs. Meanwhile, members of this committee promptly asked for information and details from regulators about what happened and why. Unfortunately, rather than being responsive to information requests from this committee, the regulators' authorizing committee, the Fed's vice chair for supervision, the FDIC chairman, and other regulators wrote their own hasty reviews of the problems to quickly set a narrative. Those reviews made no mention of the Fed's own monetary policy failures, the Fed's wildly inaccurate assessment of inflation as transitory, its delayed of monetary normalization leading to precipitous tightening and a rapid rise in interest rates, which made bank interest rate risk management more challenging. Vice Chair Barr led a review that, in thinly veiled ways, attempted but failed to reinforce the president's finger-pointing at regulatory changes made under the previous administration. During the politicized self-assessments by regulators, requests from this committee were sidelined and slow-walked. This recent experience identifies a clear need to put sunshine on the opaque federal regulators of the financial system, including the Financial Stability Oversight Council, or FSOC, which was asleep at the wheel, distracted by an obsession with a speculative and remote risk of climate instead of the concrete and immediate risk of rapidly rising interest rates that the Fed itself created. This leads to the conclusion that FSOC did absolutely nothing to promote financial stability in a panic. My bill provides additional sunlight by requiring increased accountability and transparency from the Fed, FDIC, and FSOC in general and during periods when emergency measures are invoked. The Increasing Financial Regulatory and Accountability and Transparency Act enhances FDIC transparency by increasing the reporting and documentation requirements of emergency actions, the actions taken to secure a resolution with the least costs to the Deposit Insurance Fund, and systemic risk determinations. Federal Reserve transparency by requiring more documentation and increased guardrails around any future 13.3 facilities. And FSOC transparency by taking back congressional power given away in the Dodd-Frank Act and reducing the ability of the Council to push partisan policies of the current administration. It also requires the Vice Chair for Supervision position to have supervisory experience to ensure the focus is on bank supervision and not extraneous issues outside the scope of the Fed's mission. And it increases federal regulatory transparency by requiring that the FDIC, OCC, and NCUA submit testimony and detailed reports and appear before the committee. The recent bank runs and systemic instability reveal that the federal financial regulators and Treasury are opaque and non-transparent to Congress and the American people, especially in emergencies when stability of the U.S. financial system is under threat. There is a clear need for sunshine on those regulators and enhanced accountability and transparency when their failures are really responsible. The Financial Services Committee is the authorizing committee for the federal regulators in question and deserves to be fully informed, especially when situations call for possible legislation. My bill enables Congress and the American people to be more fully informed about what the regulatory state is doing and provides the necessary enhancements of transparency and accountability. And for that reason, I urge my colleagues to support the legislation, and I yield back.
Gentleman from Kentucky yields back. Is there further debate? The gentleman from Georgia is recognized to strike the last word, Mr. Loudermilk.
Mr. Chairman, I move to strike the last word. I'd like to speak in support of H.R. 3556, which will address the supervisory and regulatory failures that caused and later exacerbated the largest series of bank failures this country has seen since the financial crisis. As this committee discovered soon after the collapse of Silicon Valley Bank in March of this year, the very entities that the people entrust to ensure safety and soundness in the banking system appear to have been asleep at the wheel. First, we were told that the systemic risk was low and that Silicon Valley Bank was an idiosyncratic bank with a homogeneous deposit base. Then, less than 72 hours later, another major bank failed. Again, we were told that these banks were similar with homogeneous deposit bases catering to wealthy customers. But earlier this month, we saw a third significant bank failure and signs of clear weakness in the regional banking sector. Immediately following SVB's collapse, federal regulators took a series of unprecedented actions to protect the banking system, and I applaud them for their swift attention to the matter. That said, their actions before and after the collapse raised an important question. Who supervises the supervisors? I believe the Constitution gives us a clear answer. Congress, specifically this committee. It is more important than ever that Congress has a complete picture of the regulatory and supervisory processes used to address systemic risk and to prevent regulatory overreach and improper supervision. As the gentleman from Kentucky said, it is only fair that the committee responsible for holding the federal bank regulators accountable, our committee, has the most accurate and timely information available to carry out our oversight duties. First, this bill would codify something that we've all benefited from recently. It would require the federal banking agencies to testify semi-annually before both the House and Senate. This kind of regular oversight is critical for keeping the committee informed about the state of our banks and credit unions and allows us to provide them with regular feedback from the constituents we represent. Second, the bill introduces three critical oversight provisions that will give this committee greater insights into the way prudential regulators respond to banking crisis. I want to specifically highlight Title III, the FSOC Transparency Act, which would make crucial reforms to ensure that the Financial Stability Oversight Council remains accountable to Congress and focused on their mission to protect the American financial system. One, it would require that the Secretary of Treasury testify annually in their role as the chair of FSOC. Two, it would require FSOC to notify the committee of any recommendations it makes to regulators regarding financial activities it deems to pose a systemic risk. Three, it would require FSOC to disclose its data, methodology, and analysis used to determine the cost of any proposal related to systemic financial risk. Third, the bill requires that the Vice Chair for Supervision at the Federal Reserve have sufficient experience to carry out his or her duties as the premier bank supervisor in the country. I'll close with this. For too long, bank regulators have operated in an opaque manner, depriving the people of insight into some of the most economically consequential decisions the federal government can make. I hope that my colleagues will join me in supporting this bill and shining light on the activities of our nation's bank regulators. Mr. Chairman, I yield back.
Gentleman from Georgia yields back, who seeks recognition. The ranking member of the full committee, Mrs. Waters, recognized to strike the last word for 5 minutes.
I move to strike the last word. H.R. 3556 is intended to respond to the recent bank failures, but I'm failing to see how this bill would help prevent a future bank failure. In fact, I'm very concerned that this bill would do the exact opposite. Regulators had to act very quickly to the bank runs on SVB and Signature Bank, in part because social media and digital banking technologies contributed to the accelerated pace of these runs. Regulators successfully and effectively used the current emergency authorities as they were intended to be used, but now Republicans are now proposing to fix what is not broken. This bill would create layers of new requirements to various emergency stabilization and financial stability tools, like the ones that regulators recently utilized, that would only hamstring regulators' efforts to respond to and resolve future bank failures. Specifically, this bill would make it harder to promptly invoke a systemic risk exception, limit the effectiveness of the Fed's emergency lending authorities, and to top it all off, the bill includes an unscrupulous political attack on the current vice chair of supervision by making him ineligible to serve in his current role. But Republicans didn't stop there. They also pulled out old, tired policies from a decade ago to hamstring agencies and programs that don't fit their brand. This bill would slash the funding of the Financial Stability Oversight Council and the Office of Financial Research, which are specifically charged with looking across regulatory silos to prevent a future financial crisis. The bill also guts the ability for FSOC to receive advice from a panel of experts on climate change in response to extreme MAGA Republicans' ridiculous claim that climate change and diversity is what caused the banks to collapse. Nothing in this bill would address the root causes of the recent bank failures. Instead, this bill meddles unnecessarily with regulators' tools and flexibility to respond in an emergency, despite the fact that regulators have gone out of their way to make confidential supervisory information available, be forthright about what happened and what they are doing in response, instead of proposing bills that would actually get at the heart of what caused the recent bank failures. My Republican colleagues seem similarly focused on blaming the bank supervisors. The regulators have owned their mistakes, and they are taking steps to fix what they can within existing authorities. But regulators alone cannot reform deposit insurance or take other steps to address systemic weaknesses exposed by the recent bank failures. That's Congress's job, and it would be irresponsible for us not to look at all the causes and factors of these recent failures. I and committee Democrats are focused on how we can fix the issues that contributed to these recent failures. The amendments we will offer today represent some of the legislative solutions that we would like to pursue. These are not gotcha amendments. They have been shared with committee Republicans in advance of this markup. I wish my colleagues on the other side of the aisle would finally roll up their sleeves and work with us constructively on strengthening the safety and soundness of our banking system instead of pointing fingers. As a matter of fact, we should be applauding the work of the FDIC and the feds and the Treasury and what they did in 48 hours to get SVB sold. And when we woke up on Monday morning, there was not a run on the banks. There was not the kind of contagion, despite what we all understand happened with the internet and the ability to get their information out. So let's take a look at what we can really do. There is so much that we can do. What we have learned as a result of these bank failures, and we have room for both sides of the aisle to have plenty legislation to deal with what we think we could do in order to prevent the kind of failures that took place this time. I yield back the balance of my time.
Gentlewoman yields back, and as a courtesy to the ranking member due to her personal intervention, I recognize the gentleman from Illinois, Mr. Caston, for 5 minutes to strike the last word.
Thank you, Mr. Chair. First, I just want to say that I'm disappointed in my friend, Mr. Barr, for offering this bill. There are serious issues with Silicon Valley Bank, Signature Bank, First Republic. There are things we should be addressing. They're not what's in this proposal. This proposal puts all of the blame on regulators, has a bunch of other changes that have nothing to do with the failures. And I think we will have been willing to work in good faith, but this is not that. But I think beyond that, I want to note how absurd it is that we are holding this markup when we're 8 days away from potentially defaulting on our debt in a global economic crisis. We should be taking that crisis seriously, passing a clean debt ceiling. And instead, we're sitting here trying to pretend that it's serious to propose reforms that would kick seniors off Medicaid and Medicare, make it harder for low-income Americans to access SNAP programs, eliminate 200,000 Head Start slots for children and Pell Grants for 80,000 students, cut veterans' benefits by 22%, and, as Moody's Analytics said, meaningfully increase the likelihood of a recession. And I hope I don't expect I'm going to persuade any of you, but I would hope you are persuaded by a statesman in our midst who said in November of this year, just 6 months ago, that he opposes McCarthy's plan to use the debt limit to extract potentially painful spending cuts from Democrats, who said, and I quote, "It is important that Congress raise the debt limit," adding that he looked forward to making sure members understand the debt limit, what it is, why it exists, and the consequences for inaction, who went on to say that Treasury markets are the lifeblood of the global economy, who closed by noting that it's an important function of the government for us to make good on the checks we cash. Those were all the words said by our chairman, Mr. McHenry, in November of 2022. He was right. He was right then. I wish we would all take the courage of those convictions that he seemed to hold so strongly 6 months ago. Because if it is now politically wise for the Republican Party to tank the economy, then it is partisan to defend it. I don't like that. None of us should like that. None of us should be proud of what we are doing here today. Because if we are sitting here having a hearing right now that is going to criticize people in Washington who failed to act in a timely fashion to prevent a foreseeable financial crisis, then we ought to get a mirror. The consequences of our inaction today vastly exceed those alleged to be caused by our prudential regulators. I yield back.
Gentleman from Illinois yields back. Mrs. Kim of California is now recognized to strike the last word for 5 minutes.
Thank you, Chairman. And I want to thank our committee chairman McHenry and subcommittee chair Barr for their leadership in drafting this common sense legislation to boost transparency and accountability of financial regulators. I was glad to join my colleagues' efforts as an original co-sponsor of H.R. 3556. SVC's failure revealed the opacity of the Federal Reserve and the FDIC and the close nature of the FSOC proceedings to Congress and to the public. Shedding light on the actions or inactions of financial regulators is the best recipe against future poor judgment and inaptitude. Our constituents need to regain confidence and trust in our financial system and know that financial regulators are using every tool possible to address bank mismanagement and foreseeable risks. Unfortunately, California has seen firsthand how the highest inflation in over 4 decades has had real-life consequences and led to the failure of 2 of its biggest banks, wiping nearly $500 billion in assets in just a matter of days. We must get to the bottom of the bank failures in order to strengthen our financial system and protect the backbone of our economy, our small and mid-sized financial institutions, which provide much-needed capital for our small businesses. And since SVB's failure, I have reached out to countless small and medium-sized financial institutions in my region to gather their input on the bank failures and the proposals being debated. Small and medium-sized financial institutions agree that they don't want the federal government to use the recent crisis as an excuse to increase regulations and capital requirements. So I urge my colleagues from both sides of the aisle to support H.R. 3556. A vote in favor of this legislation is a vote for transparency and accountability. I yield back the balance of my time.
Gentleman from California yields back. For what purpose does the gentleman from California, Mr. Chairman, seek recognition?
To strike as many words as you think appropriate.
The gentleman is recognized for 5 minutes.
I want to associate myself with Mr. Caston and others who have pointed out that we need to raise the debt limit and that shadow hanging over our economy far exceeds everything else we're discussing today. If we can't raise the debt limit and solve the problem for 2 years, at least a 30-day waiver. Republicans have taken our economy hostage. Perhaps it's too much to ask them to free the hostage, but at least agree not to shoot the hostage for 30 days. We need to deal with the U.S. deficit and focus on revenue and spending and focus on effective tax enforcement. The recent augmenting of IRS appropriations will, I believe, and I used to head the second largest tax agency in this country, collect far more than is projected, because you have to understand how communities react when you hear that someone else has been audited. You tell your CPA, and I used to practice as one of those, maybe don't take the most extreme position. And others who think not of what position they're going to take on their tax return, but are tempted to evade taxes, are less likely to do so in such an environment. So inspired voluntary compliance is just part of what additional auditing of those with over $400,000 of income will accomplish. As to the bill that we have here, I think it misses the point. The regulators and the banking industry profoundly underestimated the importance of interest rate risk. They knew full well that when interest rates go up, and they do go up, and they do go down, and today's 5% rates are nothing compared to the 16% rates we had a few decades ago. This is not a 100-year flood. They knew that interest rates would go up and down. They believed in ignoring the problem because it's easier to go through life ignoring problems. And they believed that depositors would choose to subsidize the bank. That is to say, well, interest rates go up and you had your money in the bank earning 0% or 1%, and you might just leave it there, even though you can just walk across the street and get 4% or buy a treasury bill at 4%. And in fact, there is some period of time in which depositors will subsidize a bank, will not immediately demand a higher interest rate or remove their funds, but that lasts only so long. And so they built models that said, well, if interest rates go up, sure, our marketable securities are worth less. Sure, the amount we're charging on loans is bringing in less money than we'd have to pay on new deposits, but our old deposits will just sit there because our customers love us so much they want to subsidize us and leave their money in at low interest rates. And while there is a little truth in that, very few of my constituents are anxious to subsidize their bank out of love for their bankers. So I'll be introducing 3 amendments designed to force the regulators to look with an unvarnished eye on interest rate risk. And I hope to have support. If I don't, I will not call for a recorded vote, because I know we're busy, and I know that this debt limit hangs over all of us. I look forward to trying to deal with this interest rate risk issue. Fundamentally, the responsibility is on bank management, but if you let people drive at 80 and 90 miles an hour on the freeway, that's on them, but it isn't really a good way to run a freeway.
Would the gentleman yield?
I will yield.
I thank my friend. Well, I think that you make some good constructive points there, but I want to not leave your comments on the debt ceiling just hanging out unresponded to, because since February 1st, Speaker Kevin McCarthy has attempted to encourage the president to have a bipartisan, sensible, responsible increase in the debt ceiling. And if it was such a priority for Democrats, obviously Speaker Pelosi and Leader Schumer and Mr. Biden could have raised the debt ceiling for a more long, extended period of time back in December, when all 3 levers of power were controlled by that party. I thank my friend, and I just would say that we've passed a bill across the floor to raise the debt ceiling, offer responsible conditions to it, and we invite Mr. Biden to do that. Now yield back to my friend.
Reclaiming my time, Democrats did not control the Senate when you need 60 votes to pass something through the Senate.
I think the time has expired, the gentleman. I thank you for the colloquy. Look forward to the discussion. The gentlewoman from Texas, Ms. Dela Cruz, is recognized for 5 minutes to strike the last word.
Mr. Chairman, I'd like to strike the last word. Thank you. I'd like to express my support for the pieces of legislation presented before our committee today, particularly Mr. Barr's bill, the Increasing Financial Regulatory Accountability and Transparency Act. Title V of this bill includes my own legislation, H.R. 3555, the Banking Regulator Accountability Act. Just last week, we heard from the former leaders of several failed banks and learned that the regulatory supervisors repeatedly made questionable decisions in the run-up to those bank failures. Currently, only the Federal Reserve Board's Vice Chair for Supervision is required to testify semi-annually before Congress. My bill would further codify this requirement for the vice chair and expand it to include the leaders of the FDIC, the Comptroller of the Currency, and the National Credit Union Administration. My bill also extends the reporting requirements for each of these regulators, which will help Congress further understand the condition of the financial institutions the federal banking agencies supervise on an aggregate basis. It is important to note that these reports will be disclosed in a confidential manner to appropriately protect supervisory and market-sensitive information to the chair and ranking member of our committee, as well as the Senate Banking Committee. By testifying before Congress, regulators can educate our lawmakers on the challenges, trends, and potential vulnerabilities in the banking industry, which facilitates the development of effective regulatory frameworks. This fosters a system of checks and balances, allowing Congress to assess their performance, inquire about policy decisions, and provide necessary guidance. By engaging in meaningful exchanges with regulators, lawmakers can gain first-hand insights into the practical implications of their legislative decisions. In an era where the financial landscape is constantly evolving and economic stability hangs in the balance, it is imperative that our regulatory bodies maintain a strong and transparent relationship with our citizens' elected representatives. With that, Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition? Gentleman from Illinois, Mr. Foster, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Chair. I'd like to first echo my disappointment about the overall content of this legislative package, which contains the germs of some good ideas, but unfortunately enough poison pills, if not choking enough to choke an elephant, at least to choke a donkey. And I think it is. It's also important to, just to pick an example, the idea of placing additional bureaucratic reporting requirements, particularly in the first 3 days following a determination of financial emergency, when regulators are probably working day and night to prevent further spread of contagion, is really, really unwise. As a scientist who loves numbers, I also understand that a lot of things, for example, around systemic risk determinations, will not be based only on numbers, but on non-quantifiable psychological variables, which are so important in the spread of contagion. I look forward to getting this passed through our system so that we can continue to do good bipartisan work that I know this committee is capable of. Thank you, and yield back.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Chair. I move to strike the last word. The recent failures of Signature Bank, Silicon Bank, and the First Republic Bank stemmed from shortcomings of our financial regulators. The problems with Silicon Valley Bank in particular were known to the Federal Reserve and other regulators and opinion writers at the Wall Street Journal, believe it or not, but they were slow to act on glaring problems. Congress gave regulators all the tools they needed to prevent this collapse, and they should not be granting the Federal Reserve more power when they were asleep at the wheel with the authority that it already had. Rather than accepting responsibility, Vice Chairman Michael Barr sat right in front of us, who has no prior experience working in the supervisory depository institutions, and attempted to deflect blame to his predecessor in the Federal Reserve's report on the collapse of SVB, despite making no changes to the Fed's supervisory practices in the 8 months on the job. The Vice Chair of Supervision Banking Experience Requirement Act, which is included in this package, would require the Federal Reserve Board's Vice Chair of Supervision to have previous real-world experience in banking. I now would like to yield the balance of my time to Congressman Barr.
I thank my friend from Wisconsin, and I do want to respond to a few of the substantive objections that our full committee ranking member made to my bill. But before I do that, I want to just respond briefly to my colleagues on the other side of the aisle who expressed disappointment in me that we're talking about this when there is a looming debt ceiling default over the Congress, because I share the sentiment that we obviously need to avoid default. The problem is that the president has been missing in action in this conversation for the last 3 months. More than that, the Speaker of the House signaled a willingness to sit down with the president, who refused to negotiate for 100 days and waited until right before the Treasury Secretary says there's a deadline to actually finally invite the Speaker back to the White House to have a conversation. So the characterization that there's inaction by House Republicans, by the way, the only group that has actually voted to raise the debt limit. Every single one of my colleagues on the other side of the aisle who references inaction voted against raising the debt limit. The only group that's been negotiating in good faith or inviting a negotiation is the Speaker of the House on behalf of House Republicans who did vote to raise the debt limit. Now, I concede that our friends on the other side of the aisle don't like the fact that we're also focused on the full faith and credit of the United States beyond the immediate next 2 weeks, that we are also concerned about the full faith and credit of the United States bearing future generations of Americans in debt. But there needs to be a good faith conversation that has only recently begun. Inaction has only taken place on the other side of the aisle. So if Senator Schumer wants a vote, he can do it. He controls the Senate. They need to negotiate in good faith. On the issues related to the bill, look, the ranking member says that we're hamstringing regulations. I don't know why we're rushing to defend regulators when they haven't even responded to our request for information. We're not making it harder to invoke the systemic risk exception. In fact, we want to know why the systemic risk exception wasn't invoked earlier, which could have saved massive losses to the deposit insurance fund. We're not limiting emergency lending. What we're doing is we are requiring more information and details on emergency lending actions taken by the Fed. I will note that in previous Congresses, there have been proposals to actually require congressional authorization. That's not what this bill does for the Fed to invoke 13.3 credit facilities, but it does require a little bit of more transparency and visibility into those decisions and information and detail on those actions, including a GAO audit. And finally, we're not slashing funding to FSOC. We're freezing funding at FSOC because FSOC was asleep at the switch. It was more focused on speculative climate risk than what was obviously there hiding in plain sight, which was the interest rate risk that the Fed itself created by delaying monetary policy normalization. So the opacity of the regulators here is what we're getting at. As a co-equal branch of government, the American people, through their elected representatives in Congress on both sides of the aisle, deserve more answers and transparency from regulatory failures like
Gentleman's time has expired from Wisconsin, and the gentleman, Mr. Barr, yields back to the gentleman from Wisconsin. And who seeks recognition?
Thank you, Mr. Chairman. I believe I
The
have an
gentleman
amendment
from
to that.
Massachusetts is, we haven't finished the ANS.
I believe you're right.
Yeah, I'm sorry, the gentleman.
That's okay.
So recognize Mr. Sessions of Texas for 5 minutes to strike the last word.
Mr. Chairman, thank you very much. I find it very interesting that our colleagues have decided to take on Mr. Barr in this way, despite the evidence of testimony that was from the administration. The facts of the case are real simple, that they testified that regulators had talked to the bank as early as 2018, advising them that they had some problems as it related to liquidity, that they could see that what they had done, the bank, perhaps needed to be addressed. And then we heard that what happened is, but nothing happened then. So we took questions directly to them and said, why didn't the regulators follow up? And the facts of the case are that the testimony, they did not. Now, I offered some commentary at the time that I got that. I understood that because as soon as we got to 2020 and our colleagues began pushing spending to the highest record levels ever in this country, the Treasury Department responded back that inflation was nowhere on to be seen, that it was not going to be a problem. But in fact, that did topple and exacerbated the modeling that was seen by supervision of the bank. They fell right in line with the inflation problem. And it happened because the supervisors, I assume, were listening all the way up and down the line, not just to Treasury, but to the administration who kept talking about inflation's not a problem. It's transitory. It's not going to stick around. It's not going to affect people's business models. When in fact, inflation came roaring back, which exacerbated everybody's business model to see that they would need more money faster. They would draw down the money, that the money that was put aside would be drawn down at such a rate that would put liquidity for a bank in jeopardy. But what happened is
We had hearing after hearing in this committee talking about how inflation was going to harm consumers, harm companies, harm banks. And every single time, this administration put their frontline people out to say, not gonna happen. We don't have to worry about that. So no wonder the regulators got it wrong. They were listening to their boss's boss's boss of the company line from the administration. That's not what happened. What happened is we have 40-year high inflation. We have debt crisis in this country because of excessive spending. We have problems that we're faced with today. So Mr. Barr is doing the right thing by putting what is in front of this committee, the things that we handle. The administration and the speaker are going to worry about the debt limit. That is what their job is, and our job is to do what Mr. Barr is doing today. So, Mr. Chairman, I would say to you, I'm kind of shocked that we would not have this discussion, and I'm also shocked that people would have such short-term memory that they forgot that they were simply doing as supervisors what their administration told them was going to happen. And it didn't happen that way, did it? No, it did not. Mr. Chairman, I yield back my time.
Gentleman from Texas yields back. The chairman recognizes himself for 5 minutes to strike the last word. So I rise in support of Mr. Barr's bill, but I do have some questions. I hope he'll engage with me on a colloquy in regard to Title V of his bill, where he talks about data being collected and reported on bank supervisory results. As I understand it, this is not individual bank camel ratings. This is not individual bank exam reports. Is that right?
That is correct.
I yield to my friend. Because I think it's very important that we absolutely not go down that road in this committee. We have enough problem with this left over from the 1924 Tax Act, where we're reporting individuals' tax records to the Congress for legislative purpose, which can be politicized and weaponized and used inappropriately. I think that was a real mistake that when Congress did that. And I don't want to see us do that with bank exam information. And my friend from Kentucky agrees with that, I assume.
Gentleman yield.
Gentlemen, I yield.
I do agree with that, and I appreciate my friend from Arkansas clarifying legislative congressional intent on that point.
Yeah, I thank my friend, and as I say, I support this bill and yield back the balance of my time, unless the gentleman from Kentucky needs anything. I would yield to the gentleman from Kentucky.
Just one further point to underscore, I think, the good points that my friend from Texas was just making, Mr. Sessions, and I would highlight that there is a relationship between the debt limit conversation, the overspending crisis in our country, the debt crisis in our country, and actually what we're talking about here today with this transparency bill and regulatory transparency. And the connection is the underlying cause of bank instability in our country. The underlying cause of bank instability in our country is fiscal and monetary policy failure. When you have a Congress that's so untethered from fiscal discipline that they increase the spending trajectory of our country by $10 trillion in just 2 years, creating a 40-year high inflation crisis, and a Federal Reserve that is so disconnected from the fiscal policy realities that they fuel the fire, continue to purchase $120 billion of bonds, and keep interest every month fueling the inflation crisis well into economic recovery after COVID. And they delay monetary tightening, and they keep interest rates too low for too long. What ultimately happens? The Fed moves too quickly, and the Fed starts to tighten 500 basis points in just 13 months. That is the underlying cause of the difficulties that bank management have in managing their interest rate risk, having to adjust to this abrupt policy response from the Fed, and then makes it difficult for bank supervision. But to have the San Francisco Fed be completely asleep at the switch when the Fed itself is responsible for these monetary policy mistakes, that's why we need more transparency at the Fed. That's exactly why we need congressional visibility into these decisions, which the regulators are denying to us. So there is a deep connection to the overspending problem that has brought us once again to a debt ceiling and the regulatory failures that fed that decision and why we need more transparency with these regulators. And so that's why we're having this conversation right now in the middle of these delayed default conversations, and I yield back.
The gentleman yields back to the chair yields back. For what purpose does the gentleman from Massachusetts, Mr. Lynch, seek recognition?
Mr. Chairman, I have an amendment at the desk.
We will pause while the amendment is distributed.
Mr. Chairman,
The gentleman from Missouri.
I reserve point of order.
A point of order is reserved.
I just want to leave this.
Here he comes.
Get a chance to look it over at a better time.
Thank you. Thank you.
The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 3556, offered by Mr. Lynch.
Without objection, the amendment is considered as read. The gentleman from Massachusetts is now recognized to discuss his amendment.
Thank you, Mr. Chairman. I can't resist just commenting about fiscal irresponsibility, and I refer to the Trump tax cuts that added $2 trillion to the national debt. $2 trillion. Every single Democrat in Congress voted against it, and every single Republican voted for it. Added $2 trillion. So there's no purity here. Both parties have been responsible for this debt over a long period of time. Mr. Chairman, my amendment deals with the failed bank acquisition process. So we've seen this happen several times, unfortunately, over the last few months. My amendment would ensure that more banks can be part of the bidding process to purchase failed banks by directing the FDIC to only consider the bids of a mega bank with more than 10% of total deposits if no other bank offers a qualified bid to buy that failed bank. Under the current law, mega banks that have more than 10% of total deposits in the United States, they're not allowed to acquire another depository institution, and it is a common sense limitation that promotes competition and helps ensure we have a banking system with not only mega banks, but regional banks and local banks, mid-sized banks, and credit unions. Though there is an exception that has been talked about earlier in this hearing about systemic risk exception to the concentration limit. In such a circumstance, the mega bank can buy another bank if it has failed or is in danger of failing under that systemic exception rule. However, that urgency and that danger of systemic risk is often present, so it sometimes becomes the rule rather than the exception. The FDIC is also required by law to accept a bid that is the least costly to the Deposit Insurance Fund. And this typically means that the largest institutions have an advantage in being able to outbid other banks. It was not a surprise to see J.P. Morgan win the auction to acquire First Republic Bank. That was a cluster. It was a real scramble. I know they were short on time before the markets opened on Monday. This purchase came after the bank received a surge of deposits. After depositors became concerned, they moved from these regional banks into big banks that were perceived too big to fail or that would have government assistance. However, there were reports that there were at least 3 other banks that were in the mix there: PNC, Citizens, and U.S. Bank Corp. None of those look, those aren't small banks, but they're not GSIBs. They're not mega banks. And I just think that having a more democratic process as opposed to just making these mega banks bigger would be better for the system broadly. Remember, these regional and smaller banks serve a whole different clientele than the mega banks do. And so we want a healthy system of regional banks, local banks, credit unions, instead of just feeding and giving advantage to, and letting these big banks get bigger. There's a different mission for community banks and regional banks. They have a more local mission. They service local businesses and local real estate markets, while history has shown us that these mega banks do not operate in that fashion. They're more on a national or a global scale. So I'm hoping that my colleagues will support this amendment. It is meant to sort of democratize this process in a transparent way and not give undue advantage to some of these mega banks that are already, as we know, too big to fail. So with that,
Would the gentleman yield?
I will yield, sure.
Yeah, gentleman, thank you for yielding for a question. Does the FDIC support this amendment to the best of your knowledge, or do they provide technical assistance?
I don't believe I've asked them at this point.
I thank the gentleman. You know, I have empathy for the fact that we need more bidders in the process, but they have this statutory obligation that we put on them to have the least cost resolution, and they need, I think, every option on that. But I thank my friend for yielding.
That would remain. That would remain. So just reclaiming the little bit of time I got, that would remain. We do want the least cost standard is in regard to the DIF, right? The Deposit Insurance Fund. So they would still have to do that. It would just widen out the number of bidders who were.
The gentleman yields back. Is there further debate? The gentleman from Kentucky is recognized to strike the last word for 5 minutes.
Strike the last word. Let me just say to my friend from Massachusetts, I really appreciate the sentiment behind the gentleman's amendment. I appreciate the sentiment because I agree with the policy objective. The policy objective being to maintain a robustly diverse banking sector. In other words, we don't want we don't want the result to be a barbell system where we have a lot of small community banks and only too big to fail large Wall Street banks and nothing in between. I totally agree with the gentleman's desire to make sure that we preserve diversity. And I do think that the FDIC should maintain an eye on regional banks, mid-sized banks in the merger and acquisition process. And so I think there needs to be some changes in the delays at which the regulators block and thwart the merger and acquisition process in the mid-range and regional bank segment of the banking sector, because that is actually diminishing the resiliency of those institutions as they struggle to compete with the GSIB banks that you're talking about. So the sentiment is a sentiment that I share. I think that motivates the gentleman's amendment. The problem is, I think, as our chairman pointed out, is the least cost resolution requirement. And the idea that you would take off the table the requirement to save the diff.
Would the
deposit-
gentleman yield?
Yeah, I will in just a minute, just to finish the thought. I think there needs to be a recognition that that is the statutory obligation. And I fear that if the FDIC were forced into a situation where they increase losses to the diff because of the gentleman's amendment, that would actually hurt the very institutions that he's trying to assist, because it would mean a higher assessment for those regional and small community banks. So I'll yield and ask the gentleman to respond to that concern.
Sure. So the way this is drafted, the other thing it protects is competition, right? So what we're asking here is that the FDIC consider all bidders who are qualified. And remember, the prime directive here is protect the diff, always. So even though it invites in and gets 10 competitive bids from regional banks, the directive and the primacy of the diff is still dominant, okay? So they can always choose the mega bank if that is the best method of protecting the diff.
If I could just reclaim my time, that is the law. The law is that more banks rather than fewer banks are encouraged to bid on failed and failing banks, because that would ensure the least cost resolution. That's the statutory requirement. Remember, if there is a solution or resolution, a path that is chosen that does not limit the losses to the diff, that means institutions that are below the GSIB level could very well face higher assessments. That kind of pressure is not what we want. But I will reiterate my appreciation for the gentleman's sentiment that we need to do all we can to protect the diversity of our banking system, especially protecting the competitiveness of non-GSIB banks. And that is precisely why members should oppose policy choices by regulators to roll back regulatory tailoring. That's why we need regulatory tailoring, so that we don't put unnecessary regulatory pressure on non-GSIB banks. And so as the Fed considers its holistic review of the regulatory framework, I invite my friend from Massachusetts to apply the scrutiny on rolling back regulatory tailoring, which would make too big to fail banks even bigger. And I yield.
Gentleman from Kentucky yields back. Is there further debate? The gentlewoman from California, Mrs. Waters, the ranking member of the full committee, is recognized for 5 minutes to strike the last word.
Thank you. I move to strike the last word. I support this amendment, which would ensure that more banks can compete in the bidding process to purchase failed institutions. Specifically, it directs the FDIC to only consider a bid by a mega bank that holds more than 10% of deposits in the nation if no other financial institutions meet the least cost tests per current FDIC requirements. One of the takeaways from the recent failures was that consumers' confidence was shaken, not in the largest banks, but in other regional, mid-sized, and community banks. I heard several reports that people panicked and moved their money from minority depository institutions and smaller banks and into the nation's biggest banks based on the notion that they are too big to fail. Another concern about too big to fail emerged when J.P. Morgan Chase ended up purchasing First Republic Bank, the third bank to fail in the last 2 months. Many across the nation wondered how the federal government would make a big bank even bigger. This was especially concerning as it has been reported that there are other banks that made offers to acquire First Republic that were solid offers, but J.P. Morgan Chase's offer was a little better. The problem is that the FDIC has to accept the lowest offer, even if that offer leads to a mega bank becoming even bigger. While we have focused our situation today on U.S. bank failures, we should not forget that Credit Suisse failed and it could only be acquired by one other bank in Switzerland, UBS, leaving the country with one mega bank. This situation should be a wake-up call for this committee to find ways to revise the resolution of failed institutions. So I appreciate that Representative Lynch's amendment will introduce more competition in the bidding process. I also think that this committee should spend time thinking about how we can slow down the resolution process to enable community banks and MDIs to better participate in purchasing pieces of a failed institution so that we don't end up eventually with just a handful of mega banks. So I urge members to support this amendment, and I yield back.
Gentlelady yield?
I yield to the gentleman from Massachusetts.
Thank you. I just want to emphasize what this is doing here. So the mega banks have an enormous advantage here, and if we keep having these systemic failures, they're going to gobble up these smaller banks. They just go away, right? They get eaten up by the larger banks. It's not a healthy situation. We reduce competition. We reduce service because, as I said before, these mega banks have a mission, and it is not to help the little guy. It's not to help the local businesses. It's not to help, the average. It doesn't help Main Street. It helps Wall Street. And so the idea here is to open up the process, and if the costs are the same to the diff of giving it, allowing a regional bank to come in, a healthy bank to come in and purchase the assets of that failed bank, if the cost is the same between the purchase by the regional bank versus the purchase by J.P. Morgan Chase, and I appreciate what they did. They're a favored bank. They're definitely too big to fail. Then if the costs are even, then the FDIC is directed by this legislation to consider, first of all, to open up the bidding process to those smaller banks, the regional banks, but allow them to put a bid in to purchase that failed bank. I think that's a healthier process, and always protection of the diff is predominant. We're not changing that. That's a statutory requirement, and it remains in place. But it at least gets these smaller and regional banks in the game, and I think that serves all of us. So I yield back.
Gentleman yields back to the gentlewoman from California. Gentlewoman from California yields back. Is there further debate? The gentleman from Missouri, Mr. Luetkemeyer, is recognized to strike the last word for 5 minutes.
Thank you, Mr. Chairman. I appreciate the gentleman's thought process here in that, I'm not a big fan of the big guys getting bigger either. However, there's a lot of problems with the system the way it is. There's a lot of problems with with how these problems arise. The least cost situation is something that has to be addressed, which the sponsor is concerned with as well. That sort of sometimes stymies some of what's going on. It also directs how this is actually going to be solved. I was kind of curious about the comment he made a while ago. The government needs to get involved in order to have a more democratic process. That's kind of a head scratcher for me. But I think one of the problems that we see as we go through this, and we've just seen this with this recent situation, is that the size of the banks that are in trouble dictate that there's a very limited number of other banks that can purchase them. And because of that size, it takes a lot of other things to be able to finance the acquisition of this bank that may take time for a smaller bank to put together a package that can be able to do that, where a bigger bank can do it. I'm not, again, trying to promote the big banks here, but I think you have to understand that the problem here is is much more complex. It's also complex from the standpoint that the merger and acquisition process is a disaster right now. The regulators absolutely positively are a big problem when it comes to mergers and acquisitions. They delay everything, they put more roadblocks in the way, and as a result, even if you have a competitive situation where you have an ongoing bid for another bank, two banks want to get together, you have a bank that is weak and a bigger bank or another bank want to get together with it and shore it up and become a stronger bank, it's difficult to get that done because of the process right now with the regulators. So the regulators are putting roadblocks in the way over here of trying to let a weak bank get purchased so they don't get to the situation we have now, or did have, as well as the problem of these smaller banks, the regional banks, actually putting together a proposal that could be competitive, and sometimes this has to be done very quickly, just like what happened over the weekend here when these banks went down. Number one, you got to be able to quiet the markets. Number two, you got to be able to quiet the depositors who are going to run on this thing like crazy. We saw testimony here where the CEO for Silicon Valley said that within 10 hours they had $42 billion run off the bank books. $42 billion in 10 hours. The regulators have got to step in and make some really big decisions very quickly. I've got a couple of bills to be able to help them do this in a crisis situation where they see the whole system at risk, which, quite frankly, we did for a moment there. But I think we need to be taking a look at, I mean, this is such a complex problem. I'm not sure that this bill solves the problem. I appreciate the sentiment, but I think each situation is different. And I think it takes a lot of tools in a toolbox for the regulators to be able to pick and choose which tools actually address a particular situation and how that situation affects the industry as a whole. Is it a crisis across the board, or is it just a very unique situation to a particular bank or two? And I think that's where we need to be thinking sometimes. So,
Would the gentleman yield?
Yeah, I'll yield to the chairman.
I think you bring up some really good points about the time frame, and I think you bring up this issue that I think Mr. Lynch could take into consideration here, that we don't, both sides don't like the barbell situation we have in the industry. But there's an asymmetric information benefit to the biggest banks, and smaller regional banks and their capital planning, aren't granted, that same capability. I agree with your comments about there are members of the Senate, for example, that don't want any bank mergers and have blocked smaller bank mergers that could lead to a middle-sized bank that could be a better bidder. And then this issue of what about pre-qualifying a group of medium-sized bankers to give them a better asymmetric participation. I yield back to the gentleman. I just think you make a very good point.
No, I think you've expanded on my concerns. I think, the speed with which these things have to go through sometimes precludes certain banks from being able to bid. I think the merger and acquisition process, as you articulated here, needs to be fixed so those weaker banks can be purchased by a bigger bank and actually then be a bigger player down the road. I think there's a lot of areas here we need to take a look at that doesn't necessarily talk back to the regulators as a problem, which in my mind they were a problem in this situation that we just got through. But with that, I yield back the balance of my time.
Gentleman from Missouri yields back. There's further debate. The gentleman from Illinois, Dr. Foster, is recognized for 5 minutes to strike the last word.
Thank you. This is not the first time or the last time that we'll be visiting this issue of how to prevent the bank consolidation that none of us are comfortable with. I think we should recognize a couple of things about it. First, this is the natural result of unfettered capitalism. Okay, there are real economies of scale of banks. As banking becomes more and more digitalized, they will have more and more of the characteristics of digital businesses, which are always natural monopolies, right? And we have to understand how we're going to lean against this tendency without making absolute rules that stop economically important consolidation. And we interfere with capitalism in many ways, for example, with antitrust law, or with Buy American provisions in federal procurement, where we very consciously say we are not going to go with the lowest bidder for some federal procurement because we're going to give a preference, and maybe that's one of the ways we could consider handling this, to have a preference of X% to a bid with coming from a bank that's not one of the giant banks already, or something along those lines. But I warn my colleagues not to do this with deregulation. You know, it comes outside of my memory, and probably most of us on this committee. But if you look back at the big banking crises in the past, the one that hurt the taxpayers the worst, the savings and loan crisis, where the taxpayers had to they had to come up with something like 1.7% of GDP out of taxpayers' pockets to bail out not a few giant banks, but thousands of smaller institutions which were not well regulated. And so don't just look straight to deregulation as the mechanism that will make small, 1,000 small flowers bloom here. We're going to have to think a lot more thoughtfully about this. I think I agree that the motivation behind this amendment is good, but I think we need something more tailored and thoughtful than an absolute prohibition here. Anyway, I thank you, everyone, for their thoughtful comments there. We have to let this conversation continue and come up with something that really accomplishes what we want. A final thought on this is that I think the thing that we love about small banks is what they do, not just the fact that they're small versus large. And so if we're thinking in terms of subsidies, we should subsidize the activity, the local mortgage origination, the local loans to local businesses that we're not seeing. We're seeing some, but not too much from the giant banks. And so if we're thinking of trying to encourage those, let's encourage the activities that we love that are dominantly done by some small banks, and then let the market decide the right distribution of bank size to provide the things that we love. So thanks much. Yield back.
Gentleman from Illinois leads
Gentleman yield
back.
back. Gentleman, let me.
I'm sorry, the gentleman's time has expired. Is there further debate?
2 minutes.
If not, does the gentleman from Missouri insist on his point of order?
Withdraw my point of order.
If not, the question now occurs on the amendment offered by the gentleman from Massachusetts, Mr. Lynch. All those in favor shall signify by saying aye.
Aye.
All opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it.
Request a roll call.
Mr. Lynch requests a roll call vote. All those in favor of the roll call vote will raise their hands. A sufficient number having raised their hand, a recorded vote is ordered pursuant to Rule 3C5 of the committee rules. A vote on this question is postponed. For what purpose does the gentleman from California seek recognition?
I have an amendment at the desk.
We will pause while the amendment is distributed. Oh, yes.
Yes. First, let me take,
Mr. Chairman, you reserve point of order.
Gentleman from Missouri has reserved a point of order. It is reserved. Ready?
okay, thank you.
The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 3556.
Without objection, the amendment is considered read. The gentleman from California, Mr. Sherman, is now recognized on his amendment.
I'll take one of my 5 minutes to deal with some of the general comments that have been made. The CECL accounting system discourages the very kind of business lending that Mr. Foster and I and so many of us would like to see banks engage in. Democrats may not have voted on the floor to raise the debt limit, but we all signed the petition that would bring to the floor such an opportunity to vote. It seems a little unfair to say that Democrats don't want to vote to raise the debt limit when in fact we are anxious to do so, but not being in the majority are not given the opportunity to vote for a clean or a Democratic version of a debt limit increase. Yes, the economy was not perfectly managed due to COVID. The health aspects were not perfectly managed. This was an extraordinary event. We do have inflation. Somebody may, 100 decades from now, write that perfect book about how we should have handled COVID. I have very few times does society deal with something that startling perfectly. The Fed is independent. It should not be regarded as partisan when Mr. Powell was originally appointed to the Fed by Donald Trump and then elevated by President Biden. Banks should not be saying that it is the fault of the Fed that they are having difficulty. We need seaworthy boats that can withstand wind and rain. Yes, we've moved to a 5% interest rate world. That is a normal world, or pretty close to a normal world. It is nothing like the 16% world that we had a few decades ago. Interest rates go up, interest rates go down. We need banks and a regulatory system that can deal with it. That is why this amendment is necessary. What it does is it looks at the available for sale securities that banks have and say, look at the real value. You're holding them, they're available for sale, there's a market value if you sell them, and if you're going to sell them at a loss, that affects your capital. The American banking system had $280 billion in unrealized losses for available for sale securities, yet most of this is not reflected in the capital of the bank. In Europe, this is required. Basel III requires that regulatory capital include unrealized losses on held for sale marketable securities. We require this in the United States of banks over $700 billion. We make it elective for smaller banks, and unfortunately, 2/3 of the banks have opted for a fairy tale balance sheet instead of a real balance sheet. But we can prove that this is workable since 1/3 of the smaller banks have adopted it voluntarily. We need to join Europe. We need to do what is the best practice that has been embased by 1/3 of the smaller banks. We need to follow a rule that applies to all banks of over $700 billion and say, when you calculate your capital, if you've lost money on securities and those securities are held available for sale, that you must recognize those losses. I'll add that this is symmetrical. That is to say, if a bank has made money on its marketable securities, it can increase its capital just by selling those securities, and nothing is as easy as selling a bunch of treasuries at a profit. So the banks are free to increase their capital by selling their held for available for sale short securities. Their capital should be decreased when those securities have declined in value. So with this amendment, we will adopt the standards, the international standards of Basel III. We'll adopt the standards we already have for $700 billion plus banks. We'll adopt the standards that 1/3 of the banks between 100 and 700 billion have voluntarily adopted. And I'll point out this amendment deals only with banks over $100 billion. So 1/3 of that universe has already voluntarily adopted these standards. It's time to impose it on all, and I yield back.
Gentleman yields back. Is there further debate? Gentleman is from Kentucky. He's recognized to strike the last word
Strike the last
for 5
word.
minutes.
I appreciate my colleagues' attempt to improve the bill, to bring up an idea that's worthy of and merits deliberation and consideration, given the fact that accounting treatment of available for sale securities does get to the heart of what happened with Silicon Valley Bank and some of the other bank failures. But the amendment is really outside the scope of the bill. So what I would encourage my colleague to do is raise this in a separate piece of legislation. We could be happy to discuss it with the gentleman, and he's certainly free to introduce this at another time where we're actually having a conversation relevant to accounting treatment of available for sale securities. But this bill is not that. This bill before the committee today is about regulatory transparency and accountability. And so it just doesn't fit within the scope of this legislation. That's why I urge my colleagues to vote against the amendment. We can talk about the other comprehensive income, accumulated other comprehensive income at another time and in another bill, but it doesn't make sense in a regulatory transparency bill.
Will
So
the
I urge-
gentleman yield? I just want to
I
put
will.
on the record, we had requested of committee leadership that a freestanding bill on this very point be made in order for this markup. It was rejected. So I think this is a germane amendment. It does broaden the bill. If it's meritorious, please vote for it. I will yield back to you.
I'll reclaim my time, and I commit to working with the gentleman on future markups on this issue, which again, as I say, is worthy and meritorious of a conversation, but again, doesn't fit in this bill, which is a regulatory transparency bill. With that, I yield.
Gentleman yields back. Is there further debate? The chair recognizes the distinguished ranking member of the full committee. Mrs. Waters, strike the last word, 4 or 5 minutes.
I move to strike the last word. I support Representative Sherman's amendment, which would remove the ability of a large bank to decide on its own to not hold capital against the real value of the assets in its balance sheet. What became very clear following the failure of SVB Signature Bank and First Republic was that some banks were holding capital against assets on their balance sheet based on the value when they purchased it, failing to account for falling values as interest rates rose. Many of those assets were safe assets like Treasury securities or mortgages, but interest rate risk, which is among the ABCs of banking basics, was ignored at these banks, even though the Fed was very clear in signaling that it would continue to raise interest rates in the near term to deal with inflation and follow through on such intentions. These banks claim to hold capital against a pretend value of the assets. The problem with allowing the banks to opt out of raising capital is that the bank executives have no incentive to hold high levels of capital. Their own compensation is derived from the stock of the bank, and if they're suddenly required to issue more stock, it can lower the executive's compensation and net worth. Now, we've seen yet again what happens when banks are given discretion over whether critical rules apply to them, and any institution over 100 billion has demonstrated that they do pose risk in our financial stability. For these reasons, I support the Sherman Amendment. Everyone should support this amendment. This became very obvious to everyone. There was a lot of discussion about this. Even, people on the opposite side of the aisle agreed with me at one point when I raised questions about the securities that had lost their value. And so there's no reason why we shouldn't all support the Sherman Amendment. And I just want to say that while we, sometimes get off in other directions when we have the challenge of dealing with something as serious as we've experienced recently, the failure of these banks, we should not hesitate to correct the problems that we have witnessed, that we have seen, that everybody understands played a role in the failure of these banks. If we don't do this, one would question, why is it we are not tackling what is so obvious? And so with that, I would ask everyone to support this amendment. It makes good sense. We know that it is needed. And I will yield back to Mr. Sherman if he would like to try and convince, that we could find a way to take a standing loan bill out of what he's done and not make the commitment to deal with it down the road somewhere.
Will the gentleman yield for a question to the sponsor of the amendment?
It's my time.
Oh.
Do you want me to yield?
Yield to the gentleman so I could see if I could ask a question?
Does the gentleman
I'm
wish
happy,
me to yield to him?
Yes, if the
Then I
gentlelady
yield
has
to the
yielded to me,
gentleman
I will
from
yield to the
California.
gentleman for a question.
Real quick question. My understanding is that the AOCI accounting treatment is within the discretion of the regulators under existing law for those institutions with in excess of 100 billion in assets. Is that the gentleman's understanding? And they have not elected to
I know that they don't actually do it, and if it's in their discretion, I could send them a letter asking them to do it. They have a shredding machine over there, and so I think it's incumbent upon us to pass this legislation and make them do it. because I think the gentleman has recognized it's meritorious, and hopefully we won't stand on whether it should be done today or tomorrow in this bill or that bill. I hope to have his support.
Reclaiming my time, I thank the gentleman from California for further explaining how this could be handled and not rely on those people you don't trust over there, the regulators, to use their authority to do it instead of having legislation. With that, I yield back my time.
The gentlewoman yields back. Is there further debate? The gentleman from Missouri is recognized to strike the last word for 5 minutes.
Last word. Thank you, Mr. Chairman. This has got some interesting potential here from my standpoint, and I just kind of like to engage the sponsor with a little colloquy here if I can. So we're doing this only on securities that are held for sale, right?
Yes. I've thought of less modest versions of this and decided to go with the most modest version.
Okay. Do we not right now accrue interest on those whenever you show your account, whenever you do your balance sheet? Do you not show the accrued interest on those securities?
Well, all interest earned is income. When you receive that interest in cash, it's part of the cash balance of the bank. But what isn't shown is the unrealized. So you may have invested in say a 10-year 2% bond. The day, on December 30th, if you're on a December 30th, 31st year, you may get an interest payment. That interest payment is one of the assets of the bank. But 2/3 of these medium-sized banks will list that bond at their acquisition cost. You and I know that in today's world, a 2% 30-year bond is worth an awful lot less. And so if it's being held for sale, that loss would be subtracted from the bank's other capital to determine the amount of capital that it has available to absorb other losses.
I'm going to get to the loss in a second, but you say here in your bill, all accumulated other comprehensive income components. So my initial question is, if you're on accrual accounting, would you not already have that interest in your income account?
Accrual accounting, you would have on your balance sheet only the interest payments you received. The problem with a 30-year bond that's yielding 2% is that the interest rate payments you're going to receive over the next 30 years is only 2%.
Isn't interest receivable on your account?
Interest that has not accrued. So if you own a bond and you get your interest payment, say, on December 30th, and it's got another 20 years to run, you do not list the interest payments you're going to get over the next 20 or 30 years as an asset. You list...
That's not a receivable?
No, it's not a receivable because you haven't earned it yet. You earn interest by letting the borrower hold your money.
It's money, it's interest you're going to receive, is it not?
You're going to receive it.
So it's a receivable sitting on your assets.
The word receivable in accrual accounting means you've earned it.
You have earned it. You held it during a period of time.
If you loan me money for 30 years, and it's been 1 year, I owe you the interest for this year.
You owe it on a daily basis.
But we've got another 20 years to run.
We take that amount.
You do not list as an asset the interest you're going to earn over the next 20 or 30 years on a long-term bond.
Not on all at one time, but you do it on the daily basis that you accrue it. That's correct.
If you hold the bond for 30 years, then by the end of the 30 years, it will be accurately stated on your balance sheet, because at that point, you're going to get paid.
Okay. That's not, okay. The thing about the bill that's interesting here is that you would realize your loss, though. Is that correct? So whenever let's say a bank goes over the 100 billion threshold, suddenly now their bank would have to figure out what their loss is in their for sale securities. Mm-hmm. Is that correct?
So if you happen to have bought a bond for $10 million and it's only worth $8 million, you have $2 million less capital.
Okay, all right, that's, okay, I yield back.
We've exhausted that topic in an effective way. There further debate. The gentleman from Illinois, Dr. Foster, is recognized for 5 minutes to strike the last word.
Yeah, well, just to clarify, sort of part of the last debate, the way I understand it, is that you earn the interest payments only as you decide not to sell the bond. You know, that's when it shows up. Anyway, so a couple of points on this, that it was not just the available for sale securities, it's also the hold to maturity securities, and really the toxic mix of available for sale, hold to maturity, and uninsured deposits, all right? And that's what killed Silicon Valley Bank and put others at risk. And so that, I think that if we decide to legislate, which I hope won't be necessary, but that you really have to, there's a corner of behavior that involves both of those that are really the risky corner that we have to warn banks away from. And that's why I think it's something, you know, this has the germ of a good idea, and we have to think about how to better implement this. The other thing is that we've suffered in the case of Silicon Valley banks and similar sized banks, is that basically we ask the regulators for a tapered haircut, and we got a fade. For those of you who know what that means, when you just basically shave, you know, put a bowl on your head and shave everything below. Those apparently it's called a shade, or a fade rather. And so this is what we got. And there are ways that you can taper this. Just say as your size grows from 50 to $250 billion, that you have to realize an increasing percentage of the losses, for example. That would allow you to sort of smoothly transition into the situation that GSIBs are in right now. Anyway, that's...
Would the gentleman yield?
Yes.
Would the gentleman yield?
Yes.
I would add, as a practitioner in this business for 4 decades, to say that most bankers I know, I won't speak for every bank on the planet, but most bankers have everything available for sale now. And very few banks put a large portion, if any significant portion of their assets, their investment portfolio in hold to maturity. And in fact, that's one of the tremendous flaws in the Silicon Valley case study. So I just have to get that off my chest. Mr. Foster, I yield back to you.
Yeah, well, thank you. And, if both sides of the aisle are willing to entertain just abolishing the whole concept of held to maturity, and I'll yield.
Yeah, I just want to clarify. For generally accepted accounting purposes, these losses are already recorded. They are acknowledged in the footnotes. They're required they reduce capital when you compute it according to the International Basel III standards. They reduce capital when you're over $700 billion. They reduce capital if you're one of the 11 of the 34 medium-sized banks that has elected this. And so this is a modest proposal that says that which is already being done in many situations should be done here. And I yield back.
Yeah, and the other argument that's relevant in this debate is the counter-cyclical, the pro-cyclical nature of mark-to-market requirements, because that can get really grim in times of crisis. Thank you. Yield back.
The gentleman yields back. Is there further debate? If not, does the gentleman from Missouri insist on his point of order?
I withdraw my point of order.
Gentleman withdraws the point of order. If not, now the question occurs on the amendment offered by the gentleman from California, Mr. Sherman. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the affair of the chair, the nays have it. A request for a recorded vote has been requested. All those in favor of recorded vote, please raise your hands. A sufficient number having raised their hands, a recorded vote is ordered pursuant to Rule 3C5 of the committee rules. A vote on this question is postponed.
Yeah, I would ask to withdraw the request for a recorded vote.
Without objection, the request for a recorded vote has been declined. I thank the gentleman from California. For what purpose does the gentleman from Illinois, Mr. Caston, seek recognition?
Mr. Chairman, I have an amendment at the desk.
We will pause and let the amendment be distributed.
Mr. Chairman, I Reserve point of order.
The gentleman from Missouri reserves a point of order. The clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 3556.
Without objection, the amendment is considered as read. The gentleman from Illinois is recognized for 5 minutes on his amendment.
Thank you, Mr. Chairman. And I really want to commend the majority and staff for just an excellent set of hearings on the banks that were put together. I think we learned a tremendous amount about what happened. I think I will continue to have a friendly disagreement with Mr. Barr about whether the elements of this bill respond to those lessons, but I did want to take the opportunity to introduce an amendment to pick up, I think, a really important thing that we did learn, and specifically about the role that a chief risk officer plays at depository institutions. I'd remind my colleagues of just some of my notes from the meetings, the hearings we had. For most of 2022, from April until January of the following year, 8 months, Silicon Valley Bank did not have a chief risk officer. And we further learned, both from Mr. Becker and from Mr. Barr, Michael Barr, that is, that the chief risk officer post was vacant in part because the Federal Reserve, in conjunction with SVB's management, concluded that their existing chief risk officer did not have the experience necessary for a large financial institution. In the Federal Reserve's report on the failure of Silicon Valley Bank, they noted that the vacancy in a post like chief risk officer removes one layer of important internal oversight. And SVB being without a chief risk officer was technically a violation of regulations issued by the Fed pursuant to Section 165 of Dodd-Frank, and the Fed could have taken enforcement action against the bank for violating the rule, but the Fed report sort of noted that because supervisors decided not to issue the violation because SVB was actively looking for a replacement. Hindsight is 20/20, of course. And in my view, which I hope we'll all share, that was a really critical mistake that our regulators and the bank did make. There should be firm and immediate consequences triggered when a large bank, $50 billion or more in assets, doesn't have a CRO, and that is what this amendment would implement. This would codify Fed rules requiring that large banks have a chief risk officer and require a large bank to immediately notify their supervisors within 24 hours of the chief risk officer position being vacant. Further, it would say that within 7 days, the bank management would have to provide their regulator with a plan for how they intend to fill the position, and if the position remains unfilled after 60 days, the amendment would subject the bank to a cap on asset growth and other potential supervisory actions as appropriate to mitigate risk. Now, I do agree with Mr. Becker, who noted that it would take a long time to fill that position. They wanted to have a place, fine. But I think it's important for us to put some teeth in place so that we provide some incentives for banks in these circumstances that, given the choice between prioritizing the filling of a chief risk officer position and prioritizing growth that could potentially exacerbate depositor risk, broader systemic risk to our society, that they stay focused on what really matters. Finally, I just remind my colleagues that Silicon Valley Bank did not publicly disclose that they didn't have a risk officer until almost a year later in their 2023 proxy statement. So during that whole period of time, investors did not have this information. When I had asked Mr. Barr in this room why they didn't require that disclosure, he said, well, that's really more an obligation of the SEC. And so I think we've got to close that barn door. So this would further, the amendment would also require a bank to notify the public and their shareholders that the CRO position is vacant after 60 days. I think this is common sense. I would hope it's pretty bipartisan, certainly was a whole, and I would urge my colleagues to support. Yield back.
Gentleman from Illinois yields back. Is there further debate? The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes to strike the last word.
I strike the last word. I thank my friend from Illinois, I genuinely do, for raising this issue, because I think all members of this committee and the American people had a jaw-dropping experience after Silicon Valley Bank failed, when we heard that the bank didn't have a chief risk officer for as long as it did before the failure. And I think this is one of the examples of the mismanagement of the bank. It's also underscores the supervisory failures here. And again, this gets at why we need more transparency from regulators, and that's why we have this bill before us. And so I would urge my friend from Illinois to reconsider his opposition to the underlying legislation, given the fact that we don't have as much visibility into the regulators and what they're doing all the time, and the fact that they did not, as the gentleman acknowledges, did not take action on the vacancy, I think underscores the need for more regulator transparency. On the issue, on the merits of the bill itself, I'm open to a conversation with the gentleman about this idea for the very reasons I just outlined. Again, I don't think this bill is the right place for making these changes, because the bill is focused on transparency. But I invite the dialogue with him, because I think he makes some very good points about why we had a vacancy for this long. One counterpoint to consider here, and as I recall Mr. Becker's testimony in this room, he indicated that it was the rapid growth of the institution that precipitated the regulators to, in fact, prompt bank management to make the change. In other words, they didn't have confidence in the chief risk officer that they did have in place, so they removed that chief risk officer, but that they didn't fill that position for very long because the search was taking too long. So it was actually the regulators themselves that precipitated the vacancy, and then the search was a long search. I'm not defending Mr. Becker's or the management's decision-making here, but they said because the bank was growing so rapidly, they had trouble finding the talent that could take on those responsibilities. Not an exculpatory explanation necessarily, but the regulators seemed to prompt the change, and then the regulators didn't take action when there was a delay in the replacement, and bank management is making the excuse that we couldn't find the talent. So there's a lot going on there, and so we need to evaluate what is the right response to make sure we don't have this protracted vacancy in a chief risk officer. So I'm open to a conversation about it. I think we need to be deliberative about how we deal with a situation like this, especially in a rapidly growing bank, and make sure that they're not just filling the position with someone who doesn't have the expertise, because apparently that was the reason why they had the vacancy to begin with. And what I would worry about, if there is a worry with the gentleman's proposal, is that banks would be incented to just fill the position with someone who's not qualified.
Would the gentleman yield for a
I will.
response? So, I appreciate you said this bill is about transparency. There's not a lot more transparent than making sure you have a risk officer and disclosing that to the public. This is absolutely about transparency. To the point about growth, I guess I'd ask us not to be too precious about our role here. If any of us were in any entrepreneurial capacity and we said, we want to take on an order, but you don't have someone in your manufacturing shop who can actually build to the order, we'd say, well, put the brakes on. You can't actually grow until you have the ability to execute. What this is doing is saying, if you are growing at a rate that you are outgrowing the resources of your staff, as the Fed said, fine, go get a new person, but you can't continue to grow beyond the ability of your staff until you have those folks in place. If it takes you 2 weeks, 6 months, 2 years to find that person, let's not expose to systemic risk. And I would urge to include in this bill, because I don't want to be here 2 months from now facing the same problem where we said we knew what the problem was, we identified it, we had the chance to fix it, and we deferred.
Well, I'll reclaim my time and just say I appreciate the gentleman's points that he's making, and I commit to working with the gentleman and deliberating about what is the right response to this. And I take the gentleman's point about transparency to investors not being aware that this institution had a chief risk officer for 8 months, because I share the concern that this institution didn't have a chief risk officer for 6, but there are interests to be balanced here, and what we don't want as an unintended consequence of the gentleman's amendment is a rapidly growing bank filling a position of a critical position of a chief risk officer with someone who's not qualified just because of the gentleman's requirement. I yield.
Gentleman's time's expired. Further debate? Gentlewoman from California, the ranking member of the full committee, Mrs. Waters, recognized to strike the last word in 5 minutes.
I move to strike the last word. I support Representative Caston's important amendment, which would require large banks to immediately notify their federal regulator when the chief risk officer position becomes vacant, and to provide a plan to the regulator about how it intends to fill the position. This is very clean. This is very simple. It is something that both sides of the aisle have talked about, and we recognize that that was chief failure on the part of Silicon Valley Bank. As it has been explained by Mr. Caston, no decent business, let alone a bank, should be without understanding its risk and have that position filled so that they would not be in the situation that Silicon Bank found itself. Now, it's one thing for Mr. Barr to say he will talk with Mr. Caston. Mr. Caston doesn't need any talking to. He's got a bill. He's got the bill to deal with what happens when you don't have a risk officer. Mr. Barr said, and I'll work with you down the road here somewhere. He doesn't need that. I'll tell you what's unfolding here today. What's unfolding is we, on this side of the aisle, know what has gone on with these bank failures. We, even in talking with the opposite side of the aisle, have agreed of what happened with the failure of these banks. There is no good reason why Mr. Barr would be opposed to this very straightforward, simple legislation. No, I will not yield at this point. I'm on a roll. And so, what is unfolding here today is we are responding. We are dealing with those issues. We are saying we're not going to allow this country to experience these bank failures when we know what has gone wrong. We have the management at the banks who have accepted responsibility. We have regulators who have accepted responsibility. There's no reason why a bill as clearly written as Mr. Caston has represented here should not be supported, and particularly when it simply identifies a chief risk officer. This amendment also creates consequences for a bank that fails to hire a new CRO within 60 days of the initial vacancy, specifically subjecting that bank to a cap on further asset growth until that critical position is filled. This is clear. As a matter of fact, you mentioned that Silicon Valley grew too fast, and that was one of the problems. Now we're talking about, oh no, we're not going to allow you to continue to grow fast. We're going to put a cap on your asset growth until you get this chief officer in. No, I got to finish this. I please do. And so here we not only identify what is wrong and what should never exist in a bank the way it has existed in Silicon Valley Bank, but we're also going to penalize you in a way that you get it. I don't care how popular you are, bank. I don't care how you're the go-to bank for, these small businesses that need funds, need loans, et cetera. We won't let you grow your assets unless you fill this position. One of the concerns we heard from members on both sides of the aisle last week when the CEO of Silicon Valley Bank was before our committee was that Silicon Valley Bank did not have a CRO for several months in the lead up to the bank's failure. It is unbelievable that a large financial institution can remain operating in safe and sound manner without a CRO for an extended period of time. I've also heard shared concerns from members on both sides of the aisle that regulators were not escalating penalties as part of their supervisory process. So this amendment would ensure penalties would automatically take effect when there's a vacancy for the chief risk officer position. We also know how dangerous the rapid growth that these banks experienced contributed to their failure. So I don't know how you get away with this one. It's too clear.
The gentlewoman's time has expired.
And I yield back what time I don't have.
Gentleman yields back. I recognize the gentleman from Missouri, Mr. Luchtenmeyer, to strike the last word for 5 minutes.
Move strike last word. This bill is interesting in that it is trying to address a situation in this individual bank here, applied across the board to everybody. Don't disagree with that concept to a point. I think if we were listening to Mr. Becker indicated that he had a risk committee that the risk officer was over. So we had a committee in place, and we just didn't, the officer was not replaced. I think this bill, if you want to improve it, would request or require banks, once they hit 100 million or whatever, 50 million or whatever figure you chose here, to have a risk committee so that when the chief risk officer is replaced, retires, quits, whatever, that the committee is in place to then be able to take care of that situation, and somebody is there to be appointed as the acting risk officer until one is hired or this individual is promoted and hired in the full capacity. I think, I don't know if I was the only one that heard it, but I was listening to Mr. Becker very carefully the other day, and he indicated that they did have a committee and that the risk officer was in charge of that committee. So I think that there's a way to improve this bill. If you want to put in place or require, most banks already have this risk committee in place, but if require them to do that, that would be a way I think you could improve it. But I'll yield the balance of my time to Mr. Barr.
Well, I just wanted to ask the gentleman from Missouri, as a former banker and as a former bank regulator, a question based on your expertise. Does it concern you that the regulator itself, the San Francisco Federal Reserve itself, prompted the decision of bank management to make a change? Maybe that was appropriate, but then not having the wherewithal in the succeeding 8-9 months to be on top of the fact that they precipitated the removal of the chief risk officer and took no action to make sure that there was a prompt but also proper hiring of a replacement risk officer with talent that could take care of an institution of this rapidly growing size. I mean, what culpability does the regulator have in that situation?
Well, one of the things that a regulator always looks at is succession plans, succession for the management up top as well as all the way down the line. And I would have hoped that this regulator who requested that this this risk officer be replaced or somebody else be hired in his place would have understood that there had to have been in place a succession plan to allow for somebody capable and qualified to take that position before requesting him to be removed. Again, this points to the ineptness of the regulators, of the San Francisco Fed and all the folks who were involved in this, from the standpoint that they didn't have a succession plan in place for somebody in the risk committee to be able to take over this position. Management didn't see that it was worthwhile, and the regulator to request this without having a competent person and ready to go is remiss in his duties as well. If they were going to request the management of the CEO of this bank to be replaced, they should have always had in place a succession team, and that is one of the things that the regulators look for. Is a succession team, is there somebody ready to take over should something tragic happen or somebody change jobs or retire, whatever. So I think the regulators in this situation, again, dropped the ball. across the board on this thing. This is just another instance of why I think they dropped the ball. And with
Will the
that,
gentleman yield?
yeah, I'll be glad to yield to the chair.
Thank you. I yield to Mr. Caston. Mr. Caston, they're saying this is the regulator's fault. Can you respond to that?
So I guess I want to respond to a couple things here. Mr. Barr, you mentioned that we needed to think about some of the ancillary effects, and you talked about what Mr. Becker said, and I agree. Mr. Becker did say that he had a risk committee. He also said that he had no knowledge of interest rate risk prior to early 2023. If you'll pardon my French, that is a crappy risk committee.
That's why you have a committee of all the people in the bank to do this.
But further, you need to have a desk where the buck stops. And the buck was not stopping there. They did not have a good risk committee. Let's talk about the ancillary impacts of who benefited from the lack of that risk committee. Because Mr. Becker apparently didn't think it was
My time's
necessary
expired.
to disclose to the
The
public.
gentleman's
They had-
time from Missouri has expired.
Green from Texas, Mr. Chairman. Green from Texas.
Okay, we're going to Foster.
Green from Texas.
Is that okay? Gentleman from Texas, Mr. Green is recognized for 5 minutes to strike the last word.
I strike the last word and yield to Mr. Caston.
Thank you, Mr. Green. To finish the point, let's just talk about the ancillary impacts. Mr. Becker had a risk committee, did not see that it was necessary to disclose to his investors that he didn't have a fully functioning risk officer or a risk committee. Had he disclosed that, perhaps the equity price would have fallen. Perhaps that would have hurt Mr. Becker, who sold $3.4 million of equity shortly before the bank went down. That would have been an ancillary impact. Perhaps depositors might have been concerned as this bank was growing through those 8 months from 2022 and not have as many uninsured deposits at the bank that we all as taxpayers had to step in with the Fed and find some way to protect against that. Perhaps all the equity holders who got completely wiped out when the Fed stepped in to protect depositors but not protect equity, maybe they would have been protected in the same way the captain of that ship got a $3.4 million lifeboat and let everybody go down. I agree, there would have been some ancillary impacts if we required them to have a risk officer, required them to disclose to public, and required them to be transparent. And I think we should demand those ancillary impacts in our job to protect markets, protect investors, protect the stability of our financial systems. Thank you. I yield back to Mr. Green.
Gentleman yields back to Mr. Green. Mr. Green yields back, or you?
I yield back.
Mr. Green yields back. Recognize the gentleman from Texas, Mr. Williams, for 5 minutes to strike the last word.
Thank you, Mr. Chairman. I yield my time to Congressman Barr.
Well, I appreciate the gentleman from yielding. I don't have much more to say. I think we've beaten the proverbial dead horse on this. Just maybe it bears repeating that the testimony that we heard in this committee was that the regulator prompted the vacancy. The regulator was aware of the vacancy, whether it was disclosed to investors or not. And the regulator didn't take any action when the vacancy lingered. So to completely exonerate the San Francisco Fed here, I think is missing the point. I think we all recognize that an institution that's rapidly growing, that is of a large enough size and sophistication, needs a chief risk officer. But to just simply put a mechanical rule into place that might prompt a bank to comply with the mechanical rule and fill it with an unqualified person and not recognize the bank examiner's failure to take action to make sure that not only is there someone there besides maybe a committee that's not doing their job, but someone there who can have that buck stop with them, I think points to, once again, why the regulators need greater oversight and more transparency, which is why we shouldn't rush into this mechanical amendment and instead pass the underlying bill. And I yield.
Mr. Williams, Mr. Barr yields back to Mr. Williams. Mr. Williams, you yield back.
I yield my time back.
The gentleman from Texas yields back. And I recognize the gentleman from Illinois, Dr. Foster, for 5 minutes to strike the last word.
I'd like to point out just, there's a key element in this debate is who should be the judge of the competence of a prospective CRO. This bill suggests that maybe the investing public may be the best judge. There's an alternative, which is that the CRO be an accredited position. I think the banking industry may want to think about that suggestion so that you don't just promote the janitor or some celebrity to CRO just to check the box so that you can continue to grow or whatever limitations are put on when you don't have a competent CRO in place. I remember following the crisis, some of the GSIBs were bragging that their CRO actually had single-person veto power over any corporate decision, which I thought was an interesting policy to brag about. And at least that GSIB did not get in as much trouble as others had during the crisis. Anyway, I'd just like to point that out and put it into everyone's thinking. The possibility of accrediting, not only the chief risk officer, maybe some significant numbers of the risk committee, and perhaps even the CEO of a bank themselves, so you wouldn't have a bank CEO that was unaware of the concept of interest rate risk. Thank you. Yield back.
Gentleman from Illinois yields back. Recognize myself for 5 minutes to strike the last word. A couple of comments. We're talking about the vacancy in this chief risk officer, which was clearly one of the many management errors in the case of Silicon Valley Bank. But as we heard in our first testimony, when Michael Barr, Vice Chairman of the Fed, in questioning here before this committee, I asked him, when did you get confirmed in your job? And he told us. And then I asked him, well, who had your designated responsibility on behalf of the Fed before you were confirmed? And the answer was he couldn't, and he's never responded to me in writing. Here's my point. Dodd-Frank designated a vice chairman of the Fed for supervision to have this overarching responsibility to oversee the supervisors in these district banks, and it was vacant for 1 year. The whole time this was going on, that job was vacant, and more importantly, I think, the Fed didn't designate, well, Governor so-and-so is the acting vice chairman of supervision. So I think, to me, that's a real failure in either how Dodd-Frank was structured or how the Fed's internal procedures work on that job. So speaking of people who were vacant, we didn't have in the federal government a vice chair for supervision during this basically most important period. Second comment, leadership on investigating Silicon Valley's signature and what to do about this has been, I think, from the top with our ranking member Maxine Waters and our chair Patrick McHenry. And on these particular solutions that are being proposed as amendments, to some degree, I think many of them are premature, and let me say why, ranking member. And that's because of your letter signed with Patrick McHenry on March 17th to the GAO, asking them to assess these failures of supervision, accounting, treatment, and the like, and what they contributed, to this collapse, some of the topics we're talking about today. And so when we get that report to you and Chairman McHenry, I think it will put in perspective many of the topics that we're talking about today. And I'd ask to insert in the record the letter from McHenry Waters dated March 17th, 2023 to the Comptroller General of the United States General Government Accountability Office. Without objection, it will be included. And I yield back. May I yield time to the gentleman, Mr. Muser? Then I yield back. It was further debate. I recognize the gentleman from Pennsylvania for 5 minutes to strike the last word.
Thanks, Mr. Chairman. I just want to offer a couple of quick comments, and that is that clearly there should have been a risk officer, perhaps a team of them, or maybe one smart one that was doing their job. The CEO, his entire staff are certainly all culpable here, but they're all gone, and the bank is gone, but the regulators are still there. No one's been terminated. I don't even think anybody's necessarily been chastised. The stock losses are gone. So the regulators, all regulators in this situation should operate as if all large banks are poorly managed. That's the role of a regulator. So on top of that, why don't we interview the HR managers, the risk managers, the compliance managers, the presidents. Why don't we interview all of them? Have oversight on all that microness of businesses in general. Or we perform our oversight on the regulators, which is what our jurisdiction is. I yield back, Mr. Chairman.
Gentleman yields back. Is there any further debate? If not, does the gentleman from Ohio, Mr. Davidson, withdraw the point of order on this bill?
I do.
If not now, the question occurs on the amendment offered by the gentleman from Illinois, Mr. Caston. All those in favor of the amendment shall signify by saying aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. Recorded vote has been requested. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to Rule 3C5 of the committee rules, a vote on this question is postponed. For what purpose does the gentleman from California, Mr. Sherman, seek recognition?
I have an amendment at the desk.
We will pause and let that amendment be distributed. Gentleman from Ohio.
Sorry, out of sequence. Mr. Chairman, I'd like to reserve a point of order.
Say point of order. The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 3556.
Without objection, the amendment is considered read, and the gentleman from California is now recognized for 5 minutes to discuss his amendment.
And thank you, Mr. Chairman. I won't be requesting a recorded vote on this, although other members are free to do so. And I didn't request a recorded vote on my last amendment because I feel a little guilty taking up as much time as I have, with this being the second of my 3 amendments to this bill. The regulators are allowed in some cases and required in others to do stress tests. And for year after year, their stress tests have focused on credit risk and have ignored interest rate risk. There are 2 risks that you have when you make a loan. One is that the borrower won't pay you back on time. And that's well understood. That's what everybody thinks is the risk to watch out for. But there is an equally important risk, one that doomed 3 banks recently, and that is the interest rate risk. The borrower will pay you back on time, but you've agreed to a low interest rate, and by the time the bond matures, you may be in a high interest rate environment. So if you're locked in to a 2% bond that you're going to own for another 20 years, or and this is unusual, but a business loan of 20 years that's locked in at the same interest rate at 2%, and your depositors start insisting on a 4% or 5% return on their deposits, you have lost money just as much as if you had a portfolio of loans to Main Street businesses and some of them weren't paying you back. So what this bill requires is, if you're going to do a stress test, you don't just do the stress test for credit risk or for recession, because of course during a recession you have a higher credit risk because more of your borrowers can't pay you back. But in addition to stress testing for recession, you also stress test for interest rates going up or down. I think it's basic, if you're going to decide to do a stress test, that you look at both of these 2 risks. This bill would require that. You can say that the regulators should have picked interest rate risk as something to do a stress test for. Under the 2018 bill, we're now down to having, I believe, only 2 or 3 stress tests. This one says that in addition to those, you do one for interest rates going up and interest rates going down. And I regard it as a moral failing not to take my full 5 minutes, but I've said everything that should be said, so I yield back.
Would you yield?
I yield.
That way we can burn time together. Oh, good. I think you raise a good point, but I would make a couple of comments. One, every bank is required, no matter what size, whether it's a $31 million bank down in Bearden, Arkansas, or JP Morgan Chase, has an obligation to continuously monitor interest rate risk. It's one of the CAMEL's ratings. They added an S back in the 2000s, and the S stands for sensitivity for risk. And in that, you pay for a quarterly report of mark-to-market, all assets and liabilities, and look at a range of interest rate sensitivity, down 300 basis points, up 300 basis points, and that is at the heart of every board minutes, in that issue. So in the idea of stress testing, I think that's embedded. I'm real curious that you think that from the material you've studied, it's not. So
No,
I'm
the
asking
stress
my
tests
question.
that the regulators have done the last several years have been to look at the stress of a recession in the country, which is basically credit rate risk, and they did not do stress testing. I don't know what banks do voluntarily, internally, but this would require the regulators, when they're overseeing a stress test, to stress test for interest rate increases and even interest rate decreases.
I yield back to the gentleman. Thank you. Gentleman, and the gentleman yields back. Is there further debate? The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Move to strike the last word. I appreciate the gentleman's amendment, the author of the amendment, because, in the spirit of his amendment, because it correctly points out that credit risk isn't the only risk, and that interest rate risk was missed here. Once again, highlighting the need for the underlying legislation, more transparency and accountability for the regulators who missed it. There's other risks that the author of the amendment doesn't mention. Operational risk. There are disparities in the manner in which banks of the same size operate differently, and credit risk is part of that, interest rate is part of that. There are other risks that the regulators should be monitoring. But I am concerned that being overly prescriptive in the elements of a stress test could actually continue to create the problem that we had with the regulators in the instance of these bank failures. When Congress is prescriptive and asks the bank regulators to conform to a template, we're actually missing the whole point, which is that while Dodd-Frank granted the authority to regulators to set the parameters of stress tests, the idea was to ensure that those stress tests are forward-looking and not just fighting the last battle. So my legislation allows the regulators to retain their authority to set stress test scenarios based on both current and future economic conditions. It also, though, ensures that Congress remains informed of their activities. And I think the big problem here is that Congress has not been informed of their activities, and had we been informed, we might have greater visibility in the fact that these stress tests were not monitoring interest rate sensitivity. So we're seeking transparency and accountability in this legislation for what's done. We're not seeking to micromanage or direct all elements of what the regulators need to be done, but the author of the legislation is right, that the regulators missed it, and that they were focused on, maybe excessively focused on credit risk, and not honing in on interest rate risk. But
will the gentleman yield?
Yeah, I will, but in just a minute. Just to conclude, my point is, we're not trying to be overly prescriptive. We're trying to make sure that the regulators are not directed by Congress into the last battle. We want them to be future and forward-looking as well. And I yield to the author.
This is not the Internal Revenue Code. This is a one-page amendment. It does not overly prescribe. It gives the regulators tremendous leeway. It simply says you don't just look at adverse economic conditions, AKA recession. You also look at interest rate changes. Exactly how they do that, they're free to determine. And it does not prevent us from looking at what might be some other adverse circumstance. It adds to the stress tests. It does subtracts nothing. So it's not overly prescriptive. It doesn't focus our attention on just interest rate risk to the exclusion of something else. And I hope to have the gentleman's support.
I'll reclaim my time and just conclude really quickly that it didn't take Dodd-Frank to have regulators be sensitive and mindful of interest rate risk. Interest rate risk has been around in the business of banking for a long, long time. And before Dodd-Frank and before S2155 and before this saga of Silicon Valley Bank, interest rate risk was a basic job of bank management and bank supervision. So the idea that we have to prescriptively ask bank regulators to do this it just seems to me not necessary. I yield.
Gentleman from Kentucky yields back. Is there further debate? If not, does the gentleman from...
Withdraw point of order.
The gentleman from Ohio withdraws the point of order. If not, the question now occurs on the amendment offered by the gentleman from California, Mr. Sherman. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the nays have it.
I know, but
For what purpose does the gentleman from California seek recognition?
I rise to say that I will not be introducing the third amendment since it is a third attempt to focus regulatory action on interest rate risk, and I've already had two of those, and I realize that the hour is late. I yield back.
I thank the gentleman from California and thank his keen interest and good discussion on interest rate sensitivity. And is there gentlemen, a further debate? Is there a further amendment?
It's Green from Texas, Mr. Chairman.
Mr. Green from Texas, you have an amendment, Mr. Green?
I have an amendment at the desk.
Mr. Green has an amendment at the desk. If you'll
Mr. Chairman,
pause, we'll
I
let the
reserve-
clerk report the amendment. And
Chairman, I reserve a point of order.
And Mr. Davidson from Ohio reserves a point of order. Clerk will report the amendment.
Amendment to the amendment in the nature
I
of a
ask that the amendment be considered as read, Mr. Chairman.
Without objection, gentleman is recognized for 5 minutes to discuss his amendment.
Thank you, Mr. Chairman. Mr. Chairman, my friend, Mr. Barr's Increasing Financial Regulatory Accountability and Transparency Act places some burdensome reporting requirements on financial regulators, hampering their ability to effectively carry out their authorities in the fog of an emergency. Provisions in Mr. Barr's legislation would make it harder for regulators to use emergency authorities. Let me pause for just a moment and accentuate the word emergency, which means unforeseen an unforeseen combination of circumstances that call for immediate action. An emergency. Use the emergency authorities that were effectively utilized to prevent widespread financial contagion during the bank failures this year. I would add that if not but for the president, the ranking member, and appropriate authorities acting quickly and efficaciously, contagion could have spread. And we might be dealing with many more banks than the few that we've had to contend with. My amendment would require that regulators involved in the resolution of a failed financial institution following a systemic risk exception being declared submit reports to Congress within 60 days of the declaration. My amendment would also require a more comprehensive report to be published 6 months after the systemic risk exception was invoked, detailing any mismanagement by executives and board of the insured depository institution, detailing supervisory shortcomings by regulators, and detailing other dynamics that may have contributed to the failure of the institution. I am not totally antithetical to Mr. Barr's legislation. I do believe, however, that his timelines do not account for the fog of an emergency. His timelines are 3 days and 30 days. I believe that this could prove to be an impediment for those who have their hands on the emergency, those who literally are about the business of preventing contagion, those who have to work around the clock sometimes to get these things resolved. I've been here when we had emergencies to contend with. I was here in '08. I saw how quickly these things have to be embraced and dealt with. So I think that the federal regulators in the resolution of Silicon Valley Bank, and Signature Bank, they've been forthcoming with their reports thus far, and my amendment would codify this level of transparency, put it into law. This level of transparency, I believe, properly codified, can serve not only the regulators well, but also the Congress well. The unfortunate circumstance is that we don't want to overburden regulators at a time when they are dealing with something that, quite frankly, is unpredictable or was not predictable, possibly, and they're trying to resolve it. So again, I thank the president, thank the ranking member, and all of those persons who had a hands-on experience with preventing this contagion that could easily have taken place. Finally, this, much has been said about the debt limit today. I have to address this. The debt limit capitulation bill that my colleagues put forth was a capitulation bill. Closed rule, take it or leave it. I decided to leave it with them. It's their bill. They wanted capitulation. Negotiation requires cooperation. Capitulation requires surrender. That was a surrender bill. I don't think that we should surrender if cooperation is the order of the day, and it was. We should have cooperated. We should have had amendments. I recall when my colleagues, I'll yield back and take this up at a later time. Thank you, Mr.
The gentleman has yielded back. Recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes to strike the last word.
I strike the last word, and I thank my friend from Texas for his attempt to improve this bill. And I also appreciate his desire to have the GAO take a look at this. I want to rebut the gentleman's characterization of our legislation once again as hampering regulators. And let me emphasize this for all members. The bill, the underlying legislation, does not repeal any emergency authorities of either the FDIC or the Federal Reserve. The systemic risk exception remains. There's nothing in this legislation that repeals or impedes the ability of the FDIC to invoke the systemic risk exception. The Federal Reserve's emergency lending authorities under 13.3 are unimpeded. There is nothing in this legislation that removes that emergency lending authority. Now, there have been bills in the past that Congress has considered that would require congressional pre-approval, or not pre-approval, but authorization, and this bill doesn't actually do that either. There's nothing in this bill that repeals FSOC's authority to do its job, which is to look at emerging threats to the financial system and financial stability. There's nothing in this bill that limits or impedes the FDIC or the Fed's supervisory powers. There's nothing in here that limits or prohibits the ability of the regulators to issue matters requiring attention or matters requiring immediate attention. There's nothing in here that precludes the Fed from issuing supervision or regulatory letters. There's nothing in here that prevents the regulators from taking enforcement actions. So the idea that this underlying legislation, quote unquote, hampers regulators is just false. With respect to the amendment itself and the GAO idea, the analysis called for by the amendment has actually already been requested of the GAO, and it was requested on a bipartisan basis in a March 17th, 2023 letter sent by Ranking Member Waters and Chairman McHenry. So it's premature to include the amendment since the analysis called for has been already requested of the GAO, and we're awaiting the results of their full analysis. They've given us a preliminary report, but they haven't completed their review. And in fact, we had a hearing in the Oversight and Investigation Subcommittee where members on both sides of the aisle were able to quiz the preliminary findings, but the GAO communicated very clearly that there's more work to be done in that Oversight Subcommittee hearing. So once the analysis has been completed and we become fully informed, I would be happy to work with the other side on further enhancements to provide accountability and transparency from our opaque financial regulators. The analysis called for in the amendment has been requested already in a letter from both sides of the aisle of this committee, and the analysis is already underway by an independent, nonpartisan agency and analysts, and therefore I urge my colleagues to vote against this unnecessary amendment.
Would the gentleman yield the additional time?
I'll yield.
Thank you. I do appreciate it, and I'll reciprocate at some point in the future, I'm sure. But you have made the case for the amendment because the amendment codifies what was requested by the chair and the ranking member. It then requires this to be done such that we don't have to immediately dispatch a request to the GAO. It does not harm the system to have the GAO do what is being required because we've demonstrated that it's needed. It just seems to me that this common sense, sensible amendment, do no harm amendment is something that could be embraced without reservation or hesitation.
If I may reclaim my time, yes. I love this moment in this committee because we're in radical agreement here. We all want the GAO to do the work. We've already requested it. The work is underway. I commit to working with the gentleman. If the GAO doesn't respond and doesn't complete its work, I'll work with the gentleman, make sure they do complete the work. But I think Ranking Member Waters, working with Chairman McHenry, you and I, the chairman of the O&I subcommittee, Mr. Heising, has already done one hearing. I'm sure he's going to do more. I think we're all in radical agreement that this is already underway. The one point I do want to emphasize before I yield is that the underlying legislation doesn't hamper the regulators, and I yield back.
Gentleman yields back. The chair recognizes the ranking member of the full committee, Mrs. Waters of California, for 5 minutes to strike the last word.
Thank you very much. While my Republican colleagues tout the underlying bill as a transparency bill, they neglect to highlight the various ways the bill would limit a variety of key tools to address systemic risk and promote financial stability. They also don't give credit where credit is due. specifically with respect to the FDIC, the Fed, and state banking regulators for producing extensive reports with confidential supervisory information relating to these banks. This transparency and quick work should be celebrated, not denigrated. For my colleagues who were not here during the 2007-2008 financial crisis, this committee and the public had to wait years and conduct its own investigations to learn what happened under the Bush administration. Thankfully, Biden's regulations have a new standard for quickly sharing what happened following a major bank failure, and we should ensure this kind of transparency continues. So Representative Green's amendment would codify the types of regulator and expanded GAO reports that we've received and the time frame we've received them when a systemic risk exception is used. And so we have heard today all kinds of excuses why the members on the opposite side of the aisle cannot use their power and their influence to do some of the corrections that are needed in order to avoid future bank failures. We have produced our amendments. We have talked about very key issues, some of which we have had conversations with each other about. But all of a sudden today, everything is being resisted. Everything is being denied. There is an excuse for every amendment that we have brought up and every attempt that we have made to correct some of the problems that are so obvious with our banks. And so, let me Mr. Barr left? Oh, well, he just stepped out. I wanted to yield to him because I have a question, but, you know, is he coming back? We can pause the time. Thank you. Thank you very much.
Put it 2:12.
Okay, thank you. Thank you. Okay. You want to keep going? Okay. I will just.
Please.
Thank you very much for the attempt to allow me to ask the question. Mr. Barr has not returned right away, but I'll continue and share it with you. I was going to yield to him to respond to a question. And the question was, you claim that regulators have not provided any information to the committee and that they are opaque. But do you know how many pages of documents the FDIC has provided to the committee? He's not here to answer the question, so I'll answer it for him. They have provided more than 4,000 pages of agency documents in 7 separate productions, and they have further provided our committee with access to an additional 46,000 pages of records. So the facts belie the assertions that you are making that the regulators have not been forthcoming to our document requests, and they have been very transparent throughout this process. So I'm glad that they have, and they have helped to identify shortcomings that committee Democrats will try to address with our amendments today. So,
Yield?
yes.
I thank the gentleman for raising these points and for the constructive amendments. And I think Chairman McHenry and you have both been complimentary of the immediate responsiveness by the FDIC and the Federal Reserve particularly to take responsibility, issue interim reports, and be responsive to many of our document requests, some of which I think are still outstanding. But I would say this, I think House Republicans on this side of the aisle don't want to be a ready, fire, aim situation. We want to get the GAO report back. We want to have the rest of any hearings that we might have in the Oversight Committee or the Financial Institutions Committee. Mr. Barr is back.
Reclaiming my time.
Yeah.
Let me just finish this without Mr. Barr. I respect what you just said, but this ready, fire, shoot analogy that you're given about what you don't want to do just doesn't ring right. It doesn't ring right because we have a crisis that we are experiencing, that we have experienced, and we need to be quick on the draw in order to deal with some of these issues that we can take care of now. You're right, Mr. McHenry and I are working together, but Mr. Barr doesn't seem to follow our lead in what we're trying to do today in working with us. And so I had to share that, and I'm so sorry Mr. Barr was not here, but I'll get you at another time.
Gentleman yields back. I recognize the gentleman from New York, Mr. Lawler, for 5 minutes to strike the last word.
Thank you, Mr. Chairman. I yield to Mr. Barr.
Well, thanks for my friend from New York yielding, and I'm sorry I missed the exchange, so I don't know what I missed necessarily. It sounds like it was fun, but if we're still talking about the GAO issue, I mean, we're in agreement. I don't understand why we need an amendment on a request from the GAO that the GAO review this, and they're doing it, and we were having oversight hearings, and they've given us a preliminary report, and they are still doing their work to complete the report. It's a bipartisan request from the chairman, the ranking member, the chairman of the Oversight Subcommittee and the ranking member of the Oversight Committee have had a hearing. I don't know what the concern is. Is the concern that the GAO is not going to fulfill the request? Because if that's the concern, I think all members here, having agreed with one another that this is the right thing for the GAO to do an independent, nonpartisan report, I think we'll all join in and request the GAO to complete their work. So again, this is superfluous, it's unnecessary, we're all on the same page. I don't know why we're disagreeing about the fact that we're all in agreement. I yield.
Gentleman yields back. Is there any further debate?
I yield back.
Is there any further debate?
I would like to be recognized to yield to Mr. Green.
You've been recognized.
Someone else.
Mr. Green's been recognized. Mr. Foster's been recognized. Is he?
Recognizing.
The gentleman from Colorado is recognized to strike the last word for 5 minutes.
Thanks, Mr. Chairman and staff for your support. I yield.
Thank you.
Mr. Green,
Thank you.
and continued support.
Very kind of you. Thank you very much. Mr. Chairman, this, and to my friend Mr. Barr, this codification is necessary such that when we go forward, we won't have to make the request. There's a lot of consternation that's been expressed by my friends on the other side with reference to GAO and other entities in terms of how well they perform. This eliminates the necessity to anticipate performance or to have to develop a request for performance. It's really a common sense measure because this is what the ranking member and the chair have already done. We're just talking about now as we move to the future. And getting studies are great things. I think that we just required GAO to do a study pursuant to some legislation that was passed. Would you?
Will the gentleman yield real quick?
Of course I will.
To the point that he's making. It's a good point, and I think, let me be a little bit more precise in my response to the amendment. It's already in the law. In fact, one of our problems with the Fed and the FDIC launching forward with a self-assessment before the GAO did their study was that that's in existing law. The GAO, whenever there is an invocation of emergency powers, whether it's 13.3 at the Fed or the emergency risk exception, they're already required to do the report.
I'll yield back to you in just a moment, but reclaiming my time for a moment. The request that was made by the chair and the ranking member, that request is not codified in the law. That's what we're talking about.
Would the gentleman yield?
Of course.
So again, my understanding of the law that predates Silicon Valley and all of this is that the GAO is, whenever there's a systemic risk exception that's invoked, whenever there's 13.3 authorities invoked, the GAO is automatically, in existing law, triggered and required to actually do this report. So I'm struggling to understand what the need is for this amendment.
Well, if the gentleman would allow me to respond, I would reclaim my time. The timelines with the level of specificity that the ranking member and the chair placed in their request is not in the law. That's the thing that's important, to have them statutorily required to do something within a statutory period. That's not in the law, and that's common sense. That's why they did it.
Would the gentleman yield again?
Of course I would.
So look, I mean, I'm not going to quarrel with you on the timeline, but here's what I would say is, if the gentleman wants a timeline, I think he should be equally upset that the agencies that they're reviewing jumped the gun and tried to get ahead of them and set their own narrative before the GAO could conduct its independent review of those regulatory failures.
Reclaiming my time for just a moment. I appreciate the attempt at a distraction, but I'm not going to be distracted by something that's not at hand, not an issue that's currently before us. Let's debate that at a later time. The question is, do we want to take this common sense approach that has already been implemented by the chair and the ranking member? Do we want to codify it? It's not going to hurt, and it can certainly help.
Does the gentleman yield to the gentlewoman from Colorado?
Yeah, I yield back
yield.
to the gentlelady.
The gentlewoman from Colorado, are you yielding back?
Yield back.
Gentleman yields back. Is there any further debate? If not, the gentleman from Ohio, do you insist on your point of order?
I withdraw my point of order.
If not, the gentleman, question now occurs on the amendment offered by the gentleman from Texas, Mr. Green. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair,
Recorded vote.
a recorded vote has been requested. All those in favor of a recorded vote, please raise your hands. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to Rule 3, C5 of the committee rules, a vote on this question is postponed. For what purposes does the gentlewoman from Colorado seek recognition?
Thank you, Mr. Chairman. I have an amendment at the desk.
We will pause while that amendment is distributed.
Mr. Chairman, I reserve a point of order. Have all members received the amendment? The clerk will report the amendment.
Amendment to the amendment in the nature
Without
of
objection, the
substitute.
amendment is considered as read. The gentlewoman from Colorado is recognized for 5 minutes to speak on her amendment.
Thank you, Mr. Chairman. First, I would request unanimous consent to add my name because it looks like it's not on the amendment.
Without objection.
Thank you, Mr. Chairman. Over the past several months, our committee has held 5 hearings evaluating the recent failures of Silicon Valley Bank and Signature Bank, as well as First Republic Bank. Just last week, our committee had the regulators before the full committee for a second time. And there was also a joint subcommittee hearing with the state banking regulators and the former executives of those 3 regional banks. One of the biggest shocks and frustrations that I had listening to testimony and reading reports from the regulators and news reports was exponentially larger bonuses being paid to banking executives in the years leading up to the collapse of their respective financial institutions. While their institutions were being mismanaged and had received a total of 30 citations, including numerous MRIAs. For example, from 2018 to this year, when the bank failed, SVB's supervisors issued a steady stream of supervisory citations finding serious weaknesses in how the bank was being managed that went unaddressed. However, SVB CEO simultaneously received increasingly larger cash bonuses. The CEO received a cash bonus of $3 million in just 2021, which was double the amount he received in 2017. Had the CEO's bonus payments been at risk when his bank was being issued warnings like MRIAs, it is entirely possible that we could have behaved differently and addressed those shortcomings more swiftly, maybe even avoided the collapse. My complaint is not with executive compensation and bonuses broadly. However, in every failed bank that this committee has examined, it's clear that these executives have failed to prudently manage their bank's risks, ultimately putting depositors, the bank's employees, and even our entire financial system at risk. So my amendment is simple. Should any large bank with more than $50 billion in assets be assessed with a matter requiring immediate attention or a similar supervisory notice, that bank cannot make any discretionary bonus payments to any senior executive officer until the matter is resolved. This type of consequence is not new and one that large banks should be familiar with, as it is structured in a similar manner to how discretionary bonus payments are automatically restricted when a bank fails key capital requirements. I heard members on both sides of the aisle ask why regulators did not escalate penalties quickly enough. My amendment is a common sense way of doing that by incentivizing bank executives to take those supervisory warnings seriously and resolve them quickly. I urge members to support this amendment, and I yield back.
For what purpose does the gentleman from New York, Mr. Lawler, seek recognition?
Strike the last word.
The gentleman is recognized for 5 minutes to strike the last word.
This amendment would decrease clarity and certainty in the examination process. By freezing executive pay for any supervisory action, executives will have strong incentives to seek judicial review of examination findings, and this could result in needless litigation and delay in ensuring the bank's focus on remediating findings rather than litigating when an executive can be paid. Courts may have concerns that this restriction on bonus pay fails to provide executives with meaningful due process. And while the Regal Act allows banks to appeal their exam findings to their banking agency, all require that the senior management team or board of directors of the bank seek review, not a single executive. In addition, it is unclear whether covered banking institutions under the amendment would include federal savings associations, some of which would otherwise be covered by the asset threshold. And so with that in mind, I urge my colleagues to vote against this amendment, and I would yield the remainder of my time to Mr. Barr.
I appreciate the gentleman yielding, and I'll just reiterate what the gentleman said in his arguments against the amendment, and I I do likewise oppose the amendment. The matter requiring immediate attention shouldn't require threats to single executives. The idea behind these supervisory actions should be that the banking organization and all of their management team, not just certain individuals who are isolated, but all of them take action. And I think going after kind of executive compensation is an attempt to distract from the real issue here, and that is supervisory failures. The supervisors don't need these threats to actually do their job. The supervisory team, to exonerate them for failing to do their job and pointing to some shiny object, playing class warfare or other things, is really not the problem here. The problem here is that the San Francisco Fed failed to do their job. That's why we don't need this amendment, and I yield back.
Does the gentleman from New York yield? I thank the gentleman. For what purpose does the gentlewoman from California, the ranking member, Ms. Waters, seek recognition?
Thank you very much. I move to strike the last word.
Gentlelady is recognized to strike the last word for 5 minutes.
I support Representative Patterson's amendment, which would provide real consequences for bank executives who do a poor job of responding to issues like risk management concerns that are raised by bank supervisors. Specifically, it would automatically restrict bonuses to executives when their bank has been cited with a matter requiring immediate attention or other serious supervisory citation. Last week, I heard members on both sides of the aisle grill the CEOs and executives of Silicon Valley, Signature, and First Republic banks about their irresponsible management practices. According to the Fed's report on the factors contributing to the bank's failure, as well as the performance of its own supervisors, federal regulators had cited Silicon Valley Bank with several supervisory citations requiring attention and immediate action just before it failed. At the hearing last week, we heard Silicon Valley Bank's CEO diminish the urgency of these matters requiring the bank's attention and immediate action, calling them, quote, feedback and comments like, unquote. Representative Patterson's amendment is a reasonable attempt to crack down on repeated inaction by banks. This reminds me of the investigation this committee did under my leadership as chair of Wells Fargo. Our investigation found that the megabank was slow to respond to numerous supervisory citations or never addressed them at all. This was unacceptable on top of the bank's repeated abuses, instances of consumer harm and flagrant violation of the law. This kind of amendment would have ensured Wells Fargo executives were not awarded with bonus payments while their bank continued to break the law, harming millions of consumers and operating in an unsafe and unsound manner. Members, you know, we either have a willingness to deal with these bank failures and to do everything possible to keep them from occurring in the future. And it is not understandable to have the kind of amendments that the members on this side of the aisle have been introducing today, and they have been ignored. There are no real substantive excuses for why we're not getting the support to deal with these failures in the ways that the opposite side of the aisle claims they want them to be dealt with. What's stopping them? You know what's stopping them? They don't have the will to confront these issues and get tough on these banks who are putting our constituents at risk. They don't have the will to look these bank executives in the eye and talk about bonuses and salaries and all that we're learning about maybe how some of their investments have been protected. Well, I'm so pleased with the members on this side of the aisle for taking on these issues, not just talking about them or promising to do something in the future. It's time to do it now. There are no reasons why. Many of these issues that we have identified today are not readily embraced by the opposite side of the aisle. I could mention not only the interest discussion that we had on, what was happening with inflation that they claim that they're concerned about, the chief risk officer that is so plain and simple to understand, or a willingness to say, we're not going to let you earn money or get money or be given money in bonuses if you're not, complying with the law. And so I can't help but say I'm disappointed. I'm disappointed because we're willing to do it over here. We're willing to do this work. We're not afraid of the executives. We're not afraid of criticism from the industry. We're not afraid of any of that. We're taking them on. And so I'd like to thank Ms. Patterson for this very sensible amendment that would simply deny bonuses. We shouldn't be rewarding people for bad work. With that, I yield back the balance of my time.
Is there further debate? If not, does the gentleman from New York insist on his point of order?
No, I withdraw my point of order.
If not, the question now occurs on the amendment offered by the gentlelady from Colorado, Ms. Pedersen. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the nays have it.
Recorded vote is requested.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand. A significant number having raised their hands, a recorded vote is ordered pursuant to Rule 3C5 of the committee rules. A vote on this question is postponed. For what purpose does the gentlelady from California, Ms. Waters, seek recognition?
Thank you, I have an amendment at the desk.
Clerk will distribute the amendment.
Mr. Chairman, I reserve a point of order.
So, point of order is reserved. Have all members received a copy of the amendment? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute.
Without objection, the amendment is considered as read. The gentlewoman from California is recognized for her amendment.
Thank you very much, Mr. Davidson. My amendment would strengthen the FDIC's toolkit to ensure executives of failed banks are held accountable if they are negligent or otherwise culpable for driving their banks into the ground and putting their depositors and possibly the broader banking system at risk. Ladies and gentlemen, this is where the rubber meets the road. This is where one can decide whether or not you're serious or you're just talking. This amendment is one that puts you right in front of this issue and decide which way you're going to go. Are you going to be with the bank executives or are you going to be with the people? Are you going to be with your constituents? And so, specifically, my amendment makes the following 3 reforms. First, it would give the FDIC the same clawback authority for failed banks that it has for other large financial institutions that are resolved through orderly liquidation authority under Title II of Dodd-Frank. This would allow the FDIC to claw back compensation, money, That's what we're talking about. Like the large stock sales we saw from some executives in the weeks before they drove their banks into a ditch. I know that no legislator would resist this kind of punishment for executives that just absolutely undermine the very people that they're supposed to be representing and taking care of. Second, the amendment would strengthen the FDIC's ability to bar executives of a failed bank from holding jobs in the industry going forward. Regulators already have this tool for other circumstances, and it seems reasonable to apply it to circumstances where executives that mismanage their institutions and potentially put the broader banking system at risk. Third, the amendment would expand FDIC's ability to fine executives of failed banks for their misdeeds when their actions contribute to the failure of the firm. Again, these are existing tools we would be we would be expanding to bank failures to promote executive accountability. These are sensible reforms modeled after existing law that the administration has called for to promote bank executives' accountability. A few Republicans have joined with Democrats to work on similar types of accountability measures in the Senate, and I hope House Republicans will seriously consider working with us on these issues too by supporting my amendment. This amendment should not come as any surprise to them, as my staff shared similar legislation with Chair McHenry's staff last week to try to have it considered at this markup. Now, I know Republicans are primarily focusing on bank regulators appointed by Biden, but I have to believe that there is plenty of blame to go around for what went wrong. If we want to promote a safe and sound banking system that has strong regional banks, then we have a few things to fix. If you believe that supervisors did not act forcibly enough, and I believe we all agree, then you must concede the bank was being mismanaged to begin with. After all, supervisors cannot take enforcement actions unless laws and regulations are broken, which clearly was the case with these banks that were not operating in a safe and sound condition. And so, moreover, while Republicans focus on supervision, their own witnesses have highlighted that there are regulatory improvements that must be made. So at the very least, I hope members on both sides of the aisle will give this amendment a close look and support it to hold executives accountable for their action. Like I said, this is where the rubber meets the road. You either are in favor of putting these banks in place the way that they should be and punishing them, penalizing them, or you're not. And so let's see where you are. I yield back the balance of my time.
For what purpose does the gentleman from Kentucky, Mr. Barr, seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I oppose the amendment, and the ranking member and the author of the amendment argues in favor of enlarging the toolkit. I think I quoted her correctly, enlarging the toolkit for the FDIC. The problem is that the FDIC has a toolkit already, and when they don't use the tools that already exist, why do you think giving them more tools would help? But I think the more fundamental point is that Section 104 of the amendment doesn't accomplish what the ranking member actually seeks to accomplish. While the amendment would lower the mens rea standard for prohibiting failed bank executives from the banking industry, it would actually increase the conduct standard. So let me explain that. Existing law requires that only an executive participate in an unsafe or unsound practice or, quote, directly or indirectly violated any law. This amendment would actually require that the executive cause the financial loss, which is a higher standard. So I think the ranking member is unwittingly making it easier on the executives here, or changing the law to go easier on the executives. Indeed, under current law, an executive can be prohibited from the banking industry for participating in an unsafe or unsound practice where depositors quote, could be prejudiced, unquote, or the bank, quote, will probably suffer financial loss or other damage, unquote, which are more lenient standards than establishing that the executive caused financial loss to any insured depository institution that has failed. So we are ready to work with our colleagues to find language that would work to accomplish their important goals of holding executives accountable. But when the FDIC doesn't use the tools in their existing toolkit, not sure why this amendment would be a positive. So I urge my colleagues to vote against this amendment, and I yield back.
For what purpose does the gentlelady from Michigan, Ms. Tlaib, seek recognition?
Mr. Chair, I strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you so much. I rise in support of the amendment. I think what's important is what we've learned through Silicon Valley Bank is that we need some sort of enforcement mechanism to hold them accountable right away. I think from various community engagement events I've had after SVB failed, overwhelmingly, American people want to see clawbacks. They want to see these kinds of, again, removing the CEO pay and so forth. I think even if right now FDIC did even more, maybe they sent more letters or showed up more, at the end, if you look at the timeline, it is very much a scheme that was set up so that folks could profit off of their mismanagement and their greed. And so I think it's really important to have some sort of, again, accountability. I think you can go anywhere in the country and everyone says, look, you failed at your job, you didn't do well, you shouldn't get paid for it. If you're literally mismanaging, and you know, bankers are not stupid, they just get really greedy and they make really dumb decisions when they make, you know, base it off of greed and profit. But if you look at the timeline, it's very clear, y'all, like they set it up so they can walk away benefiting from their failure and their mismanagement. So we got to do more. I think oversight and so forth is always important, but if we don't have actual real enforcement tools to claw back and to actually make them pay, or at least for them not to profit off of their mistakes and their mismanagement, we're never going to see any changes. We're going to see more banks like SVB and others do this over and over again. So again, I just hope my colleagues will at least support some sort of clawback. American people continue to ask about that over and over again.
Will the gentlelady yield?
Yes, I yield.
Thank you very much. Mr. Barr, you mentioned that the FDIC have authority now that they don't use, that they are not utilizing the authority that they have to do some of the things that we are wanting them to do. I'd like to raise a question to you, if you'd like to answer, and that is, do we have the authority to legislate tougher laws on the FDIC? Could you do that? Being in the majority, could you do that and put a bill on the floor and pass it?
Well, we're Congress. Yes, we actually created the FDIC. So, yeah, of course, we have the ability to do all kinds of things.
No, I'm sorry. I don't want to interrupt you. Go right ahead.
We have authority to make the right policy. We have the authority to give the FDIC authorities. We have the ability to withdraw certain authorities, especially if they're misusing those authorities or not conducting their activities correctly. So, I mean, yes, the answer is yes, we have the ability to give them authorities, pull back authorities, and we also have oversight.
Reclaiming my time. The reason I asked the question is because you said that they have authorities now that they're not using. You have made a number of complaints about the FDIC. Do you have any legislation to correct that? Do you have any legislation to strengthen their authority? What do you have to deal with the issues that you think the FDIC is not using, not utilizing?
So a couple ideas. One is a bill that I have that would make it easier for new bank formation. So the FDIC right now is an impediment for de novo formation for a variety of reasons. And all of us on both sides of the aisle over the years have said we are advocates of community banks. Community banks not only provide credit to new businesses and entrepreneurs and agriculture and are really the backbone of communities, but they provide competition for larger banks. And so one thing that we can do is modify some of the requirements for de novo charters to provide more competition for bigger banks.
Reclaiming my
Because
time so that I
competition
can
is the
get
way we
these
protect
last few
consumers.
minutes back in. Do you have the authority to give the FDIC the same clawback authority for failed banks that it has for other large financial institutions that are resolved through orderly liquidation authority?
So in answering your question, so I think the point that I was making is that the FDIC actually already has the authority to debar bankers, executives from the banking industry. They already have that. And what as I read your amendment, and I'm open to being corrected if I'm wrong about this, but it looks like you're actually lowering the standard, or you're increasing the conduct standard, I should say. In other words, you're using the word caused when the existing law doesn't require.
Gentlelady's
causal.
time from Michigan has expired. Does anyone else seek recognition? Further debate? If not, does the gentleman from New York, Mr. Lawyer, withdraw his point of order?
Yes, I withdraw my point of order.
The question now occurs on the amendment offered by the gentlewoman from California, Ms. Waters. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the nays have it.
Recorded vote is requested.
A recorded vote has been requested. All those in favor of recorded vote, raise your hand. Significant number having raised their hands, a recorded vote is ordered. Pursuant to Rule 3C5 of the committee rules, a vote on the question is postponed. For what purpose does the gentlelady from Michigan, Ms. Tlaib, seek recognition?
Mr. Chair, I have an amendment at the desk.
We'll pause while the amendment is distributed.
Mr. Chairman, I reserve a point of order.
Clerk, without objection, or let's see, a point of order is reserved. Clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 3556.
Without objection, the amendment is considered as read. The gentlewoman is recognized for her amendment.
Thank you, Mr. Chair. Mr. Chair, the amendment would defer part of the compensation for senior executives of major banks and bank holding companies for several years and use the deferred compensation to pay any civil or criminal fines that may be leveled on the bank or bank holding company, in addition to ensuring that uninsured depositors do not suffer losses if a subsidiary bank fails. We all know, going back to Wall Street crash in 1929 and before, improper pay structures have contributed and played a huge role in financial crises in our country. In the run-up to 2008 financial crisis, compensation packages incentivized, we saw it just recently, senior employees and executives to pursue what we call short-term profits without regard for long-term risks for their firms or broader financial systems or economy in our country. And the practice, as we saw, continues to this day. Bank executives remain unburdened by accountability despite putting our financial system at risk. Silicon Valley CEO Greg Becker enjoyed millions of dollars, y'all, in stock options and incentive-based bonuses while his bank mismanaged risks over and over again and failed to respond to regulatory warnings. Bank employees continue to walk away, and their executives walk away with generous bonuses while their firm breaks the law and undermines the stability of our financial system. Compensation incentives, colleagues, that promote inappropriate risk-taking are a threat to our economic security, and so I hope you will support this amendment.
For the purposes of the gentleman from Kentucky, Mr. Barr, seek recognition.
I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate the issues that Ms. Tlaib is trying to address in tying executive compensation with bank risk management. Obviously, we've seen that there's been a failure of bank management in some of these more high-profile failures recently, and a failure of adequate supervision to address those issues, I think, has contributed to these bank failures. But I do have some concerns with the amendment as it's currently drafted. For example, the amendment defines a senior employee in a manner that captures highly compensated employees who may not have any authority over the overall risk management of the bank and places their compensation at risk if the bank receives an enforcement action. What you don't want to do is unintentionally incentivize even more bank mismanagement by not having the right people in place and discouraging highly talented people to go into the industry because they're at risk of being punished for something they are not responsible for. That could result in some inferior people at the helm. That's exactly the opposite of what you want. We want to attract the best and brightest who know actually how to run banks. We don't want to discourage that and encourage people who don't know what they're doing to lead some of these systemically important institutions. It may not be fair to a highly compensated trader, for example, at a GSIB for an OFAC sanctions violation that they may not have any visibility into or let alone any authority to avoid. Moreover, this may result in good actors being punished for the conduct of bad actors, again, deterring quality, talented people from being at the helm when these institutions really need them. The bank regulators' existing authorities do allow them to seek fines from executives who engage in misconduct and actually target the people who are responsible, not people who are not responsible. So let's not try to punish the bad by also punishing the good. Let's target misconduct or mismanagement, and let's make sure we're not ensnaring talented, qualified people who are doing the right things, doing the right risk management, just for the sake of defunding all bankers. And that's why I urge my colleagues to vote against this amendment.
Does the gentleman yield?
Sure, I've got some time, I'll yield.
Thank you, Mr. Barr. I mean, I hope the best and brightest isn't Greg Becker, but I can tell you, I think the intent here is in regards to making sure that those that are responsible is held accountable. There is no real authority right now to do a direct clawback or create this kind of fund of deferred compensation that we can make sure that, as you know, uninsured depositors, I don't know about you all, I got a call when this was happening of a small business owner who could not do payroll on Friday. It was just, it was chaos for him and his small business. And so this is at least, again, protecting those folks that we would ensure that, again, that uninsured depositors do not suffer the losses if a bank fails because of mismanagement, as we saw recently. But
if I could reclaim my time,
Sure.
I appreciate what you're saying because I agree there was mismanagement to my friend from Michigan. The problem that we're trying to get at with the underlying legislation, why we need more accountability and transparency from the regulators, is that it was right there in front of them, and they didn't do anything about it. And I fear that the San Francisco Fed was so preoccupied with political errands unrelated to interest rate sensitivity that they did not have the wherewithal or the will or the focus to actually address the mismanagement that you're identifying. So the idea that we would not seek as a Congress more transparency, more visibility, more accountability from these failed bank supervisors is beyond me. That's what we want to get at. And so existing law allows for holding executives accountable. Existing law does. But what we don't want to do is, it's, I'm sure, well-intentioned, to pile on to bad actors or those who did cause a lot of harm, but ensnare a lot of good, quality, talented people that actually could save these institutions And just for the sake of, I don't know, class warfare, we just want to defund all bank executives. Let's actually incentivize talented, good people to go into these
Gentleman's time has
important
expired.
positions. I yield back.
For what purpose does the gentlelady from California, the ranking member, Ms. Waters, seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Before I get into the statement, I'd like to say to Mr. Barr, when you use language like you're attempting to defund all the bank executives,
Ranking member is reminded to address remarks to the chair.
Mr. Chairman, I would like to remind Mr. Barr, through you, to not use language like defunding all of the bank executives. That's not what Ms. Tlaib is doing, and that's a misrepresentation. So I just want to advise Mr. Barr that that's the kind of language that creates unnecessary confrontation. Thank you.
Madam Chair, do you yield?
I yield to Ms. Tlaib.
Yeah, I'm really trying to defund corruption. If you all did not look at the same timeline that I put up there intentionally regarding, you can see that they ignored the feds over and over again for over months and even a year. They intentionally ignored. You can add on another letter, another supervisor, put some people there, but at the end, you can see that they were going to misrepresent information. And you can see by their character, it's almost like we're ignoring the bank altogether and just blaming the feds when I'm like, well, the bank didn't respond. How come nobody's mad about that? How come nobody's mad that they even gave the bonuses out, like literally hours before? Like, how come nobody's angry about that? I just don't get it. I don't get it that this person who did an awful job, like terrible mismanagement, everybody agrees on that, got to walk away with millions of dollars while small businesses were freaking out. They didn't care about them. They didn't care about that person. You know, they're small businesses, you guys. These are really like storefront ones that you see in our neighborhoods and communities. No one cared. And I just feel like we keep saying that they already got the authority. I'll tell you right now, it's just not enough until you can get to their pocket. When you go to the bottom line of saying, hey, I'm sorry, but when you put it aside the money, so that it, again, will be a prevention of them focusing on profiting their self-interest and profiting for themselves and walking away, their hands clean. That's exactly what's going to happen over and over again. We saw it again at Silicon Valley Bank, and no one seemed angry with them before this committee, and I was just a little shocked to see that no one asked them why they didn't respond. No one asked them why they did all those things. Like, no one asked, he's like, yeah, I'm really sorry it happened. It's all my fault. Then it's all your fault. Well, why are you paying yourself to do nothing other than, again, mismanage and focus on greed and profit for yourself? I just feel like there isn't enough in the law right now that, again, protects those uninsured depositors, y'all. When I say depositors, it kind of dehumanizes. These are small businesses. These are the folks that these smaller banks tailor towards. And I just feel like Silicon Valley sets a precedent when we don't do more and at least have some language, again, that allows some sort of real enforcement and accountability. And I know you all looked at the timeline. It is very clear that they were intentionally not responding because they wanted to get to a point where they could benefit profit-wise and benefit personally for not responding to the FDIC folks. With that, I yield back to the chair.
Thank you very much.
Ranking member.
Let me just say that I do believe that I've heard too many times today, it's the regulators' fault. It's the regulators' fault. They're the ones who are causing the problems. Well, if that is true, why aren't you doing more to incentivize the banks to be better managers? But we don't see anything happening from the opposite side of the aisle to ensure that we do not have other crises that will occur because of failed bank management and or regulator supervision. And so I think I have concluded today, as we move closer to winding up in this committee, that we don't have the support of the opposite side of the aisle to take on the banks or the regulators or anybody. This is more about protecting the banks and not doing anything to deal with their compensation, not doing anything to ensure that they have chief risk officers, not doing anything to deal with the lack of understanding where the problems with their securities are shown or identified so that the balance sheet is correct. What is this all about? When will the members on the opposite side of the aisle get serious about dealing with the banks in particular? I don't know when it's going to happen, but I can tell you I'm appreciating the work of the Democrats here
General Latos,
today
time
and
has
wonder
expired.
when are the Republicans going to join us. I yield back my time.
For what purpose does the gentleman from New York, Mr. Garbarino, seek recognition?
Mr. Chairman, I move to strike the last word.
The gentleman is recognized for 5 minutes.
I yield to my colleague from Kentucky, Mr. Barr.
Thank you to my colleague and friend from New York, and I will be brief. I think when you talk about let's get serious, I think the problem that many of us have with the amendment is that it's not serious in targeting who we actually should be targeting or focusing on. The fact that there's this broad categorical ensnaring of every senior bank employee, including those who are totally not to blame, is an unserious attempt at actually getting at the issue and holding executives accountable who are actually at fault. I think that if there was a more serious effort to target and hold accountable the management that is actually to blame as opposed to senior employees who have nothing to do with the problem, that's why we don't take this amendment seriously. Although I will stipulate and know Ms. Tlaib is well-intentioned here, it's the fact that the amendment is so over-inclusive that leads me to just not be able to support it, and that's why I urge my colleagues to not support it, and I yield back.
Mr. Garbarino, yield.
I yield to Ms. Davidson.
Oh,
I thank the gentleman. I too oppose the amendment, and I think the point that the executive compensation isn't being paid attention to misses the mark. The right attention is being paid to executive compensation paid out right before the bank failed. There's a criminal investigation underway. Thank goodness our federal law enforcement agencies, our bank regulators, our Department of Justice is focused on actual crime, including white-collar financial crime. Not clear that there was crime, but we're glad that there's an investigation there. We trust that there will be due process and there will be a prosecution. If, as it turns out, that no one is held to account, I think maybe we'll take a look at is the law clear enough here? But the law that would hold people accountable for withholding material information as a fiduciary in a bank or any other traded company, withholding that information and then executing trades for their own benefit is clear in my mind. And the question is, will the Department of Justice actually hold people accountable for complying with that law? So far, I'm encouraged they're launching an investigation. I would point out that the other thing that happened here, because the bank's owners, the shareholders, hired incompetent managers, their equity is completely wiped out. Their investment went to nothing. That's a just punishment for hiring bad management teams. They were rightly wiped out, and frankly, because the bank's creditors didn't do proper underwriting, they too were wiped out. And I think that is a just action here. The real question is, why did the people with material knowledge, which did include bank management, but it also included regulators, why didn't they take action? And I'm encouraged that there is actually a criminal investigation underway on the bank's management team. The underlying bill does do the right thing in putting pressure on the regulators, which isn't going to come to bear from the market. It's going to come to bear because we get this underlying bill across the finish line. With that, I'll yield back to Mr. Garbarino.
Oh, Mr. Garbarino, do you yield just a minute?
Yes, sure.
Thank you. Just so clarification, through the chair, the amendment only covers top 5% of the employees at banks with more than the $250 billion in assets, and they have to make more than $1 million. And it's also someone with the authority to expose this is where we can maybe work there, but it's someone with the authority to expose 0.5% or more of the bank's capital. Again, if you want to maybe just have it apply to CEOs and do unanimous, I will totally support that, and we can focus on the CEOs. And it'll be, I think we'd get a lot of support among colleagues to, again, at least hold the top person accountable. With that, I yield back to Mr. Garbarino.
I yield back.
Gentleman yields. For what purpose does the gentlelady from Texas? Oh. What purpose does the gentleman from Illinois, Mr. Foster, seek recognition?
Oh, strike the last word.
Gentleman's recognized for 5 minutes.
I'd just like to briefly make the point, a couple of points. The first is that I'm much more comfortable with clear rules on compensation that are set up ahead of time, rather than some ex post facto clawback. I mean, that's, I think it's going to have a lot less effect on behavior. The other thing is, clearly criminal behavior we have to deal with, but bad judgment we should also deal with. And, the theory of having the shareholders looking carefully at who they hire to run the bank, that's how a perfect free market economy should work. It clearly doesn't always work. They're just not. It's not realistic to expect that that sort of market discipline will always result in getting competent leaders. And so we have to, the thing we can do here is to set standards for the compensation that will automatically align the incentives between the decision makers. And I support the point of having the actual decision makers be the ones whose compensation is at risk if they come up with bad decisions. But to align the incentives of those with the shareholders, because the market by itself hasn't shown that it really aligns the incentives, and we have to do a better job of that. So that's why I really support the idea behind this of just doing more to incentivize this. And with that, I'll yield my time to Ms. Garcia or Ms. Talib as they prefer.
No, I don't need the time anymore.
You don't?
Thank you.
What? And, all right. Hearing no other objection, I will now yield back the remainder of my
Gentleman yields. Is there further debate? If not, does the gentleman from Texas withdraw his point of order?
Mr. Chairman, I do remove my point of order.
The question now occurs on the amendment offered by the gentlelady from Michigan, Ms. Talib. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay.
No.
In the opinion of the chair, the nays have it. A recorded vote has been requested. All those in favor of a recorded vote, raise their hand. A significant number having raised their hands, a recorded vote is ordered. Pursuant to Rule 3C5 of the committee rules, a vote on this question is postponed. For what purpose does the gentlelady from California, Ms. Waters, seek recognition?
I have an amendment at the desk.
We'll pause while the amendment is distributed.
Thank you very much. Well, I know we
We'll
focus.
pause while the amendment is distributed.
Oh, I'm sorry. Thank you. Sorry, Maxie. That's okay, I forgot.
Mr. Chairman,
For what purposes, gentleman from Texas seek recognition?
I reserve a point of order.
A point of order is reserved. Have all members received a copy of the amendment? Clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 3556.
Without objection, the amendment is considered as read. The gentlewoman is recognized for her amendment.
Thank you very much. Well, I know we have focused a lot on S2155. My amendment would actually address a loophole in the original Dodd-Frank framework that let banks like Signature Bank and First Republic Bank off the hook and avoid being subject to regulatory safeguards. Unlike Silicon Valley Bank, Signature and First Republic did not have a bank holding company, which means they were able to escape many of Dodd-Frank's enhanced prudential standards. However, no one has been able to explain why a large bank should be subject to different capital liquidity, resolution planning, or stress testing, whether they have a holding company or not. Again, this is another substantive amendment to address a real problem exposed by the crisis. I know how much the other side loves to air their criticism of Dodd-Frank. So this amendment gives Republicans a chance to correct a flaw with Dodd-Frank to improve the safety and soundness of our banking system. So I would urge all members to support my amendment, and I yield back.
For what purposes, the gentleman from Kentucky, Mr. Barr, seek recognition?
Move to strike the last word.
The gentleman's recognized for 5 minutes.
I wish I could find an amendment to agree with, but I cannot. This amendment is outside of the scope of the legislation, and I don't think it really works in this context, because the Dodd-Frank enhanced prudential standards are intended to bring bank-like prudential standards to large holding companies and their consolidated organizations. Banks are already subject to more prudential standards than bank holding companies. So existing law already accomplishes what the ranking member intends to accomplish with this amendment. I invite her to further explain if she has an argument to make why banks are not subject to more prudential standards than bank holding companies. I invite her to explain that. And I will yield.
Lady from California.
I will yield to the ranking
Yes.
member.
I think that you must be making a mistake in saying that banks are required to the same or even larger requirements than banks with holding companies. I do not find that to be true. And so that is why I believe that there is a loophole. Now, if you can identify exactly where you have discovered that they are now required for the same prudential requirements from the prudential legislators, then perhaps this is not needed. But I see it as a loophole in Dodd-Frank. And I was just kind of reminded that you mean to tell me you have found something wrong with Dodd-Frank? I admit, this is a loophole, and we want to close it. You can close it.
Well, I'll reclaim that time and ask another question. Is there an example? Can the author of the amendment give me an example?
Okay. All right, I have some information for you. Signature Bank, for one, and another bank, First Republic Bank, was not subject to Section 165. It only applies to bank holding companies. It does not apply to banks without a holding company.
Well, I'd be happy to talk to you about how there's disparate treatment of banks without a holding company. But again, this is a transparency and accountability bill for the regulators. I'd love to talk to you about this further, but the reality is we do have a tailored regulatory framework right now, and if there's disparate treatment of banks with holding companies and banks without holding companies, and there's a reason why there's a loophole or a gap, I'd like to discuss that with you. Be happy to do so, but that conversation is not really germane to what we're trying to do, which is regulatory transparency.
I think it is, and let me just say that not only have I found a loophole, this is an opportunity for you to get at those regulators you've been complaining about all day. Make them do their job. Make them do their job. And so I would not only like to talk with you, but you indicated you're going to be talking to a lot of people about a lot of things. I just want to legislate, and I want to legislate with you. I yield back.
Time belongs to the gentleman from Kentucky.
I urge my colleagues to oppose the amendment and support the underlying bill, and I yield back.
Is there further debate? If not, does the gentleman from Texas insist on his point of order?
Mr. Chairman, I remove my point of order.
The question now occurs on the amendment offered by the gentlelady from California, Ms. Waters. All those in favor signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the nays have it. A recorded vote has been requested. All those in favor of a recorded vote, raise their hands. A sufficient number having raised their hands, a recorded vote is ordered pursuant to Rule 3C5 of the committee rules. A vote on this question is postponed. For what purpose does the gentleman from Texas, Mr. Green, seek recognition?
I have an amendment at the desk, Mr. Chairman.
We'll pause while the amendment is distributed.
Thank you.
Mr. Chairman.
For what purpose does the gentleman from Texas seek recognition?
Mr. Chairman, I reserve a point of order.
Point of order is reserved. Members received a copy of the amendment. The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 35.
Mr. Chairman, I ask that the amendment be considered as read.
The gentleman is recognized for his amendment.
Thank you, Mr. Chairman. Mr. Chairman, our banking system has been tested when it shouldn't have been. Our regulators had to exercise authorities to stop contagion because the Trump administration undermined the safeguards on large banks meant to prevent contagion. We have an opportunity today to consider real reforms that will fix the mess made not just over the last 2 months, but over the last 5 years. In particular, Mr. Chairman, we need to ensure that the risks exposed by this crisis are addressed and that the bill for those failures falls squarely on the institutions that benefited the most. My amendment would clarify that it is the sense of Congress that our community banks, including rural banks, community development financial institutions, and minority depository institutions, did not cause the crisis, yet may have been harmed by the crisis and certainly should not have to pay for the crisis. When Silicon Valley Bank and Signature Bank failed, the Treasury Secretary, with the bipartisan and unanimous support of the FDIC and Fed, used systemic risk authorities to prevent contagion and protect depositors. This caused the Deposit Insurance Fund to incur significant losses. This fund, also called the DIF, is comprised of premiums that are all insured banks pay, premiums that all insured banks pay in the amount up to $250,000 each. However, when Silicon Valley Bank and Signature Bank failed, the FDIC had to use the DIF to also protect uninsured deposits. The FDIC currently estimates that the cost to cover these uninsured deposits is $15.8 billion. While no taxpayer dollars were used to protect depositors, these losses will have to be repaid using a special assessment. The actions taken by the Biden team successfully stopped the contagion, and has helped to restore confidence, especially in those regional banks that remain open. In addition, the whole crisis drove billions of dollars in deposits to the mega banks, much of it coming from community banks. As I see it, it is the regional banks and the mega banks that received outsized benefits from the needed actions by the Biden regulators. Hence, it should be those institutions that pay back the Deposit Insurance Fund. Community banks have long suggested that too big to fail is alive and well. Further, many think that it is highly unlikely that a systemic risk exception would ever be declared for their decidedly smaller institutions. For these reasons and others not mentioned, my amendment also clarifies that the smallest community banks, those with $5 billion or less, should never have to pay if those authorities are used additionally ever again. The institutions between $5 billion and $50 billion should pay a significantly smaller amount than the largest banks. While the FDIC has proposed an assessment that is consistent with this amendment, which should be made and adopted easy, we need to protect community banks in the statute for any future use of these authorities. I urge all members to support this amendment and yield back.
Gentleman from Texas yields back. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes to strike.
Move to strike the last word. Now, this is an interesting amendment. I really appreciate the gentleman from Texas offering this amendment because I really want to work with him on this. My recollection, the last time I looked at the summary of the special assessment on this was that institutions less than $50 billion in assets were responsible for only, I think, if my memory serves, around 4.7% of the entire assessment. So what that means is that the FDIC has actually honored the request that many of us have made to them. And to my friend, Mr. Green, I agree with exactly what you're doing here in terms of tailoring. Tailoring to hold harmless the smallest institutions and graduate it up so that the losses are borne mostly by the larger institutions, and certainly that makes sense to me. But the FDIC, to their credit, already did this. In their special assessment, they exempted the institutions $5 billion or less, and the institutions between $5 billion and $50 billion, again, are only paying 4.7% of the assessment. So on that basis, the larger institutions, and especially the GSIBs, they're bearing the largest amount. Now, some of the large regionals, I think, have problems with the assessment. They think they're paying too much. But your bill, or your amendment, as I read it, doesn't affect any of that. It just affects the institutions with $50 billion or lower. I want to pose a question to the gentleman because I'm interested in his amendment. Does your amendment change the law in all cases of a loss to the Deposit Insurance Fund, or is it just for this the special assessments related to the failures of these recent bank failures?
I thank the gentleman.
And I'll
for the
yield to
question.
him for the answer.
Thank you. I thank the gentleman for the question. This would only occur when there has been a systemic risk exception made. And I would also add this, the rule that you said that has been placed into action has been proposed but has not been ratified. So what we're doing now is assuring that there is more than a proposal.
Yeah, so, but this would, reclaiming my time, as I understand it, the amendment, I know it would only apply when there's a systemic risk exception invoked, but this would change the law permanently for all losses to the DIF.
Yes, when there is the systemic risk
Prospectively
exception.
going forward. Well, I'm interested in working with the gentleman on this idea because, again, I support tailoring. I have a proposal for the gentleman.
I have ears to hear.
Okay, I will vote for this amendment if the gentleman will vote for the underlying legislation.
Well, I appreciate your asking me to,
Because I want bipartisan support for the underlying legislation, and this is an intriguing idea.
well, I appreciate your asking me for a cow, for milk if I would give you a cow. I think that you're asking a little bit more than I'm according you. Can we settle on something?
Yeah, how about this?
That's a lot less.
How about this? If the gentleman opposes my legislation, if the gentleman would withdraw his amendment, I would offer to join the gentleman in legislation separate and apart from this bill so we could move this idea forward.
When you indicate you would join me, you mean separate and apart?
We work on a bipartisan bill together.
But for another time, another place, another hearing?
Well, sure. Well, the idea is, okay, so you're not going to support the underlying legislation. So let's commit to each other that we'll work on this legislation as a standalone idea.
Well, I don't know that it's unusual for members to support some aspects of legislation and oppose others. So I think I'll ask you to just simply do what appears to be something you're amenable to.
Reclaiming my time, I may introduce the bill as a standalone bill and invite you to co-sponsor it.
Well, I appreciate your asking me to join myself.
Gentleman's time's expired. It was an excellent exchange. Look forward to that. The gentlewoman from California, the ranking member of the full committee, Ms. Waters, is recognized to strike the last word.
Thank you very much. Mr. Chairman and members, both sides of the aisle are forever talking about how much they love the community banks. We're always talking about the fact that they should not have to receive the kind of legislation that the bigger banks sometimes are forced to receive, on and on and on. This is time to show your love. I'm going to yield to Mr. Green. Mr. Green, this is a great amendment. We love the community banks, and we have an opportunity all to show that love by voting on this bill. Not making a deal, but voting on the bill. I yield to Mr. Green.
Thank you, Madam Chair. I concur with you. This is common sense legislation, again, something that my colleague, Mr. Barr, finds so acceptable, such that he's willing to introduce it himself. So it can't be anything that he finds repulsive or repugnant. And one would assume that given he has gravitated to this bill to the extent that he has, that he would support it here and now. It does not harm the legislation that he's proposed. And what it does is it shows that there is collegiality. It demonstrates a willingness to have the public, the viewing public, understand that we can work together on things that we agree on. Now, this is something we agree on, so I would hope that we can work together on something upon which we agree. I will yield to Mr. Barr.
Thank you, Mr. Green.
Well, I don't have, I'm sorry, the time belongs to the chair.
It's the chair, it's the ranking member's time.
Thank you.
It's my time, but Mr. Barr, I'll be happy to yield to you on this wonderful bill.
Thank you.
To support the community banks. I yield to you.
Thank you, Madam Ranking Member, and this is a good moment because there's an opportunity here, a real opportunity to do some bipartisan work. So what we'll do is introduce this bill. I'll ask the Ranking Member and Mr. Green to co-sponsor the bill, and I urge them to reconsider their opposition to the underlying legislation.
Reclaiming my time.
I yield back.
Reclaiming my time. This is Mr. Green's amendment. This is his bill. This is what he came to this committee with today. And since we have not been able to agree on very much here today, This is a wonderful time for us to come together for those community banks that we love so much. And so I would urge Mr. Green to continue to try and, get you to support this bill and to provide the leadership for this committee and for your side of the aisle to do something that we can leave here with today that shows that most of the time we're not able to agree, but on this one, this has been easy for all of us. And so, Mr. Green, I'm going to yield time back to you. See if you can encourage him a little bit more to support this wonderful bill.
Well, thank you, Madam Chair. I would suggest to my dear friend, Mr. Barr, that we have these rare moments in time that can impact a significant portion of our time. This is such a moment. It's rare, unfortunately, all too rare, but it is one that we should take advantage of. So, Mr. Barr, I make an appeal to you to take advantage of this unique moment in time and bring the committee together such that we can have unanimous consent to move forward with this piece of legislation.
Ranking member's time. Are you yielding back, ranking member? Oh, Mr. Barr.
Mr. Barr
would
desires
yield
additional time.
Well, yes, I have a few minutes to yield to Mr. Barr. Mr. Barr, don't use up this time. Come on. Yeah. He's only got.
Let's hold the clock for a minute.
Would-
We'll just,
this
is gonna extend itself. So ranking member, I recommend you yield back and perhaps we'll continue this.
Unanimous consent to hold the vote to the point where he was yielded to. That'll only take us back to about 58. Mr. Barr?
I think I'll rule that out of, Mr. Barr, you need more time to consult down there, sir?
I would ask for the indulgence of the committee for just a minute while I can consult with.
Indulgence? I've just asked for unanimous consent for you. Indulgence does not take
This
precedence
is
over
potentially a
unanimous
new age of
consent.
Aquarius, so we'll hold for a moment.
I'm having so much fun.
I'm going to rule that out of order, thank you.
Okay, if I may.
All right, it's the gentlewoman from California's time. She has 29 seconds left. She's asked unanimous consent to put 58 seconds on the clock, and if we can do that, we will do that.
Okay.
Stand by. All right.
I agree.
I yield. Gentlelady has the floor.
I yield to the gentleman.
Thank you. So staff has clarified something that I didn't understand in the amendment, and it is that what the FDIC has done is exempted banks less than $5 billion, but it only applies to uninsured deposits. So the draft amendment is not as I thought it was, because as I understand it, Mr. Green, it would actually exempt institutions with much larger assets than just $50 billion, because the assessment relates only, the current assessment relates only to uninsured deposits. Am I misreading your amendment?
It's the gentlewoman's time of California. Or do you yield to Mr. Green, Ms. Waters?
Yes, I yield to Mr. Green.
Yes, thank you. The $5 billion or less would apply to the smaller institutions, and
the gentlewoman's time has expired. Is there further debate?
Mr. Chairman?
Just a moment. Is there further debate?
Mr. Chairman, I'd like to remove my point of order.
No.
excuse me, move to strike the last word.
Gentleman from Texas moves to strike the last word. He's called on for 5 minutes.
Mr. Chairman, this brings up new, as you've said, the new age of Aquarius. This is where I voted for something to vote against it. And it brings up interesting questions that I believe Mr. Barr and Mr. Green appropriately are questioning in this. And I think it's really a good idea. Now, Mr. Barr is trying to clarify a lot of this, but in the clarification of doing this, I think we've moved the ball further down the road. But it really stands as a really good opportunity for us to understand that Mr. Barr is willing to let the gentleman have this, I think, if there's an agreement that we want to move this. And his vote would be there to do the right thing. So I just find this very interesting.
Is the gentleman
that we're here, and I would like to yield time now to the gentleman, Mr. Barr, to continue the dialogue.
Well, I appreciate the gentleman from Texas, Mr. Sessions from Texas. What made me very excited about Mr. Green's proposal is that I thought he was proposing would be to exempt institutions with from an assessment $5 billion or lower, and then have a graduation of the assessment to institutions between $5 billion and $50 billion. As has been clarified for me, those thresholds are actually not what would operate in practice under the gentleman's bill, because it would exempt institutions with much higher asset sizes, as I understand it now. Can the gentleman, Mr. Green from Texas, clarify if we can get on the same page and what my intention is and what your intention is?
Well, I regret to point out, regrettably, that I don't read the bill the way you read it. So could you point to the language that has caused you to have this recent revelation? Can you read that language?
Mr. Barr, would you yield for a question? I mean, it's Mr. Sessions' time, but we do.
The gentleman's bill does not track what the FDIC has done, because the exemption applies to institutions with assets of $5 billion or less, but they may not have uninsured deposits. Is that right? Okay, so they may I think what we'd like to do is look at what the FDIC has done. The goal is to exactly as I think you intend it, and that's my goal as well, to tailor the assessment. Now, they already have tailored the assessment, but further tailoring I'm open to. So that's what I would invite the gentleman to work with me on, to make sure we're aligning what you're doing and what the FDIC has done, and talk to the FDIC about that. And I will yield.
It's Mr. Sessions.
The gentleman yields back his time to me. Would the gentleman, Mr. Green, I would yield for such time as I have remaining to the gentleman, Mr. Green.
Thank you. I appreciate it greatly. The language reads, would it exempt insured depository institutions and depository institution holding companies with less than $5 billion in consolidated assets? Now, if we need to tweak this language, this can be accomplished after the bill is passed today. We do this quite regularly. It's a matter of course almost in the House. So
would the gentleman yield for a question?
This language is susceptible to that type of amendment. Yes.
Let me just real quickly, Mr. Green, are you trying to amend the assessment that's in place now by the FDIC, or are you trying to amend make a prospective decision to reduce FDIC special assessments for banks 5 billion and under?
We're trying.
Prospectively.
Thank you. I'm assuming I understand your question. It's been
Well, I mean, I think Mr. Barr is trying to amend the assessment that the FDIC is imposed right now, which is why there's confusion, and the time has expired. So Ms. Garcia is recognized for 5 minutes to strike the last word.
I move to strike the last word, Mr. Chairman. I want to rise in support of my colleague from Texas's amendment. I think it's a great amendment, and I think any discussion of a bill, it should really be made at a later time. And I'm just concerned that even if Mr. Green agreed, where does that really get him in his amendment? Because there's no agreement to give him a hearing. There's no agreement to make sure there'll be a markup on his bill. So I support his amendment, and I, for one, would like to get a vote on that, but I'll let him add anything to that that he might desire, and he can use up the remainder of my time. So I yield to Mr. Green.
It is our reading of the FDIC's proposal as well as our bill that the language is similar. And I'm asking you to point out the difference because I don't see it. And it's your allegation that there is a difference, so I regret to tell you that the burden's on you to point out the difference.
Will the gentleman yield?
Yes.
Well, obviously, as everybody can see, there's a lot of common ground here. But obviously, the issue is important, and the details will matter. And making sure we're aligning our intentions here, I think, needs to be hashed out. I, again, appreciate the gentleman raising this issue because I think we can get on the same page, but we need to step back, get it right, and proceed separately from this bill. But I certainly commit to the gentleman, and whether it is applied to this assessment or prospectively, let's have a conversation about that. That's important. Are we prospectively changing the law for every loss to the diff, or are we talking about this particular assessment, and are we going to include insured and uninsured deposits, or just deal with these exemptions?
Reclaiming the time,
reclaiming
the time. It is for this and for the future, for today's legislation and the future. And what you're talking about is called a technical correction. We do this. We do it quite regularly. So it's a simple thing that would engender collegiality and produce harmony. And I think that's what you want.
Yeah. Will the gentleman yield?
Collegiality and
Will the gentleman yield?
I will.
Here's what I wanted to explore with you through a deliberate process. What I want to explore is whether or not the right policy is to include all deposits or just uninsured deposits as we apply the threshold. That is a conversation that we need to have, and we should have it also in consultation with the FDIC.
It says no banking organization
Well,
with total
Mr. Green, it's the gentlewoman from Texas time. Are you still okay with Mr. Green controlling your time?
She's yielding.
Mrs. Garcia?
I yielded my time to Mr. Green.
Very good. Mr. Green, continue.
Thank you, Mr. Chairman. The staff has been quite generous in helping me with the legislation in question, and it is the FDIC's codified legislation, statement that it is the smaller banks and it is total assets of these banks. I don't know that it can get much clearer than that. And that is the same as our language, which indicates $5 billion in consolidated assets. So it's the same. And I'm asking you, if you would, to point out the difference, because I'm showing you the sameness of it, and I'm not hearing you go to some specificity or with some specificity language that shows that there's a difference.
Well, just the gentleman yield.
Well, if the lady yields, I would agree.
I yield.
Okay, thank you. And I appreciate the gentleman's offer. Here's what I will commit to. I will commit to working with you offline to get the details right. So I'm gonna oppose the amendment now, but with the commitment that getting the details right in terms of what institutions we're actually describing. That is important, because what I will oppose is unintentionally including institutions
May I claim
that
the
are
time
much
before-
larger than
before
maybe
it
the gentleman
expires?
and I are intending to include
Ms.
in this.
Garcia.
this
Ms.
tailoring.
Garcia's
Mr.
time.
Green, I yield to Mr. Green.
The language is perspicuously clear. It indicates $5 billion in consolidated assets. That's the language being used by the bill that we have, and it's the equivalent of what the FDIC is calling to our attention. And if we can do this now, we would obviously have the opportunity to have some level of cooperation. Thank you.
Gentlewoman's time has expired. Is there further debate? Gentleman from South Carolina, Mr. Norman's recognized to strike the last word for 5 minutes.
Thank you, Mr. Chairman. You know, I think you're walking on a slippery slope here by, you know, I get community banks. I mean, I was on one, but now you're exempting them. What about the next Silicon Valley bank that closes? Everybody wants an exemption, but at the end of the day, why are you giving them an exemption? And let's say we have 4 more bank failures. Are you going to exempt that as well? I think you're setting a pattern here. Secondly, I think you need to know I mean, I don't know what assessment dollar amount that the assessment comes to, but it would make sense to me to let's see what type dollars you're talking about before we just go exempting banks. You know, we got a set pattern that is there, and the funds got to be kept solvent, I assume, for losses like this. We are going to have more banks. I just think you're walking a tightrope to do this, and we ought to know all the facts. I've enjoyed the discussion, but I think you need a lot more exploration before you just start.
Will the gentleman yield?
Yes, sir.
Thank you. I greatly appreciate it. The smaller banks, the empirical evidence clearly indicates that they had no part in the failure. They did nothing to cause the failure. They are, in many circumstances, barely capable of keeping the doors open. We have indicated on many occasions that we want to support these smaller banks. These are the smaller banks, probably the smallest almost of the smaller banks. I think that this is an opportunity to show them that we respect what they do and will not disrespect them by requiring them to pay a fee for something that they had no role in creating.
Reclaiming my time. I'm sympathetic to community banks, Mr. Green, but you know, when houses burn, cities are not exempt from paying it because they didn't start them, as one example. But I think, again, are you going to exempt when other banks fail? Or is the same question, are you going to exempt other, I mean, the same community banks, you're 5 billion and under, what's the difference? I yield you.
Yes, sir. Thank you. The exemption would apply for future failures, and those banks, again, would be exempt. They didn't cause the failure, so they would be exempt. And permit me to just add this quickly. We say community banks, but these are rural banks also. These are banks that communities depend on because the bigger banks aren't there for them. And I don't think we should punish them when they did not create the problem. So it's just a simple appeal to give them an exception.
Reclaim my time. Yeah, I get that, and I've enjoyed the discussion. I guess, in fairness, let's find out what the dollar amount is. And if the intent is to, from here on out, to let community banks out of any future bank failures, that's pretty dramatic. I yield back.
Gentleman from South Carolina yields back. Is there further debate? If the gentleman, Mr. Sessions, do you withdraw your point of order?
Mr. Chairman, I do withdraw my point of order.
The question then occurs on the amendment offered by the gentleman from Texas, Mr. Green. All those in favor shall signify by saying aye.
Aye.
Opposed shall signify by saying nay. Nay.
Recorded vote is requested.
In the opinion of the chair, the nays have it. A recorded vote has been requested. All those in favor of a recorded vote, please raise your hands. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to Rule 3C5 of the committee rules, a vote on this question is postponed. There being no further amendments, without objection, the previous question is ordered. Recorded votes on the amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. Now, pursuant to the notice, I call up H.R. 3564, the Middle Class Borrower Protection Act. The clerk will report the bill, which was distributed in advance.
H.R. 3564, to cancel recent changes made by the federal...
Without objection, the bill is considered read and open to amendment at any point. The gentleman from Ohio, Mr. Davidson, the sponsor of the legislation, has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report.
Amendment in the nature of a substitute to H.R. 3564.
Without objection, the amendment in the nature of a substitute is considered read and will serve as base text for the purpose of the amendments. The gentleman from Ohio is recognized for 5 minutes.
Thank you, Chairman. I'd like to introduce the following amendment to H.R. 3, introduced on Monday. So that's having been done. So thank you. My bill would provide critical oversight and accountability for the Federal Housing Finance Agency and help eliminate any unfairness, intentional or otherwise, in how it sets its pricing. The FHFA is the conservator and regulator of the world's largest housing finance companies, Fannie Mae and Freddie Mac. These two GSEs represent an unbelievable 70% of our nation's single-family mortgage market. To put it into perspective, Fannie and Freddie together guarantee mortgages for tens of millions of families. It's very likely that if you're a middle-class homeowner in this country, you have a Fannie or Freddie loan. These two companies play an enormous role in everyday lives of Americans, and the role of the federal government seems persistently skewed because they're not only controlling interest that FHFA has in the GSEs throughout the Treasury, but also FHFA acts as their conservator, both regulator and conservator. So FHA has broad and highly unusual role to, quote, preserve and conserve the assets of Fannie and Freddie. This authority came about during the great financial crisis when a catastrophic buildup of unsound mortgage practices led by the GSEs caused a nationwide housing market collapse. In addition to this role, FHFA wears the other hat as regulator of Fannie and Freddie. In this capacity, FHFA must protect the safety and soundness of the institutions and, in turn, fundamentally, the entire mortgage market. Any way you look at it, FHFA has an extraordinary level of authority in our housing landscape, including over the cost of mortgages for American families. In January this year, the agency announced that it would change the pricing grid for single-family loans. This resulted in an increase for many creditworthy borrowers and a decrease for many less creditworthy borrowers. Some said this is just a way to subsidize lower credit score borrowers by making credit more expensive for the middle class. The Wall Street Journal called this an upside down mortgage policy, and I agree. Yesterday, however, FHFA Director Sandra Thompson chalked this all up to a misunderstanding and asked us to trust the government in setting mortgage prices. I say trust but verify, and that's exactly what the Middle Class Borrower Protection Act would do. The legislation would bring much-needed independent oversight to the process for setting GSE's upfront fees, called loan level price adjustments, or LLPAs. It would put in place a one-year freeze on FHFA's ability to make additional fee changes while the GAO, the Government Accounting Office, reviews and brings transparency to the FHFA's process with underlying data. It would also allow the public and key stakeholders the opportunity to review and comment on any LLPA fee change in the future, as any federal agency should do when enacting policies that affect millions of Americans. Importantly, it would also require the FHFA to use risk-based principles in setting these fees, which would be doing away, which it should be doing anyway as conservator and regulator. Finally, the bill would prohibit FHFA from imposing any LLPA changes based on the borrower's debt-to-income ratio. Notably, FHFA recently withdrew a rule that would base fees on debt-to-income, which was the right thing to do. It did, however, shine an even brighter light on the need for transparency to Congress and to the American public of the agency's fee-setting process, in the underlying data that they examined as part of this. This bill comes at a critical time for consumers facing the sting of inflation and interest rate increases in their daily lives. Further, it will support the safety and soundness and fiscal sustainability of the GSEs and the broader mortgage markets. These efforts support taxpayers and hardworking Americans looking to purchase a home. We learned from the last financial crisis the importance of maintaining good underwriting standards for the solvency of the GSEs and the entire housing market. And frankly, Director Thompson supported the need for transparency and acknowledged the need for more transparency. This bill does that. I urge my colleagues to support this measure, and I yield back to the chair.
The gentleman yields back. The chair recognizes the ranking member of the full committee, Mrs. Waters, for 5 minutes to strike the last word.
Thank you very much. H.R. 3564 would eliminate FHFA's recent changes to its upfront fees that are charged to borrowers who apply for conventional mortgages purchased by Fannie Mae and Freddie Mac. Unfortunately, the very premise of this bill is factually incorrect. Republicans have now held 2 hearings where they regurgitated Fox News talking points, claiming that these pricing changes result in higher credit score for borrowers, subsidizing lower credit score borrowers. Their own witnesses at these hearings debunked these claims, and yet we're here marking up this bill that would reverse those changes. My Republican colleagues say they're concerned about fairness. These pricing changes would make upfront fees more fair, not less. Specifically, first-time home buyers, rural and manufactured housing home buyers, as well as home buyers who don't have the bank of mom and dad to make a 20% down payment on a home, but have proven they can make regular payments with no longer be overcharged, as they had been under the old pricing framework for over a decade. How does FHFA offset the cost of lowering fees on these borrowers? By reducing the subsidy wealthy people have received when buying vacation homes and investment properties. I'd say that's more than fair. My colleagues on the other side of the aisle also say they're worried about the next generation being able to afford the dream of home ownership. I feel the same way. I have long fought for more opportunities, including home ownership that allow for wealth to be passed down from one generation to the next. Unfortunately, not one of them supported my efforts to address affordability crisis in this country, and even criticized the fact that I held 55 hearings on all aspects of the housing crisis in this country. FHFA's pricing changes are helping lower wealth borrowers gain fair access to home ownership so they can start taking part in the American dream of home ownership and build wealth. Perhaps there's nothing more I can say here to convince my Republican colleagues of the truth when they have ignored their own witnesses who have said the same things. But I stand ready to work with Republicans if they're truly interested in working on ways to increase housing supply, lower costs, and equitably expand home ownership. With that, I urge my colleagues to oppose this bill before I yield back, and I ask for unanimous consent to submit statements of opposition to this bill from the National Fair Housing Alliance, Americans for Financial Reform, Public Citizens, as well as statements outlining concerns with the bill from the Mortgage Bankers Association and the National Association of Federally Insured Credit Unions.
Without objection, they'll be included in the record.
Mr. Chairman and members, I had some conversation with some of the members about what we need to do in what I call an urban-rural renaissance, where we really do need to put some attention on the rural areas where people are living in shacks, and we have areas in this country where they're still not running water. And so this kind of change that you're opposing that would take subsidies away from the most wealthy people who are buying second homes and all of that would help us to identify how we're going to get the necessary resources to expand what we do for housing and get to those areas that many Republicans represent, but somehow constituents are not getting the value of their influence by doing these kinds of things, supporting this kind of stuff. So I still oppose this bill. I think that we should vote against it, but I'm still going to focus on how we can get more housing to the rural areas and small towns that have been ignored along with urban areas. Manufactured housing also that a lot of you support. I yield back.
The gentlewoman from California yields back. Is there further debate? The gentleman from Minnesota, the whip of the House, Mr. Emmer, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Chair. Last week, my office actually surveyed our constituents from the 6th Congressional District of Minnesota regarding the Biden administration's socialist and unilateral mortgage pricing change that went into effect this month. Of the 6,000 results, and this is rural America, of the 6,000 results, 93% disagree with this administration's credit score redistribution plan. Fundamentally, it is wrong to support those with a history of financial irresponsibility by punishing Americans who have worked diligently to earn a high credit score. And the numbers don't lie. The Federal Housing Finance Agency's changes both increased fees for half of all borrowers with FICO scores over 680, while decreasing fees for 90% of those with scores under 680. Regardless of how much of a down payment they made or if they qualify as low income. The FHFA tells us that it had to make these changes based on its capital rule. My constituents in Minnesota know that any capital rule that tells people the safer thing to do is to borrow beyond their means is a bad one that fundamentally needs to be rethought. So whichever way this administration wants to present this flawed policy to the American people, this ploy to politicize home ownership to the detriment of those who set themselves up for success poses a safety and soundness concern to the housing market, and it puts taxpayers at risk. Home ownership in this country is becoming a pipe dream, frankly, especially for younger generations. Young Americans are faced with the results of irresponsible government decisions. Massive spending, massive inflation, and steep rate hikes. My constituents rightly are angry about this mortgage pricing change. It's a gross display of yet another unilateral bureaucrat decision here in Washington, D.C., with far-reaching impacts on access to home ownership, just to prop up a socialist political agenda. I would hope the sharp public criticism of this assault on the safety and soundness of our housing market and on access to home ownership is evidence enough that socialism will never prevail, and bureaucratic abuses like this are met with strong resistance and demands for accountability. I am proud to be an original co-sponsor of Mr. Davidson's legislation, the Middle Class Borrower Protection Act. This bill repeals the recent FHFA change to mortgage pricing. It institutes a freeze on any mortgage pricing changes pending a review by the Government Accountability Office, and it makes future mortgage pricing changes subject to the standard public notice and comment period. This will hold the FHFA accountable to the American people. And by the way, the FHFA is supposed to be working for the American people, not the other way around, and to prevent it from ever attempting to enact a credit score redistribution plan, again, to politicize home ownership. I encourage my colleagues on this committee to support its passage in this markup, and I yield to my colleague, Mr. Davidson from Ohio.
I thank the gentleman from Minnesota. Thanks for the co-sponsorship and the support. And frankly, I appreciate the ranking member's concern for affordable housing, not just in urban areas like in her district, but for so much of my district that has rural affordability issues as well. Look, this bill does not stop the FHFA from doing its job as a conservator to help the enterprises get out of their conservatorship. But it does give the opportunity to address a glaring flaw in the approach. Director Thompson highlighted the need to raise additional capital. Supposedly, that's what the point of the higher fees is, to raise more capital for the GSEs. there's no clear understanding of what they were doing, why they were doing it, or how they were doing it. The ranking member highlights, maybe it was to correct unfair things in the housing market. That's not why Director Thompson said they were doing it. They said they were doing it to raise capital. By withdrawing the debt-to-income standard that they launched, they clearly are going to fall short of the capital they thought they were going to raise. They need to go through a process to get their discovery and request for input. And they know that because they did it after the fact, which is the wrong sequence. You do it before the fact. This bill would get that order the right way, and it's just a common sense approach. I hope it stays bipartisan or becomes more so, and I encourage support. I yield back to the gentleman.
And I yield the balance of my time.
The chairman of the Housing Insurance Subcommittee yields back to the Majority Whip. Majority Whip yields back. Is there any further discussion on this bill? Seeing no further discussion or amendments to H.R. 3564, the question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentleman from Ohio, Mr. Davidson. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment in the nature of a substitute is adopted. The question now occurs on ordering the bill, H.R. 3564, as amended, reported to the House with a favorable recommendation. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. All those in favor of a recorded vote, you've been requested. All those in favor, raise your hands. A sufficient number having raised their hands, recorded vote is ordered pursuant to Rule C3, C5 of the committee rules. A vote on this question is postponed.
Mr. Davidson.
Now pursuant to a notice, I call up H.R. 2627, Increasing Investor Opportunities Act. The clerk will report the bill, which was distributed in advance.
H.R. 2627, to amend the investor...
Without objection, the bill is considered read and open to amendment at any point. The gentlewoman from Missouri, Ms. Wagner, the chair of the Capital Markets Subcommittee, is the sponsor of the legislation as amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report.
Amendment in the nature of a substitute to H.R. 2627, offered by Mrs.
Without
Wagner.
objection, the amendment in the nature of a substitute is considered read and will serve as base text for the purpose of amendments. The gentlewoman from Missouri is recognized for 5 minutes to talk about her amendment.
Thank you, Mr. Chairman. Approximately 3 million retail investors rely on closed-end funds whose shares trade on the open market and have some similar traits with ETFs and mutual funds as a source of retirement savings and investment opportunities. Under current SEC staff guidance, closed-end funds may only invest up to 15% of net assets into private funds unless the shares are only sold to, quote, accredited investors, that is, well-off investors. My bill, H.R. 2627, the Increasing Investor Opportunities Act, would eliminate that SEC guidance and provide greater access to the types of investments that private funds hold while maintaining investor protection. When it comes to investor protection, a closed-end fund is subject to the Investment Company Act of 1940, which governs the fund's structure and operations and ensures appropriate public disclosure about funds and their investment objective. These funds are also subject to valuation and disclosure requirements that are overseen by the SEC through examinations and enforcement actions. This legislation gives our Main Street investors access to the types of investments typically reserved for the most wealthy and with the complete protections of our federal securities laws. I want to thank my friend from New York, Mr. Meeks, for his support of this important legislation, and thank Representatives Torres, Scott, and Nickel for partnering with us and co-sponsoring this legislation to ensure retail investors have the choice and access that they deserve when investing for retirement, a child's education, and everything in between. I'd like to submit 5 letters of support, Mr. Chairman, for this legislation from the Investment Company Institute, CARTA, Angel List, the U.S. Chamber of Commerce, and SIFMA.
Without objection, they'll be included in the record.
Thank you, Mr. Chairman. And without further ado, I urge all my colleagues to support this bill, H.R. 2627, the Increasing Investor Opportunities Act, and I yield back.
Gentleman yields back. Is there further debate? The gentleman recognizes the gentlewoman from California. 4 or 5 minutes to strike the last word. Would you like to go to Mr. Meeks? Gentleman from California, New York, Mr. Meeks is recognized for 5 minutes to strike the last word. Mrs. Waters would like you in California, but you're in New York.
It's always great visiting Mrs. Waters in her district, but I'll stay in New York. Thank you, Mr. Chairman. I'd like to strike the last word. And I want to thank my friend from Missouri, Ann Wagner, for her friendship and working with this important legislation in today's markup. It's a bipartisan bill, and as she's indicated, with the support of my colleagues, Mr. Torres, Scott, and Nickel. H.R. 2627 will provide opportunities for enhanced exposure to private funds through closed-end funds, investment vehicles with comprehensive protections under the 1940 Investment Act. These rules include the mandatory requirement that the fund be managed by an investment advisor who is required to conduct due diligence on the fund's investments, answer to independent directors, and adhere to extensive disclosure and reporting requirements. So I'm excited to reintroduce this bipartisan legislation in the 118th Congress because it increases access for people who have been left out of these investment opportunities in the past, while ensuring that robust rules of the road are indeed followed. So I urge all of my colleagues to support this bipartisan legislation and move it out of the committee. I yield back the balance of my time.
The gentleman from New York yields. Is there further debate? The gentlewoman from California is recognized for 5 minutes to strike the last word.
Thank you very much, Mr. Chairman. Seldom do Mr. Meeks and I disagree, but this is one time we will. This bill, I think, would be better entitled Increasing Investor Risk Act because it poses significant risk to retail investors. Currently, closed-end funds, which are a type of mutual fund, are only allowed to invest up to 15% of their assets into private funds. This gives closed-end funds some flexibility to invest in private funds, but establishes a reasonable restriction considering private funds are subject to less regulation and disclosure. This restriction also accounts for the fact that the assets private funds invest in, fledgling startups or distressed companies, are significantly more risky than public securities, and most of their investments fail. This bill would completely eliminate the restriction on closed-end fund investments into private funds, allowing them to invest up to 100%, let me repeat, 100% of its assets into private funds. Moreover, this bill provides zero safeguards to mitigate the new risk created by this blunt deregulation. Again, like all the rest of the capital markets related bills before us today, this bill is opposed by investor groups, consumer and investor advocates, and state regulators. For this reason, I cannot support the bill, and I yield back the balance.
The gentlewoman yields back the balance of her time. Is there further debate? The gentleman from Texas, Mr. Green, seeks recognition.
Thank you, Mr. Chairman. I have an amendment at the desk.
The gentleman has an amendment at the desk. We'll pause while it's distributed.
Mr. Chairman, I reserve a point of order.
I thank the gentleman from New York for a point of order is reserved. The clerk shall report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 26.
Without objection, the amendment will be considered as read. Gentleman from Texas, Mr. Green, is recognized to discuss his amendment for 5 minutes.
Thank you, Mr. Chairman, and I thank my colleagues for making this effort to have this bipartisan legislation move forward. I admire what Ms. Wagner is trying to do. She and I are friends, and we have been successful at getting some things done. However, as written, this piece of legislation allows close-end funds to invest up to all of their assets in private funds. The problem with the bill is that, as written, it creates a pass-through vehicle by which retail investors, that is, one who buys and sells securities for their personal account, those persons who invest in closed-end funds can indirectly now invest in private funds, generally available to only sophisticated, qualified investors. Private fund assets are inherently risky. These risky investments consist primarily of distressed or fledgling companies that have little chance of success. In fact, a recent Harvard Business School study estimated that 75% of venture-backed companies never return cash to their investors. This means that for roughly 3 of every 4 private fund-backed companies you invest in, you lose your entire investment. We should not be creating avenues by which retail investors are exposed to such high probability of loss. If we must do so, however, we should do so in a way that ensures private funds that closed-end funds invest in are subject to retail investor-friendly protections. The Investment Company Act, which applies to publicly registered funds like mutual funds but currently does not apply to private funds, does contain such protections. These include redemption rights, which gives the investor the right to have the fund buy back their shares upon request, liquidity management policies, require the fund to have enough cash on hand to pay their investors back if asked, fair valuation policies, make sure that fund securities are offered at a fair value when no market value is available. My amendment ensures that a closed-end fund may not invest in a private fund unless it determines that private fund has policies in place that are substantially similar to the 3 protections of the Investment Company Act I outlined. In doing so, we affirm that if retail investors are indirectly invest in private funds through closed-end funds, then the closed-end fund should be able to obtain a fair price for its private funds assets and have the ability to recoup its initial investment. Mr. Chairman, let me put aside the written materials and say this. These persons who invest in closed-end funds, if these funds are invested in a private fund, many of them are not sophisticated, and as such, they're not prepared to suffer the loss that might be available or they might incur as a result of the investment. This bill, this amendment would protect them. It does not prevent them, it protects them from the loss. I think it in fact makes Ms. Wagner's legislation a much better piece of legislation. So I would hope that we can agree that protecting investors is our primary aim as it relates to the legislation, or at least one of them. And finally this, when these investors lose their money, they find their way to us. I was here after what happened with Mr. Madoff and the investors who lost money, they came to us. I think that if we don't make this improvement, we will find many investors, after having lost large sums of money, making their way to us, asking why. Why did we allow it? I yield back.
Gentleman's time's expired. The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes to strike the last word.
I move to strike the last word, and I thank the chairman for the time. And I thank my good friend from Texas, Mr. Green, for the spirit of his amendment. We have worked on many pieces of legislation together successfully, and I too am deeply concerned about investor protection. However, this amendment would dramatically reduce the number of investable private funds and does not meet the intention of the bill at all. Investors in closed-end funds currently have full protections of the 1940 Act and other federal security laws. The 1940 Act imposes stringent requirements on closed-end funds that address the goal of this amendment. Closed-end funds are already subject to strict valuation requirements that require funds to periodically price their investments and disclose those prices under board-approved valuation procedures and ongoing board and SEC oversight. These valuations must be in accordance with the 1940 Act and accounting standards. The SEC also recently enhanced fund valuation requirements when it adopted Rule 2A5 under the 1940 Act, which requires that funds periodically assess any material risks associated with determining the fair value of the fund's investments. And this particular rule was finalized last year, and closed-end funds have begun to comply with it. In addition to reporting any valuation risks to the board, a registered investment advisor to a closed-end fund is already required to conduct due diligence on a fund's investments. And this includes assessing the valuation mechanisms of an underlying private fund to ensure that the registered fund can meet its own valuation requirements. This amendment also does not specify whether or not the proposed board-required due diligence would apply to closed-end funds available to retail investors or closed-end funds available only to accredited investors. I'd also like to note that, for instance, pension plans, which have millions of retail investors, may invest in private funds without these restrictions that I have just put forward. Why should closed-end funds, which have registered advisors subject to fiduciary duties, be given more onerous standards? I oppose this amendment, Mr. Chairman, and I yield back the balance of my time.
Gentlewoman yields back. Is there further debate? The ranking member of the full committee, Mrs. Waters, is recognized for 5 minutes to strike the last word.
I move to strike the last word. I thank Mr. Green for offering his amendment to H.R. 2627. It adds a reasonable requirement that ensures retail investors are protected from the dangers of investing in private funds. The unregistered securities offered by private funds are considered very risky for the average investor. So if we're going to give retail investors access to them through closed-end funds, as this bill does, we must do so in a way that makes sure there are proper safeguards in place. This amendment does just that. It ensures closed-end fund managers conduct due diligence in picking private funds that have self-imposed policies and procedures in place that reflect the protections of the Investment Company Act. These protections include redemption rights, liquidity management, and fair valuation procedures. In doing so, we would mitigate risk associated with retail investors having access to private funds. So I thank you and I yield back.
Gentlewoman yields back. Is there any other debate? If not, does the gentleman from New York insist on his point of order? Mr. Lawler, do you insist on your point of order?
No.
I'm not sure that that's a very convincing no, but we'll take it as one. The question now occurs on the amendment as offered from the gentleman from Texas, Mr. Green. All those in favor of the amendment signify by saying aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. A recorded vote has been requested. All those in favor of a recorded vote, raise your hands. Sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to Rule 3, C5 of the committee rules, a vote on the question is postponed. Is there further debate? There being no further amendments, without objection, the previous question is ordered and recorded votes on the amendment have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. Now, pursuant to notice, I call up H.R. 1553, Helping Angels Lead Our Startups, the HALOS Act. The clerk will report the bill, which was distributed in advance.
H.R. 1553, to require the Securities and Exchange Commission.
Without objection, the bill is considered read and open to amendment at any point. The gentleman from New York, Mr. Lawler, the sponsor of the legislation, has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report.
Amendment in the nature of a substitute to H.R. 1553.
Without objection, the amendment in the nature of a substitute is considered as read and will serve as base text for the purpose of amendments. The gentleman from New York, there's an objection heard, ranking member?
Yeah, objection.
What's the objection?
Consider.
The amendment in the nature of substitute will be considered a first-degree amendment for purposes of the amendment.
It was late,
So what?
we'll recognize it.
We'll recognize your objection. The amendment in the nature of substitute will be considered a first-degree amendment for the purposes of amendment.
Thank you very much.
Now, the gentleman from New York is recognized for 5 minutes to discuss his amendment.
Thank you, Mr. Chairman. The state of our economy is still fragile. Inflation has been near or above 5% for months, which rampant government spending has a lot to do with. In New York State, which I represent a portion of, tens of thousands of jobs were lost in the month of April, and overall consumer confidence also dipped. It truly does appear as if our economy is heading in the wrong direction. Small businesses are now facing these turbulent economic times after surviving COVID and having to contend with many regulations which could stifle economic growth, prevent entrepreneurs from achieving their full potential, and frankly, prevent folks from living out their American dream. Entrepreneurs and small businesses drive the American economy. In 2019, the Small Business Administration calculated that close to 44% of our GDP was a result of small businesses. We should be doing everything we can to promote investment, promote entrepreneurship, and foster small business growth, whether it be cutting red tape, providing additional access to capital, or simply getting government out of the way of entrepreneurship. Which is why I asked my colleagues to support my bill, the Helping Angels Lead Our Startups Act, otherwise known as the HALOS Act. The HALOS Act will promote access to investment capital for small companies and ensure that startups can continue to generate buzz and interest and connect with investors. It will do this by ensuring that demo days, pitch competitions, and community economic development events where there is no specific investment offering are not considered general solicitation under Reg D. In doing so, companies will be able to engage with a wider audience of investors and spread word of the products and services that they can offer to help develop a thriving and diverse economy. As former Chairman Hensarling said, our economy works better for all Americans when small businesses can focus on creating jobs rather than navigating bureaucratic red tape. Barriers like the general compliance requirements on general solicitations can reduce opportunities for small businesses, entrepreneurs, and everyday investors, as they both soak up the amount of time and resources needed, but also deter small businesses who are afraid of unintentionally violating these laws. We have seen many successes from and since the passing of the Bipartisan Jobs Act over a decade ago that helped reduce barriers to investment. The HALOS Act is a logical next step on the long road of clarifying and modernizing rules that will enable startups to find the resources they need to grow and thrive. The bill defines an angel investor and clarifies the definition of general solicitation to ensure that startups have the opportunity and ability to discuss their products and business plans at certain events known as demo days. Angel investors not only play a major role in financing individuals' efforts to pursue their dream and start a business, but also often provide a wealth of advice and support to these startups. By facilitating angel investment, we can work towards a stronger, more dynamic economy, lifting up entrepreneurs of all ages, and ensuring they have access to the early capital they require. In addition to driving economic force, angel investors provide, by supporting tens of thousands of small companies per year, long-term impact can be seen as companies such as Amazon, Costco, Facebook, Google, and Starbucks were all initially funded by angel investors. By alleviating burdens on businesses, cutting red tape, and making capital raising in our public markets easier and less costly for emerging companies, not only will we be clearing the way for businesses to expand and develop, but we will also be helping to build a more diverse and inclusive universe of entrepreneurs and founders by expanding opportunities to underrepresented entrepreneurs and communities facing capital formation challenges. The HALOS Act will simply allow folks to get eyes on their businesses and potentially find the vital investor they need to succeed. Once again, I urge all of my colleagues to support this common sense and bipartisan measure to help our small businesses. I yield back my time.
The gentleman yields back. Who seeks recognition?
Mr. Chairman,
The gentlewoman from New York is recognized to strike the last word for 5 minutes.
I move to strike the last word. Thank you, Mr. Chairman. The bill we are considering today, the Helping Angels Lead Our Startup Act, or HALOS Act, makes several changes regarding private placement offerings, which are often utilized by small businesses seeking capital to grow and expand their operations. First, the bill defines an angel investor for the purposes of federal security laws, and second, it also clarifies the definition of general solicitation contained in the Securities Act to ensure that startups can discuss their products and business plans at events known as demo days, without such discussion being considered an investment offering. In other words, demo day organizers will not have to comply with the usual procedures verifying that investors they are attracting to the event are accredited. The last time we considered this legislation in 2017, I offered an amendment on the House floor that would have made two important changes to the bill. First, my amendment would have provided demo day attendees with a disclosure, as prescribed by the SEC, describing the risks of investing in the securities being advertised. Second, my amendment would have ensured that an investor's attendance at the demo day event will not qualify by itself as establishing a pre-existing relationship between an insurer and an investor for the purposes of SEC private placement regulations. Despite the well-intended goal of expanding the use of demo days to better meet startups' capital needs, it is easy to see how unscrupulous actors could exploit this exemption to deceive ordinary people that were drawn to the event by a public advertisement. The changes I was proposing in 2017 were modest and would help strike an appropriate balance between capital formation and investor protection. However, my amendment was resoundingly criticized by House Republicans, many of whom are still on this committee, as being overly broad, unnecessary, and would create yet another SEC-required disclosure and further burden the ability for startups to present their ideas to demo days. But I am glad to see that today, Mr. Lawler and my colleagues on the other side of the aisle have come around to understanding the importance of striking a more appropriate balance between capital formation and investor protection by including my language into the base text of the bill. This language certainly moves the bill in a better direction, yet the bill continues to be overly broad and expands the types of eligible sponsor beyond what the SEC thought was appropriate when they promulgated similar changes in 2020. Additionally, passage of the bill will further accelerate growth in the rapidly expanding and largely unchecked private market. In 2018, issuers were estimated to have raised roughly $2.9 trillion of capital through exempt offerings compared to only $1.4 trillion through public offerings. To help regulate this space, the SEC must update and make reforms to Form D filings, including both prior and upon termination of this offering. When we think of a startup business, the early days of Apple or Google usually come to mind. And as we all know, startups face unique financing challenges. One avenue for securing additional capital is by participating in a demo or pitch day. But helping our small businesses obtain this critical capital must be balanced with the need to include appropriate investor protection and regulation of private markets. As ranking member of the House Small Business Committee and a senior member of this committee, I am committed to getting this combination right. And the draft we are considering today, which includes the language I proposed years ago, is a step in the right direction, but the bill effectively takes not step to regulate the ever-increasing size of our private market. And for that reason, I continue to remain opposed.
Has expired.
I yield back.
Is there further debate? The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
I thank you, Mr. Chairman. I move to strike the last word. I oppose this amendment, and I'd just like to point out that H.R. 1553, the Helping Angels Lead Our Startups, or HALOS Act, that in implementing the Bipartisan Jobs Act of 2012, the SEC classified demo day communications, and those are communications made in connection with an event sponsored by a group or entity that invites issuers to present their businesses to potential investors as a general solicitation. Classifying these communications as a general solicitation limited the regulatory pathways a company could choose for raising money, as certain offering exemptions prohibit the use of general solicitation to market securities. Thankfully, the SEC later reversed course, then it finalized Rule 148. And under the new rule, an issuer is not deemed to have engaged in a general solicitation if the communications are made in connection with an event sponsored by certain specified entities, provided certain conditions and limitations are indeed satisfied. H.R. 1553 simply codifies this position, Mr. Chairman, including the limitations on demo day sponsors' activities, the requirement that the advertising for the event not reference any specific offering of securities by the issuer, and the limitations on information conveyed at the event regarding the offering of securities. A substantially similar version of the bill passed out of the House in the 115th Congress by a vote of 344 to 73, and I had the privilege of supporting that piece of legislation both in committee and in the floor of the House back in the 115th Congress. I will end by just saying that by codifying Rule 148, this bill ensures that issuers may continue to conduct demo days to discuss their products and business plans without such discussions being considered an investment offering in violation of the securities law. With that, Mr. Chairman, I have to oppose this amendment, but I stand in strong support of my good friend from New York, Mr. Lawler's piece of legislation, H.R. 1553, and I yield back.
Gentlewoman yields back. Is there further debate? We'll pause for a minute. Stand by.
The ANS or an amendment?
General debate. Very good. Gentlewoman from Missouri yields back. The chair recognizes the ranking member of the full committee, Mrs. Waters. Strike the last word for 5 minutes.
Thank you. I move to strike the last word. H.R. 5553, sponsored by Mr. Lawler, codifies a controversial Trump-era SEC rule that is opposed by many investor advocates. The bill allows high-risk attempts to tout their businesses in front of unaccredited investors. This currently is prohibited in part because roughly 75% of VC-backed startups fail. The bill would specifically allow angel investors and insurers to market their startup ventures to prospective investors at colleges and nonprofits, including churches. Broadly marketing your securities to the public in this fashion, known as general solicitation, is usually prohibited for private offerings like these because the public nature of the marketing effectively makes the offering itself public and therefore requires registration with the SEC. At universities and churches, students and congregants gather to learn, and they generally trust the information they receive. I don't believe these are spaces where it is appropriate to market highly risky investment opportunities. In my own district, a church was victim of an investment scheme in which an issuer conned the church out of nearly $6 million in securities. I will be offering an amendment to prevent this bill from enabling future frauds like this from happening again. I urge my colleagues to oppose this bill, and I yield back.
Gentlewoman yields back. Who seeks recognition? Is there any other debate? For what purpose does the gentleman from California seek recognition? Gentlewoman has an amendment at the desk. We'll pause while it's distributed. The clerk will report the amendment when she's ready.
I'm ready. I have an amendment at the desk.
Mr. Chairman.
Mr. Sessions.
I reserve point of order.
Point of order has been reserved. Madam Clerk, you ready? Clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 1553.
Without objection, the amendment is considered as read. And the gentlewoman from California is now recognized to discuss her amendment for 5 minutes.
Thank you very much, Mr. Chair. As I alluded to earlier, my home district of California has experienced a recent instance of fraud perpetrated against a church. First Church of God Center of Hope was victim of an investment scheme in which an issuer conned the church out of nearly $6 million in securities. The church had purchased securities with the expectation the funds would be used in a joint venture to buy and sell property for a profit. The church was later informed by the scammer that they would be unable to get their funds back due to how the venture was structured and therefore lost their entire investment. This despicable act could have been prevented and had the law stated that such promotions could not occur at places of religious worship. And so I wrote to then Chair Clayton, raising specific concerns about this investment scam. To my knowledge, the prior administration's SEC didn't follow up on that information. Furthermore, I must also highlight the various stories over the past few years of college students losing thousands of dollars investing in get-rich-quick crypto schemes and overhyped meme stocks. I would hope that we could all agree that students, especially undergraduate students, have enough stress to deal with from high tuition and living expenses that they don't need to also be offered to get quick rich schemes too. Universities and religious institutions are sacred places of learning and worship. We should not make them venues for scam artists and thieves to legally operate. I'm reminded by my grandmother when Jesus found vendors and loan sharks operating in the temple. He stormed in and flipped their tables over and pushed them out. I asked my colleagues across the aisle, in passing this bill, would we be welcoming them back to the sanctuary? Let me just wrap this up by saying the pastor who was conned had a heart attack and died. I don't know for sure whether this was the cause of it, but it was close in relationship to learning that they had lost all the church's money. And so I feel very strongly about this. I yield back the balance of my time.
The gentlewoman yields back. Is there further debate? The gentleman from New York is recognized to strike the last word for 5 minutes.
Thank you, Mr. Chairman. So in looking at the ranking member's amendment, it says, insert, quote, so long as a significant number of attendees of such event are not undergraduate students, end quote, with respect to being able to hold one of these demo days at a college, university, or other institution of higher education. Would the gentlelady yield for a question? What does significant number mean? Yeah, how many is a significant number? Sorry, can you just turn the mic on, please? Thank you.
The definition that you learned in grade school about significant, many, much. That's about what it is.
So would that be like 30 or 15 or 2? I don't know. To be honest with you, I just don't know what it means.
I am reminded that the SEC has the authority to define significant.
Well, why wouldn't we just define it in the bill?
I beg your pardon?
Why wouldn't we just define it?
Because we don't have all that it takes with research and data, et cetera, to come up with a meaning or a definition of it. And it is best done by those who spend their significant time making these kinds of decisions.
Okay, so if the, appreciate your exchange on this. If the student your concern is that a student would get duped or, convinced to invest in a risky scheme, correct? That's your concern in putting this amendment forth?
Repeat it.
Your concern in putting this amendment forth is that a student could get duped or?
Yes, yes.
Okay, so
Yes.
what would be the difference between one student attending versus a significant number? I mean, if your concern is that a student could get duped, I'm not sure why you would allow any students then.
Well, what is your definition of it? What should it be? Tell me.
I don't support your amendment, so.
Oh, good. Then why continue this conversation?
Fair enough. I just wanted to understand what you were trying to gain out of it if you're allowing
This kind of
somebody to come.
discussion will never get you to understand. Let's move on.
I think that's a function of not being able to explain the amendment, but I digress. Look, a college or a university is a place of learning, and allowing for a demo day to occur at a college or a university could be a good thing for these students to actually engage and understand practical, real-world scenarios. And you still have to be an accredited investor. This does not allow for you to actually have a sale. This is saying that you're trying to allow for your product or your business to get exposure. You would still have to do the due diligence after this demo day is over. So to allow this to occur in an institution of higher learning, I don't see the problem. And frankly, your amendment really doesn't make any sense given the fact that your concern is that one individual student could be duped, yet you would allow students to come, but it can't be a significant number, which we can't define what a significant number means. I don't know if that's 2, 5, 10, 30, 50, 100. It's unclear. So that doesn't make much sense. And a place of a religious institution, I mean, obviously, it's unfortunate what occurred at the church in your district. But a lot of people rely on their church as a community center, as a place to congregate, to discuss matters other than faith. I go to churches and synagogues and faith-based community centers all the time to discuss lots of things. Again, it's not interfering with the fact that you would still need to be an accredited investor, and you would still have to go through the process after the fact. So, again, I'm not really clear why we would prevent, a religious institution from being used as a place to have a demo day. So I oppose this amendment and would encourage my colleagues to.
Gentleman's time has expired. Who seeks recognition? If there is no additional debate, I would ask Mr. Sessions of Texas, does he still stand by his point of order?
Mr. Chairman, I'll remove my point of order.
Question now occurs on the amendment offered by the gentlewoman from California, Ms. Waters. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. A recorded vote has been requested. All those in favor of recorded votes, please raise your hands. A sufficient number having raised their hands, a recorded vote is ordered according to Rule 3C5 of the committee rules. A vote on this amendment is postponed. There being no further amendments without objection, the previous question is ordered and recorded votes on the amendment have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. Now, pursuant to notice, I call up H.R. 2622, a bill to amend the Investor Advisors Act of 1940 to codify certain Securities and Exchange Commission no-action letters that exclude brokers and dealers compensated for certain research services from the definition of investment advisor and for other purposes. The clerk will report the bill, which was distributed in advance.
H.R. 2622, to amend the Investment Advisors Act of 1940.
Without objection, the bill is considered read and open to amendment at any point. The gentleman from Texas, Mr. Sessions, the sponsor of the legislation, has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report.
Amendment in the nature of a substitute to H.R. 2620.
Without objection, the amendment in the nature of a substitute is considered read and will serve as, there's an objection heard by the ranking member. The amendment in the nature of a substitute will be considered a first-degree amendment for the purposes of amendment. And Mr. Sessions is recognized for 5 minutes to explain his amendment.
Mr. Chairman, thank you very much, and I'm asking for the committee's support of this amendment and the substitute and the additions that we will soon hear about to H.R. 2622. Mr. Chairman, this bill is necessary because the Securities and Exchange Commission suddenly decided to withdraw a non-action letter issued in response to the EU's Markets and Financial Instruments Directive number 2. This action will necessarily disrupt markets and create transparency without any benefit to investor protection. Mr. Chairman, what are we talking about here? What we're talking about here is that broker-dealers under what would be the EU are now prohibited from bundling research and trading costs and therefore must accept hard dollar payments for research. However, doing so would require broker-dealers who are already regulated to register as investment advisors with the SEC, a costly and unnecessary step that would change the way things are done today to formalize themselves with the EU. The bottom line to this is that we believe that this is unnecessary. We believe the marketplace allows, understands, and has for all these years understood its part and place and how important it is. And so I would say that I have been working with the American Securities Association. Mr. Chairman, I would ask that their letter in support of this would be in the record. And it offers not only explanation.
Without objection.
Thank you very much. It also offers insight into not only doing business, but the importance of doing business under this in order to make sure that we continue moving. I would yield back I would ask for the support, and I move back my time.
Gentleman from Texas yields back. Is there anyone else who seeks recognition? Would anybody care to strike the last word? If not, the chair shall pause.
So Gottheimer wants.
Okay. The chair would like to welcome the gentleman from New Jersey to the markup.
Madam
And-
Chair, I have an amendment at the desk.
We will pause while the amendment is distributed.
Thank you.
Mr. Gottheimer.
Mr. Chairman.
Okay, have all members received a copy of the amendment? The clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 2622.
Without objection, the reading of the amendment is disposed with. And the gentleman is recognized, the gentleman from New Jersey is recognized on his amendment.
Thank you, Madam Chairwoman, and thank you, Ranking Member Waters. My colleague, Congressman Sessions, and I have been working together on this issue for some time, and I'm very grateful for his very constructive work, friendship, and his team who has worked so diligently with our team. This bipartisan legislation draws attention to serious issues that have been brought to light, in large part from the European Union, following their enactment of the Markets in Financial Instruments Directive, commonly referred to as MiFID II. I think I speak for all members of this committee when I say that transparency and competition are essential to the sound operation of American financial markets, and all necessary steps should be taken to protect consumers by providing access to the information that allows them to make the best investment decisions. The Securities and Exchange Commission realized in the run-up to Europe's implementation of MiFID II that the approach taken by the Europeans created friction with U.S. securities laws that needed to be addressed. Particularly, it would impact research firms covering small public companies that rely on research to draw investments that allow them to grow, create jobs, and compete in competitive markets. This amendment will provide a temporary extension of the SEC's MiFID II no-action letter and require the SEC to conduct a study on the potential implications of its expiration. The SEC is also asked to evaluate possible avenues to avoid negative outcomes, as well as options to increase cost transparency for market research. The SEC should take thoughtful action using existing authorities to address the concerns raised by market participants regarding MiFID II. This bipartisan amendment will head off potential negative impacts, and I encourage my colleagues to support this bipartisan amendment. And I yield back.
Gentleman yields back. Is there further debate on the amendment? Gentlelady, the ranking member is recognized for 5 minutes.
I move to strike the last word. Madam Chair, I do have concerns about H.R. 2622 and how it impacts U.S. investors. The overarching thing the bill does is codify, in other words, permanently extend a Trump-era SEC order known as the No Action Letter. That order exempts U.S. brokers who accept direct payment for research services from their European customers, which include asset managers from needing to register as investment advisors under the Advisors Act. The primary problem this creates is that these asset managers then turn around and shift their research expenses from their European customers to their U.S.-based customers, which includes pension fund and mutual fund investors. Because they still pay for research and trading as one bundle, these U.S. pension and mutual fund investors can't see how much they're actually being charged for the research, which is often far too much. Mr. Gottheimer's amendment would extend the SEC's order by 6 months and also direct the SEC to conduct a balanced study to examine the impacts of a permanent extension of this no-action letter, and in the alternative, letting it expire as the SEC originally intended. So I also want to point out that I am very pleased that Mr. Gottheimer worked with the staff from the opposite side of the aisle to come to this agreement. And it basically shows that we're willing to work together when there's an opportunity for us to be able to both support legislation that we think makes good sense and it doesn't do any harm. So Mr. Gottheimer has done that. Our members over here have worked very hard today, and we have been in opposition to much of what you all have put forth. but I look forward to the opportunities for us to try and work together and come to agreements on this type of amendment. And that's how you get legislation done and achieve a bipartisan result that has a real chance of passing the House. So I urge my colleagues to vote yes on this amendment.
The ranking member yields back. Is there further debate on the amendment? Seeing none, the question now occurs on the amendment offered by the gentleman from New Jersey, Mr. Gottheimer. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. And the amendment is agreed to. Does anybody else seek recognition? There being no further discussion or amendments to H.R. 2622, the question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from Texas, Mr. Sessions. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. And the amendment in the nature of a substitute is adopted. The question now occurs on ordering the bill, H.R. 2622, as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it.
Madam Chairman, I'd like to ask for a recorded vote.
Here we are. Okay, all those in favor of a recorded vote, raise their hand. A sufficient number having raised their hand, a recorded vote is ordered, and the clerk does not need to call the roll. A recorded vote is ordered. Pursuant to Rule 3, C5 of the committee rules, a vote on this question is postponed. Now, pursuant to notice, I call up H.R. 3063, the Retirement Fairness for Charities and Educational Institutions Act. The clerk will report the bill.
H.R. 3063, to amend the federal securities laws to enhance 403B plans. And
without objection, the bill is considered read and open to amendment at any point.
Madam Chair,
Yes.
I move to strike the last word because I have an amendment on the desk.
The gentlewoman has an amendment at the desk. We'll pause for the amendment to be distributed.
Oh, 30.
Oh, you didn't read it?
I did.
What is it? What is it? What is it? What is it?
Madam Chair, I can withdraw my motion and refer back to
I thank the gentlelady from Texas for withdrawing her motion.
I will re-urge it at the appropriate time.
I appreciate that from the gentlelady from Texas. Now, I recognize the gentleman from Oklahoma to speak on his bill.
Thank you, Madam Chair. And I believe we draw to the last bill of the markup, which is in itself always a wonderful experience after a day of actively legislating. Let's talk for a moment about H.R. 3063. And one of the most difficult decisions that a worker will ever undertake is determining how to save for retirement. This requires an individual to forecast decades into the future, ensuring one has the ability to navigate through life, family, and economic events. For many healthcare workers, teachers, and nonprofit employees, their retirement savings are through a 403B plan. However, those public servants in the 403B plans are unable to invest in the same cost-effective investment products that are available to all other plans, including 401K plans, government 457B plans, and the federal thrift savings plan. Since the creation of 403B retirement plans back in 1958, there have been many changes to how we save for retirement, both in the law and in the overall economy. My bill, the Retirement Fairness for Charities and Educational Institutions Act of 2023, will allow 403B plans the ability to invest in collective investment trust, or CITs, and insurance company separate accounts. CITs and insurance company separate accounts are both pooled investment vehicles sponsored and maintained by a bank or a trust company or an insurance company, respectively. This measure originated in Secure 2.0 last Congress, which passed the Ways and Means Committee unanimously under Chairman Richie Neal. The Secure 2.0 Act that ultimately became law included the required changes to the tax code, but not the necessary changes to security law. According to data from the Investment Company Institute, over the past 10 years, total assets in 403B plans increased by only 46%, while 401K plans increased by 88%, and government 457B plans increased by 82%. We have for too long limited the investment options made available to public servants, and this bill will allow for much-needed consistency across retirement plans. I'd like to thank the bill's bipartisan co-sponsors on this committee: Congressman Gottheimer, Congressman Barr, Congressman Foster, Congressman Nunn, Congressman Nickel, Congressman Flood, Congressman Lawler. I urge my colleagues to support the bill, and I yield back, Madam Chair.
The gentleman from Oklahoma yields back. And now I would say that it is time for us to move that the gentleman from Oklahoma, Mr. Lucas, the sponsor of the legislation, does have indeed an amendment in the nature of a substitute, I think copies of which were distributed in advance, and the clerk will report.
Amendment in the nature of a substitute to H.R. 3063.
Without objection, the amendment in the nature of a substitute is considered as read and will serve as base text for proposed of amendments. Gentlelady has an objection. The amendment in the nature of a substitute will be considered a first-degree amendment for purposes of amendment. Gentleman from Oklahoma is recognized for 5 minutes.
Thank you, Madam Chair. I would just simply say the lack of parity between 403B retirement plans and other plans is most evident in the numbers. Looking at the most recent data from the Investment Company Institute, we compare the performance across retirement plans. In the past 5 years, assets held in 401K plans increased by 20%. Assets held in 457 plans increased by 20%. The thrift savings plan assets, which members of Congress also participate in, increased by 30%. 403B plans increased by just 12%. The disparity is truly astonishing and underscores the importance of putting 403B plans on the same playing field with other retirement plans. With that, I yield back, Madam Chair.
Gentleman from Oklahoma yields back. Is there any further debate?
Madam Chair, I seek recognition to strike the last word.
The gentleman from North Carolina is recognized.
Thank you, Madam Chairwoman. I'm proud to be a co-sponsor of H.R. 3063, the Retirement Fairness for Charities and Educational Institutions Act. I want to thank Mr. Lucas and Mr. Foster for their leadership on this bill. The bill lowers the cost of retirement for public sector employees like our hardworking teachers, nurses, janitors, and charity workers. Many Americans working in jobs like these have 403B retirement plans and are currently denied access to low-cost investments, like collective investment trusts available to private workers with 401K plans. There's no reason the people teaching our children and caring for our sick are paying millions more in investment costs than private sector employees. Our bill addresses this inequity by providing parity for workers in public education institutions, nonprofit hospitals, universities, and other charitable and educational organizations. They should have the same retirement choices as everyone else. President Peter Hans of the University of North Carolina System sent a letter to the committee supporting our bill. Madam Chairwoman, without objection, I'd like to enter this letter into the record.
Without objection.
President Hans says that our bill would allow UNC to, quote, pass substantial savings on to our university employees who deserve the best retirement we can give them. end quote. At a time when working families are being crunched by rising costs, it's essential that we do everything we can to empower them to save for retirement. Some estimates show that the cost savings to 403B participants from this bill could be roughly $250 million a year. I encourage my colleagues to vote yes on H.R. 3063, and I yield back the remainder of my time.
Gentleman from North Carolina yields back. Is there any further debate? Now, for what purposes does the gentlelady from Texas, Ms. Garcia, seek recognition?
Madam Chair, I have an amendment at the desk.
We will pause while the amendment is distributed. Have all members received a copy of the amendment? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 36.
Without objection, the reading of the amendment is dispensed with. The gentlewoman is recognized on her amendment.
Thank you, Madam Chair, and my amendment seeks to continue this glorious moment of having the last bill on the markup. And my amendment it really seeks to better achieve the underlying goal of Mr. Lucas's bill, as I understand it, which is true parity between the 401K and 403B plans. I thank Mr. Lucas for his work on this bill because I understand its core mission. Of course, I believe that we all want to ensure robust retirement plans for our nature's teachers, hospital workers, and so many other public employees. However, I am concerned that this bill would create far too much risk in 403B plans because it would remove meaningful safeguards. As members know, 401K, while exempt under securities laws, are subjected to the Employee Retirement Income Security Act of 1975, also known as ERISA. These 401K ERISA plans afford protections to the investor by requiring plan administrators and fiduciaries to act with the best interests of the plan holder in mind. These protections are valuable and market tested and are examined and enforced by a federal agency. In other words, 401K ERISA plans have enough federal oversight to keep hardworking Americans' money safe and sound. So my amendment would simply establish parity between 401K plans and 403B plans to allow 403B plans that are either ERISA plans or government plans to invest in the unregistered collective investment trusts and unregistered variable annuities. In simpler terms, my amendment would keep the intention of the underlying bill, but only allow a relaxing of regulations on 403B plans that are also ERISA plans. This way, our nation's school teachers, who most often utilize 403B plans, have enough federal safeguards in place to keep their money safe. The goal is simple. Now that we're proposing to deregulate 403B plans out of SEC's investor protection framework, we must ensure that the same retirement protections available to 401K investors and plan participants are also available to our public school teachers and workers. I encourage my colleagues to support this amendment, and I yield back the balance of my time.
Gentlelady from Texas yields back. Is there any further debate?
Madam Chair, strike the last word.
The gentleman is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. This amendment would compromise the underlying purpose of the bill, which is to provide parity to public servants that participate in these plans. The underlying legislation requires that these financial products are only available when there is an institutional plan sponsor overseeing the 403B investments. This is identical to all other retirement plans. Either an ERISA fiduciary, a state or local government entity, or an employer agreed to take on the fiduciary status must sponsor or oversee a 403B plan. For example, 403B plans offered by state and local governments, such as for public schools or universities, are not covered by ERISA. Just as with ERISA plan sponsors, the state and local government must screen these investments. Further, all of the government retirement plans are currently permitted to offer these investment products, even though they're not under ERISA, such as 457B plans for state and local government employees. Even in the case of non-ERISA plans, the SEC retains strict oversight of these investments, and in addition to the state laws that regulate government retirement plans, those laws regulate how investment options are chosen, which state officials are authorized to seek the investments, what qualifications those officers must have, and how frequently the investments are reviewed. Carving out non-ERISA plans fails to recognize fiduciary responsibilities already in place, and again, does not reconcile the fact that non-ERISA plans currently have access to these financial products in other retirement plans. If there is a debate concerning which plans should and should not be subjected to ERISA, that debate should exist elsewhere. I respectfully urge my colleagues to oppose this amendment, and let's pass a bill that will create a level playing field for nurses, teachers, social workers, and other employees of non-charitable, nonprofit charities. With that, I yield back, Madam Chair.
Gentleman from Oklahoma yields back. For what purpose does the gentlelady from California, Ms. Waters, seek recognition?
I move to strike the last word.
Gentlewoman is recognized for 5 minutes to strike the last word.
Madam Chairwoman, I rise to offer my support for Ms. Garcia's important amendment. She happens, I think, to be right on this. If our goal is to create parity between 401 and 403B plans in terms of their access to similar investment products, then we should also carry over the federal or state-based protections available for 401K plan participants and working families. I had an opportunity to speak briefly with Mr. Lucas about this bill, and I think his intentions are very good. And he's worked very hard because he believes that this bill is not only important, but he thinks that this will help some of the people that Ms. Garcia is concerned about to be able to invest and to be able to increase their wealth. And so, unfortunately, I won't be able to support it, but I commend you for trying. Thank you. So now with that, again, Madam Chair, as you know, and as Ms. Garcia described, all 401K plans are ERISA plans. ERISA plans are administered under the Employee Retirement Income Security Act of 1975, and their sponsors are examined and held accountable by DOL's Employee Benefit Security Administration. Now, these are the plans that Mr. Lucas' bill would deregulate. That is the 403B plans, which have grown enormously in recent years to now have roughly $1.3 trillion under their management. The bill would permit financial products that are not SOC registered and regulated to be sold to public school teachers. And while certainly Mr. Lucas cares about public school teachers, I want to tell you, Ms. Garcia really cares about public school teachers and spends a lot of time talking to me and others about what we can do to increase their pay so that they can be paid adequately for the job that they do. She's concerned about their safety in the schools and the fact that not only are children the targets of violence, but the teachers are too, but they still come to school every day to educate our children. So nobody cares more about the teachers than Ms. Garcia. So Ms. Garcia's amendment would mitigate the risks here and afford the same protections available for 401K plan participants to 403B plan participants. So I support this very sensible and measured approach. I would urge all of my colleagues to vote for it.
Will the gentlelady yield?
Yes, I yield to the gentlelady from Texas.
Thank you, Madam Ranking Member. You're absolutely right. We want parity, but we want parity with protection to make sure that our teachers and public employees don't suffer any losses. And I just wanted to point out that this amendment applies to those plans that are not ERISA and not government. Does not apply to not government and only to the not ERISA. So I think the gentleman is kind of reading this too broadly. So I urge my colleagues to vote for this amendment.
You yield back?
I yield back to
Does the
Ms.
ranking
Waters.
member yield back?
I yield back the balance of.
The ranking member yields back the balance of her time. Is there any further debate on the amendment? Seeing none, the question now occurs on the amendment offered by the gentlelady from Texas, Ms. Garcia. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the nays appear to have it.
Recorded vote is requested.
A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to Section C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Is there further amendment or discussion? All right. There being no further amendments, without objection, the previous question is ordered, and recorded votes on the amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measures. Pursuant to the chair's earlier notice, we will take recorded votes on those postponed amendments and then move to the question on reporting. The committee is now going to stand in recess until 5:30 p.m.
Okay, all right, okay.
Hi, Todd. I already yelled at Wally.
So he did.
One vote series, and then we would do four votes. And then just three. It turns into four votes. Because then we have the six passages.
The committee will come to order. Committee will come to order. A quorum being present, will now resume proceedings on the postponed measures. Committee will take votes on the postponed amendments to H.R. 3556, the Increasing Financial Regulatory Accountability and Transparency Act. We're going to, with the comedy of our ranking member, we're going to en bloc several of these amendments, and we're going to take up first Mr. Caston, Amendment 1. The question on the amendment offered by the gentleman from Illinois. The clerk will call the roll. Now, do you want me to read all the ones that we're doing that to? These are the ones we're en blocking. No. First, okay. Clerk will call the roll on Caston Amendment number 1.
Mr. Lucas? No. Mr. Lucas votes no. Mr. Sessions? Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Luetkemeyer? Mr. Luetkemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams of Texas? Mr. Williams of Texas votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose? Mr. Rose votes no. Mr. Stile? Mr. Stile votes no. Mr. Timmons? Mr. Timmons votes no. Mr. Norman? Mr. Norman votes no. Mr. Muser? Mr. Muser votes no. Mr. Fitzgerald? Mr. Fitzgerald votes no. Mr. Garbarino? Mr. Garbarino votes no. Mrs. Kim? Mrs. Kim votes no. Mr. Donalds? Mr. Donalds votes no. Mr. Flood? Mr. Flood votes no. Mr. Lawler? Mr. Lawler votes no. Mr. Nunn? Mr. Nunn votes no. Ms. De La Cruz? Ms. De La Cruz votes no. Mrs. Houchin? Mrs. Houchin votes no. Mr. Ogles? Mr. McHenry? Mr. McHenry votes no. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gonzalez?
Aye.
Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Tlaib? Ms. Tlaib votes aye. Mr. Torres?
Aye.
Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas? Mr. Gottheimer?
Is there any member who hasn't voted or wishes to change their vote? The clerk will report.
Mr. Chairman, on this vote, the ayes are 21 and the nays are 26.
A majority having voted against the amendment is not agreed to. We'll take up Mrs. Waters' Amendment number 1. The question on the amendment offered by the gentlewoman from California. The clerk will call the roll.
Mr. Lucas? Mr. Lucas votes no. Mr. Sessions? Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Luetkemeyer? Mr. Luetkemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams of Texas? Mr. Williams of Texas votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose? Mr. Rose votes no. Mr. Stile? Mr. Stile votes No. Mr. Timmons? Mr. Timmons votes no. Mr. Norman? Mr. Norman votes no. Mr. Muser? Mr. Muser votes no. Mr. Fitzgerald? Mr. Fitzgerald votes no. Mr. Garbarino? Mr. Garbarino votes no. Mrs. Kim? Mrs. Kim votes no. Mr. Donalds? Mr. Donalds votes no. Mr. Flood? Mr. Flood votes no. Mr. Lawler? Mr. Lawler votes no. Mr. Nunn? Mr. Nunn votes no. Ms. De La Cruz? Ms. De La Cruz votes no. Mrs. Houchin? Mrs. Houchin votes no. Mr. Ogles? Mr. McHenry? Mr. McHenry votes no. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Aye. Mr. Gottheimer votes aye. Mr. Gonzalez?
Aye.
Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas?
Is there any member who hasn't voted or wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 26.
A majority having voted against the amendment is not agreed to. We'll now take up Mrs. Waters' amendment number 2. The question is on the amendment offered by the gentlewoman from California.
Mr. Lucas?
Clerk will call the roll.
Mr. Lucas votes no. Mr. Sessions? Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Luetkemeyer? Mr. Luetkemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams of Texas? Mr. Williams of Texas votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose? Mr. Rose votes no. Mr. Stile? Mr. Stile votes no. Mr. Timmons? Mr. Timmons votes no. Mr. Norman? Mr. Norman votes no. Mr. Muser? Mr. Muser votes no. Mr. Fitzgerald? Mr. Fitzgerald votes no. Mr. Garbarino? Mr. Garbarino votes no. Mrs. Kim? Mrs. Kim votes no. Mr. Donalds? Mr. Donalds votes no. Mr. Flood? Mr. Flood votes no. Mr. Lawler? Mr. Lawler votes no. Mr. Nunn? Mr. Nunn votes no. Ms. De La Cruz? Ms. De La Cruz votes no. Mrs. Houchin? Mrs. Houchin votes no. Mr. Ogles? Mr. McHenry? Mr. McHenry votes no. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty? Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas? Mr. Gonzalez? Mr. Gonzalez votes aye.
Is there any member who hasn't voted or wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 26.
A majority having voted against the amendment is not agreed to. We'll now proceed to Mr. Green, Amendment Number 2. The question is on the amendment offered by the gentleman from Texas. The clerk will call the roll.
Mr. Lucas? No. Mr. Lucas votes no. Mr. Sessions? Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Luetkemeyer? Mr. Luetkemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams? Mr. Williams votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose? Mr. Rose votes no. Mr. Stile? Mr. Stile votes no. Mr. Timmons? Mr. Timmons votes no. Mr. Norman? Mr. Norman votes no. Mr. Muser? Mr. Muser votes no. Mr. Fitzgerald? Mr. Fitzgerald votes no. Mr. Garbarino? Mr. Garbarino votes no. Mrs. Kim? Mrs. Kim votes no. Mr. Donalds? Mr. Donalds votes no. Mr. Flood? Mr. Flood votes no. Mr. Lawler? Mr. Lawler votes no. Mr. Nunn? Mr. Nunn votes no. Ms. De La Cruz? Ms. De La Cruz votes no. Mrs. Houchin? Mrs. Houchin votes no. Mr. Ogles? Mr. McHenry? Mr. McHenry votes no. Mrs. Waters? Mrs. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Aye. Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas?
Is there any member who has not voted or wishes to change their vote? The clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 26.
A majority having voted against the amendment is not agreed to. Without objection, the remaining 4 amendments to H.R. 3556 will be considered en bloc. I was expecting applause at that point. What is that word? What is it? The question now occurs on the en bloc. The clerk will call the roll.
Mr. Lucas? Mr. Lucas votes no. Mr. Sessions? Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Luetkemeyer? Mr. Luetkemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams of Texas? Mr. Williams of Texas votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose? Mr. Rose votes no. Mr. Stile? Mr. Stile votes no. Mr. Timmons? Mr. Timmons votes no. Mr. Norman? Mr. Norman votes no. Mr. Muser? Mr. Muser votes no. Mr. Fitzgerald? Mr. Fitzgerald votes no. Mr. Garbarino? Mr. Garbarino votes no. Mrs. Kim? Mrs. Kim votes no. Mr. Donalds? Mr. Donalds votes no. Mr. Flood? Mr. Flood votes no. Mr. Lawler? Mr. Lawler votes no. Mr. Nunn? Mr. Nunn votes no. Ms. De La Cruz? Ms. De La Cruz votes no. Mrs. Houchin? Mrs. Houchin votes no. Mr. Ogles? Mr. McHenry? Mr. McHenry votes no. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas?
Is there any member who hasn't voted or wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 26.
A majority having voted against the amendment is not agreed to. The question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentleman from Mr. Kentucky, Mr. Barr. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it.
Recorded vote?
A recorded vote on the ANS?
Oh, sorry.
So,
Withdraw, sorry.
you withdraw your request? The request on the ANS has been withdrawn. The question now occurs on ordering the bill H.R. 3556 as amended. Reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay.
No.
In the opinion of the chair, the ayes have it.
Recorded vote.
All those in favor of a recorded vote, raise their hand. A sufficient number having raised their hand, a recorded vote is ordered, and the clerk will call the roll.
Mr. Lucas? Yes. Mr. Lucas votes aye. Mr. Sessions? Mr. Sessions votes aye. Mr. Posey? Mr. Posey votes aye. Mr. Luetkemeyer? Mr. Luetkemeyer votes aye. Mr. Huizinga? Mr. Huizinga votes aye. Mrs. Wagner? Mrs. Wagner votes aye. Mr. Barr? Mr. Barr votes aye. Mr. Williams? Mr. Williams votes aye. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes aye. Mr. Mooney? Mr. Davidson? Mr. Davidson votes aye. Mr. Rose? Mr. Rose votes aye. Mr. Stile? Mr. Stile votes aye. Mr. Timmons? Mr. Timmons votes aye. Mr. Norman? Mr. Norman votes aye. Mr. Muser? Mr. Muser votes aye. Mr. Fitzgerald? Mr. Fitzgerald votes aye. Mr. Garbarino? Mr. Garbarino votes aye. Mrs. Kim? Mrs. Kim votes aye. Mr. Donalds? Mr. Donalds votes aye. Mr. Flood? Mr. Flood votes aye. Mr. Lawler? Mr. Lawler votes aye. Mr. Nunn? Mr. Nunn votes aye. Ms. De La Cruz? Ms. De La Cruz votes aye. Mrs. Houchin? Mrs. Houchin votes aye. Mr. Ogles? Mr. McHenry? Mr. McHenry votes aye. Ms. Waters? Ms. Waters votes no. Mrs. Velasquez? Mrs. Velasquez votes no. Mr. Sherman? Mr. Sherman votes no. Mr. Meeks? No. Mr. Meeks votes no. Mr. Scott? No. Mr. Scott votes no. Mr. Lynch? Mr. Lynch votes no. Mr. Green? Mr. Green votes no. Mr. Cleaver? No. Mr. Cleaver votes no. Mr. Himes? No. Mr. Himes votes no. Mr. Foster?
No.
Mr. Foster votes no. Mrs. Beatty?
No.
Mrs. Beatty votes no. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes no. Mr. Gonzalez? Mr. Gonzalez votes no. Mr. Caston? Mr. Caston votes no. Ms. Presley? Ms. Presley votes no. Mr. Horsford? Mr. Horsford votes no. Ms. Talib? Ms. Talib votes no. Mr. Torres? Mr. Torres votes no. Ms. Garcia?
No.
Ms. Garcia votes no. Ms. Williams?
Williams of Georgia votes no.
Ms. Williams votes no. Mr. Nickel? Mr. Nickel votes no. Ms. Pedersen? Ms. Pedersen votes no. Mr. Chairman? Mr. Chairman votes aye. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas?
Is there any member who wishes to change their vote? The clerk will report.
Mr. Chairman, on this vote, the ayes are 26 and the nays are 22.
3556 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. The committee will now take recorded votes on ordering the bill H.R. 3564 as amended, reported to the House with a favorable recommendation. The clerk will call the roll.
Mr. Lucas. Aye. Mr. Lucas votes aye. Mr. Sessions. Mr. Sessions votes aye. Mr. Posey. Mr. Posey votes aye. Mr. Lukemeyer. Mr. Lukemeyer votes aye. Mr. Huizinga. Mr. Huizinga votes aye. Mrs. Wagner. Mrs. Wagner votes aye. Mr. Barr. Mr. Barr votes aye. Mr. Williams. Mr. Williams votes aye. Mr. Emmer. Mr. Loudermilk. Mr. Loudermilk votes aye. Mr. Mooney. Mr. Davidson. Mr. Davidson votes aye. Mr. Rose. Mr. Rose votes aye. Mr. Stile. Mr. Stile votes aye. Mr. Timmons. Mr. Timmons votes aye. Mr. Norman. Mr. Norman votes aye. Mr. Muser. Mr. Muser votes aye. Mr. Fitzgerald. Mr. Fitzgerald votes aye. Mr. Garbarino. Mr. Garbarino votes aye. Mrs. Kim. Mrs. Kim votes aye. Mr. Donalds. Mr. Donalds votes aye. Mr. Flood. Mr. Flood votes aye. Mr. Lawler. Mr. Lawler votes aye. Mr. Nunn. Mr. Nunn votes aye. Ms. De La Cruz. Ms. De La Cruz votes aye. Mrs. Houchin. Mrs. Houchin votes aye. Mr. Ogles. Mr. McHenry. Aye. Mr. McHenry votes aye. Ms. Waters. No. Ms. Waters votes no. Mrs. Velasquez. No. Mrs. Velasquez votes no. Mr. Sherman. No. Mr. Sherman votes no. Mr. Scott. No. Mr. Scott votes no. Mr. Meeks. No. Mr. Meeks votes no. Mr. Lynch. No. Mr. Lynch votes no. Mr. Green. Mr. Green votes no. Mr. Cleaver. No. Mr. Cleaver votes no. Mr. Himes. No. Mr. Himes votes no. Mr. Foster.
No.
Mr. Foster votes no. Mrs. Beatty.
No.
Mrs. Beatty votes no. Mr. Vargas. Mr. Gottheimer. Mr. Gottheimer votes no. Mr. Gonzalez. Mr. Gonzalez votes no. Mr. Caston. Mr. Caston votes no. Ms. Presley. Ms. Presley votes no. Mr. Horsford. Mr. Horsford votes no. Ms. Talib. Ms. Talib votes no. Mr. Torres. Mr. Torres votes no. Ms. Garcia.
No.
Ms. Garcia votes no. Ms. Williams.
Williams of Georgia votes no.
Ms. Williams votes no. Mr. Nickel. Mr. Nickel votes no. Ms. Pedersen. Ms. Pedersen votes no. Mr. Chairman. Mr. Chairman votes aye. Mr. Emmer. Mr. Mooney. Mr. Ogles. Mr. Vargas.
Is there any member who has not voted? Is there any member who wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 26 and the nays are 22.
A majority having voted in favor of H.R. 3564 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Committee will now take the votes postponed on amendments to H.R. 2627, sponsored by the gentlewoman from Missouri, Mrs. Wagner. First vote is on the Mr. Green Amendment Number 1. The question is on the amendment offered by the gentleman from Texas. Clerk will call the roll.
No. Mr. Lucas votes no. Mr. Sessions. Mr. Sessions votes no. Mr. Posey. Mr. Posey. Mr. Posey votes no. Mr. Lukemeyer. Mr. Lukemeyer votes no. Mr. Huizinga. Mr. Huizinga votes no. Mrs. Wagner. Mrs. Wagner votes no. Mr. Barr. Mr. Barr votes no. Mr. Williams. Mr. Williams votes no. Mr. Emmer. Mr. Loudermilk. Mr. Loudermilk votes no. Mr. Mooney. Mr. Davidson. Mr. Davidson votes no. Mr. Rose. Mr. Rose votes no. Mr. Stile. Mr. Stile votes no. Mr. Timmons. Mr. Timmons votes no. Mr. Norman. Mr. Norman votes no. Mr. Muser. Mr. Muser votes no. Mr. Fitzgerald. Mr. Fitzgerald votes no. Mr. Garbarino. Mr. Garbarino votes no. Mrs. Kim. Mrs. Kim votes no. Mr. Donalds. Mr. Donalds votes no. Mr. Flood. Mr. Flood votes no. Mr. Lawler. Mr. Lawler votes no. Mr. Nunn. Mr. Nunn votes no. Ms. De La Cruz. Ms. De La Cruz votes no. Mrs. Houchin. Mrs. Houchin votes no. Mr. Ogles. Mr. McHenry. Mr. McHenry votes no. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Vargas?
Is there any member who hasn't voted or wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 26.
The majority have voted against the amendment. The amendment is not agreed to. The question now will occur on the adoption of the amendment in the nature of a substitute offered by the gentlewoman from Missouri, Mrs. Wagner. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment in the nature of a substitute is adopted. The question now occurs on ordering the bill, H.R. 2627, as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. Mrs. Wagner. Gentlewoman has asked for a recorded vote. All those in favor of a recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. The clerk will call the roll.
Mr. Lucas?
Aye.
Mr. Lucas votes aye. Mr. Sessions? Aye. Mr. Sessions votes aye. Mr. Posey? Mr. Posey votes aye. Mr. Lukemeyer? Mr. Lukemeyer votes aye. Mr. Huizinga? Mr. Huizinga votes aye. Mrs. Wagner? Mrs. Wagner votes aye. Mr. Barr? Mr. Barr votes aye. Mr. Williams? Mr. Williams votes aye. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes aye. Mr. Mooney? Mr. Davidson? Mr. Davidson votes aye. Mr. Rose? Mr. Rose votes aye. Mr. Stile? Mr. Stile votes aye. Mr. Timmons? Mr. Timmons votes aye. Mr. Norman? Mr. Norman votes aye. Mr. Muser? Mr. Muser votes aye. Mr. Fitzgerald? Mr. Fitzgerald votes aye. Mr. Garbarino? Mr. Garbarino votes aye. Mrs. Kim? Mrs. Kim votes aye. Mr. Donalds? Mr. Donalds votes aye. Mr. Flood? Mr. Flood votes aye. Mr. Lawler? Mr. Lawler votes aye. Mr. Nunn? Mr. Nunn votes aye. Ms. De La Cruz? Ms. De La Cruz votes aye. Mrs. Houchin? Mrs. Houchin votes aye. Mr. Ogles? Mr. McHenry? Aye. Mr. McHenry votes aye. Ms. Waters? Ms. Waters votes no. Mrs. Velasquez? Mrs. Velasquez votes no. Mr. Sherman? Mr. Sherman votes no. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Aye. Mr. Himes votes aye. Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman?
Aye.
Mr. Chairman votes aye.
The gentleman from Massachusetts. How's the gentleman from Massachusetts recorded? If the gentleman from Massachusetts would suspend a minute, let's make sure we got our account right, and then we'll go back and ask for clarification.
Mr. Lynch? you are recorded as voting aye. Mr. Lynch, off aye, on no.
Green from Texas.
Green of Texas. How's the chairwoman recorded? I mean, the ranking member recorded.
Ms. Waters, you are recorded as no.
Mr. Green, off yes, on no, is that right? All right, one at a time. I see that everybody voted wrong on the Democratic side, I'm sorry. All right, let's do this in an orderly way. Raise your hand for recognition. Mr. Cleaver.
How am I recorded?
Mr. Cleaver, you are recorded as voting aye.
I voted previously with Mr. Green, so I vote no.
Mr. Cleaver, off aye, on no.
Who else seeks recognition? Ms. Beatty?
Ms.
I'd like to change my vote from a yes to a no.
Ms. Beatty, off aye, on no.
Ms. Presley?
Off aye, on no.
Ms. Presley, off aye, on no.
Ms. Talib?
Off aye, on no.
Ms. Talib, off aye, on no.
Ms. Garcia?
Of aye, and I'm a no.
Is any other member seek, Ms. Williams?
Off aye, on no. How am I recorded as aye?
You are recorded as aye.
Off aye, on no.
Does any other member seek to change their vote? Hearing none, the clerk will
Mr. Chairman, I want to validate that I'm off aye on no.
Correct. I was just about to ask that, so.
Thank you.
Order, please. Our exceptional clerk will report.
Mr. Chairman, on this vote, the ayes are 37 and the nays are 11.
A majority having voted in favor of H.R. 2627 as amended, the bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. The committee will now turn to H.R. 1553, the Helping Angels Lead Our Startups, the HALOS Act, and vote on the postponed amendment sponsored by the gentleman from New York, Mr. Lawler. We will vote on the Waters Amendment number 1. The question is on the amendment offered by the gentlewoman from California. The clerk will call the roll.
Mr. Lucas? No. Mr. Lucas votes no. Mr. Sessions? No. Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Lukedemeyer? Mr. Lukedemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams? Mr. Williams votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose. Mr. Rose votes no. Mr. Stile. Mr. Stile votes no. Mr. Timmons. Mr. Timmons votes no. Mr. Norman. Mr. Norman votes no. Mr. Muser. Mr. Muser votes no. Mr. Fitzgerald. Mr. Fitzgerald votes no. Mr. Garbarino. Mr. Garbarino votes no. Mrs. Kim. Mrs. Kim votes no. Mr. Donalds. Mr. Donalds votes no. Mr. Flood. Mr. Flood votes no. Mr. Lawler. Mr. Lawler votes no. Mr. Nunn. Mr. Nunn votes no. Ms. De La Cruz. Ms. De La Cruz votes no. Mrs. Houchin. Mrs. Houchin votes no. Mr. Ogles. Mr. McHenry. Mr. McHenry votes no. Ms. Waters. Ms. Waters votes aye. Mrs. Velasquez. Mrs. Velasquez votes aye. Mr. Sherman. Mr. Sherman votes aye. Mr. Meeks. Mr. Meeks votes aye. Mr. Scott. Mr. Scott votes aye. Mr. Lynch. Mr. Lynch votes aye. Mr. Green. Mr. Green votes aye. Mr. Cleaver. Mr. Cleaver votes aye. Mr. Himes. Mr. Foster.
Aye.
Mr. Foster votes aye. Mrs. Beatty.
Aye.
Mrs. Beatty votes aye. Mr. Vargas. Mr. Gottheimer. Mr. Gottheimer votes aye. Mr. Gonzalez. Mr. Gonzalez votes aye. Mr. Caston. Mr. Caston votes aye. Ms. Presley. Ms. Presley votes aye. Mr. Horsford. Mr. Horsford votes aye. Mr. Lieb. Mr. Lieb votes aye. Mr. Torres. Mr. Torres votes aye. Ms. Garcia.
Aye.
Ms. Garcia votes aye. Ms. Williams.
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel. Mr. Nickel votes aye. Ms. Pedersen. Ms. Pedersen votes aye. Mr. Chairman. Mr. Chairman votes no. Mr. Emmer. Mr. Louder, or Mr. Mooney. Mr. Ogles. Mr. Himes. Mr. Vargas.
Is there any member who has not voted or wishes to change their vote? The clerk will report.
Mr. Chairman, on this vote, the ayes are 21 and the nays are 26.
A majority having voted against the amendment is not agreed to. The question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentleman from New York, Mr. Lawler. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment in the nature of a substitute is adopted. The question now occurs on ordering the bill H.R. 1553 as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. Gentleman from New York.
Mr. Chairman, I request a recorded vote.
All those in favor of recorded vote need to raise their hands. A sufficient number having raised their hands, a recorded vote is ordered. The clerk will call the roll.
Mr. Lucas.
Aye.
Mr. Lucas votes aye. Mr. Sessions. Aye. Mr. Sessions votes aye. Mr. Posey. Mr. Posey votes aye. Mr. Lukedemeyer. Mr. Lukedemeyer votes aye. Mr. Huizinga. Mr. Huizinga votes aye. Mrs. Wagner. Mrs. Wagner votes aye. Mr. Barr. Mr. Barr votes aye. Mr. Williams. Mr. Williams votes aye. Mr. Emmer. Mr. Loudermilk. Mr. Loudermilk votes aye. Mr. Mooney. Mr. Davidson. Mr. Davidson votes aye. Mr. Rose. Mr. Rose votes aye. Mr. Stile. Mr. Stile votes aye. Mr. Timmons. Mr. Timmons votes aye. Mr. Norman. Mr. Norman votes aye. Mr. Muser. Mr. Muser votes aye. Mr. Fitzgerald. Mr. Fitzgerald votes aye. Mr. Garbarino. Mr. Garbarino votes aye. Mrs. Kim. Mrs. Kim votes aye. Mr. Donalds. Mr. Donalds votes aye. Mr. Flood. Mr. Flood votes aye. Mr. Lawler. Mr. Lawler votes aye. Mr. Nunn. Mr. Nunn votes aye. Ms. De La Cruz. De La Cruz votes aye. Mrs. Houchin. Mrs. Houchin votes aye. Mr. Ogles. Mr. McHenry. Mr. McHenry votes aye. Ms. Waters. Ms. Waters votes no. Mrs. Velasquez. Mrs. Velasquez votes no. Mr. Sherman. Mr. Sherman votes no. Mr. Meeks. Mr. Meeks votes aye. Mr. Scott. Mr. Scott votes aye. Mr. Lynch. Mr. Lynch votes no. Mr. Green. Mr. Green votes no. Mr. Cleaver. Mr. Cleaver votes no. Mr. Himes. Mr. Foster.
Aye.
Mr. Foster votes aye. Mrs. Beatty.
No.
Mrs. Beatty votes no. Mr. Vargas. Mr. Gottheimer. Mr. Gottheimer votes aye. Mr. Gonzalez. Mr. Gonzalez votes aye. Mr. Caston. Mr. Caston votes aye. Ms. Presley? Ms. Presley votes no. Mr. Horsford? Mr. Horsford votes no. Ms. Tlaib? Ms. Tlaib votes no. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
I vote no.
Ms. Garcia votes no. Mrs. Williams?
Williams of Georgia votes no.
Ms. Williams votes no. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes aye. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Himes? Mr. Vargas?
Has not voted. Is there any member who wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 35 and the nays are 12.
A majority having voted in favor of 1553 is amended. The bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. The committee will now take recorded votes on ordering the bill, H.R. 2622, as amended, reported to the House with a favorable recommendation. The clerk will call the roll.
Mr. Lucas? Aye. Mr. Lucas votes aye. Mr. Sessions? Aye. Mr. Sessions votes aye. Mr. Posey? Mr. Posey votes aye. Mr. Lukedemeyer? Mr. Lukedemeyer votes aye. Mr. Huizinga? Mr. Huizinga votes aye. Mrs. Wagner? Mrs. Wagner votes aye. Mr. Barr? Mr. Barr votes aye. Mr. Williams? Mr. Williams votes aye. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes aye. Mr. Mooney? Mr. Davidson? Mr. Davidson votes aye. Mr. Rose? Mr. Rose votes aye. Mr. Stile? Mr. Stile votes aye. Mr. Timmons? Mr. Timmons votes aye. Mr. Norman? Mr. Norman votes aye. Mr. Muser? Mr. Muser votes aye. Mr. Fitzgerald? Mr. Fitzgerald votes aye. Mr. Garbarino? Mr. Garbarino votes aye. Mrs. Kim? Mrs. Kim votes aye. Mr. Donalds? Mr. Donalds votes aye. Mr. Flood? Mr. Flood votes aye. Mr. Lawler? Mr. Lawler votes aye. Mr. Nunn? Mr. Nunn votes aye. Ms. De La Cruz? Ms. De La Cruz votes aye. Mrs. Houchin? Mrs. Houchin votes aye. Mr. Ogles? Mr. McHenry? Mr. McHenry votes aye. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver?
Aye.
Mr. Cleaver votes aye. Mr. Himes? Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Tlaib? Ms. Tlaib votes no. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Aye.
Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? Mr. Chairman votes aye. Mr. Emmer? Mr. Mooney? Mr. Vargas? Mr. Himes? Ms. Presley, you are recorded as voting on aye. Ms. Presley, off aye, on no.
Is there any member who has not voted? Is there any additional member who wishes to change their vote? Stand by. The clerk will report.
Mr. Chairman, on this vote, the ayes are 45 and the nays are 2.
A majority having voted in favor of H.R. 2622 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. The committee will now take votes on the postponed amendments to H.R. 3063, sponsored by the gentleman from Oklahoma, Mr. Lucas. Our first vote will be the Garcia Amendment number 1. The question is on the amendment offered by the gentlewoman from Texas. Clerk will call the roll.
Mr. Lucas?
No.
Mr. Lucas votes no. Mr. Sessions? Mr. Sessions votes no. Mr. Posey? Mr. Posey votes no. Mr. Luetkemeyer? Mr. Luetkemeyer votes no. Mr. Huizinga? Mr. Huizinga votes no. Mrs. Wagner? Mrs. Wagner votes no. Mr. Barr? Mr. Barr votes no. Mr. Williams? Mr. Williams votes no. Mr. Emmer? Mr. Loudermilk? Mr. Loudermilk votes no. Mr. Mooney? Mr. Davidson? Mr. Davidson votes no. Mr. Rose? Mr. Rose votes no. Mr. Stile? Mr. Stile votes no. Mr. Timmons? Mr. Timmons votes no. Mr. Norman? Mr. Norman votes no. Mr. Muser? Mr. Muser votes no. Mr. Fitzgerald? Mr. Fitzgerald votes no. Mr. Garbarino? Mr. Garbarino? Mr. Garbarino votes no. Mrs. Kim? Mrs. Kim votes no. Mr. Donalds? Mr. Donalds votes no. Mr. Flood? Mr. Flood votes no. Mr. Lawler? Mr. Lawler votes no. Mr. Nunn? Mr. Nunn votes no. Ms. De La Cruz? Ms. De La Cruz votes no. Mrs. Houchin? Mrs. Houchin votes no. Mr. Ogles? Mr. McHenry? Mr. McHenry votes no. Ms. Waters? Ms. Waters votes aye. Mrs. Velasquez? Mrs. Velasquez votes aye. Mr. Sherman? Mr. Sherman votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Scott? Mr. Scott votes aye. Mr. Lynch? Mr. Lynch votes aye. Mr. Green? Mr. Green votes aye. Mr. Cleaver? Mr. Cleaver votes aye. Mr. Himes? Mr. Foster?
Aye.
Mr. Foster votes aye. Mrs. Beatty?
Aye.
Mrs. Beatty votes aye. Mr. Vargas? Mr. Gottheimer? Mr. Gottheimer votes aye. Mr. Gonzalez? Mr. Gonzalez votes aye. Mr. Caston? Mr. Caston votes aye. Ms. Presley? Ms. Presley votes aye. Mr. Horsford? Mr. Horsford votes aye. Ms. Talib? Ms. Talib votes aye. Mr. Torres? Mr. Torres votes aye. Ms. Garcia?
Well, what do you think? Aye.
Aye. Ms. Garcia votes aye. Ms. Williams?
Williams of Georgia votes aye.
Ms. Williams votes aye. Mr. Nickel? Mr. Nickel votes aye. Ms. Pedersen? Ms. Pedersen votes aye. Mr. Chairman? The chairman votes no. Mr. Emmer? Mr. Mooney? Mr. Ogles? Mr. Himes? Mr. Vargas?
Is there any member who has not voted? Any member who wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 21 and the nays are 26.
A majority have voted against the amendment is not agreed to. Now, before we turn to the final item of business, final two items of business, I want to remind everybody, please exit quietly as you rush off to something a lot more fun than this. And the question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentleman from Oklahoma, Mr. Lucas. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. The ayes have it. The amendment in the nature of a substitute is adopted. The question now occurs on ordering the bill, H.R. 3063, as amendment reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. And all those opposed shall signify by saying nay. Nay. In the opinion of the chair, the ayes have it. Mr. Lucas?
Chairman, could I request
a recorded vote has been requested. Those in favor of such, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. The clerk will call the roll.
Mr. Lucas? Mr. Lucas votes aye. Mr. Sessions? Mr. Sessions votes aye. Mr. Posey? Mr. Posey votes aye. Mr. Luetkemeyer? Mr. Luetkemeyer votes aye. Mr. Huizinga? Mr. Huizinga votes aye. Mrs. Wagner? Mrs. Wagner votes aye. Mr. Barr? Mr. Barr votes aye. Mr. Williams of Texas? Mr. Williams votes aye. Mr. Emmer? Mr. Loudermilk. Mr. Loudermilk votes aye. Mr. Mooney. Mr. Davidson. Mr. Davidson votes aye. Mr. Rose. Mr. Rose votes aye. Mr. Stile. Mr. Stile votes aye. Mr. Timmons. Mr. Timmons votes aye. Mr. Norman. Mr. Norman votes aye. Mr. Muser. Mr. Muser votes aye. Mr. Fitzgerald. Mr. Fitzgerald votes aye. Mr. Garbarino. Mr. Garbarino votes aye. Mrs. Kim. Mrs. Kim votes aye. Mr. Donalds. Mr. Donalds votes aye. Mr. Flood. Mr. Flood votes aye. Mr. Lawler. Mr. Lawler votes aye. Mr. Nunn. Mr. Nunn votes aye. Ms. De La Cruz. Ms. De La Cruz votes aye. Mrs. Houchin. Mrs. Houchin votes aye. Mr. Ogles. Mr. McHenry. Mr. McHenry votes aye. Ms. Waters. Ms. Waters votes no. Mrs. Velasquez. Mrs. Velasquez votes no. Mr. Sherman. Mr. Sherman votes no. Mr. Meeks. Mr. Meeks votes aye. Mr. Scott. Mr. Scott votes aye. Mr. Lynch. No. Mr. Lynch votes no. Mr. Green. Mr. Green votes no. Mr. Cleaver. Mr. Cleaver votes no. Mr. Himes. Mr. Foster.
Aye.
Mr. Foster votes aye. Mrs. Beatty.
No.
Mrs. Beatty votes no. Mr. Vargas. Mr. Gottheimer. Mr. Gottheimer votes aye. Mr. Gonzalez. Mr. Gonzalez votes aye. Mr. Caston. Mr. Caston votes aye. Ms. Presley. Ms. Presley votes no. Mr. Horsford. Mr. Horsford votes no. Ms. Talib. Ms. Talib votes no. Mr. Torres. Mr. Torres votes no. Ms. Garcia.
No.
Ms. Garcia votes no. Ms. Williams.
Williams of Georgia votes no.
Ms. Williams votes no. Mr. Nickel. Mr. Nickel votes aye. Ms. Pedersen. Ms. Pedersen votes aye. Mr. Chairman. Mr. Chairman votes aye. Mr. Emmer. Mr. Mooney. Mr. Ogles. Mr. Himes. Mr. Vargas.
Can I change my vote?
Mr. Chairman.
Who seeks recognition? Mr. Torres.
Mr. Torres, you are recorded as voting no.
I want to record, I intended to vote yes.
Okay, Mr. Torres off no on aye.
Is there any other member who has not voted or any other member who wishes to change their vote? Clerk will report.
Mr. Chairman, on this vote, the ayes are 35 and the nays are 12.
A majority having voted in favor of 3063 as amended, the bill is ordered favorably, reported to the House without objection. A motion to reconsider is laid on the table. Staff are authorized to make technical conforming changes to all measures ordered as reported today. Members will have 2 days to file views on each reported measure considered today. There being no further business pending, the committee stands adjourned.